Okay. Good morning, ladies and gentlemen. It's a real pleasure for me to welcome you all to this 5th biannual conference on financial stability, a conference that is jointly organized by the Banco de España and the Centro de Estudios Monetarios y Financieros, CEMFI. The first edition of this conference was held in 2017, just 8 years ago, and yet it has become a well-established event in our calendar. Over the course of today and tomorrow, a total of 37 speakers with diverse backgrounds and coming from more than 20 institutions and universities will discuss both the theoretical and also the empirical aspects of some of the most pressing and emerging issues in financial stability and macroprudential policy. As in previous editions, 12 working papers will be presented and discussed. These papers were carefully selected from over 140 submissions received in response to our call for papers. And this would have not been possible without the work of the scientific committee, co-chaired by Rafael Repullo from CEMFI, who has co-led this conference since its inception, if I'm not mistaken, and Galo Nuño from Banco de España. I would like to sincerely thank both of them, as well as all the other colleagues involved in organizing this event for their dedication and efforts. This year's topics are wide-ranging, from the implications of interest rate risk to the bank lending channel of monetary policy, the link between credit and climate risk, and the implementation of the countercyclical capital buffer, to name just a few. This afternoon, we will have the honor of welcoming Professor Thomas Philippon, who will deliver a keynote speech on stress testing, an issue of great economic and regulatory relevance. And the conference will conclude tomorrow with a policy panel focused on housing risk and macroprudential measures, specifically on the design and the implementation of the borrower-based tools. The panel will be moderated by Professor Javier Suarez from CEMFI and will feature several distinguished experts. I think we can say that this conference is always privileged to host an exceptional lineup of keynote speakers. And today, we have the honor of welcoming Governor Klaas Knot, who will open the conference with his remarks. And this will be followed by a dialogue between Klaas Knot and José Luis Escrivá, Governor of the Banco de España, moderated by myself. Klaas Knot needs no introduction, but, of course, I'm going to introduce him. He is about to complete his second and final 7-year term as president of the Nederlandsche Bank and has simultaneously served as president of the Dutch Financial Stability Committee, vice chair of the Financial Stability Board between 2018 and 2021, and since then, chair of the Financial Stability Board until the end of this month. He has a distinguished public service career as an economist, which spans more than 3 decades, with increasing responsibilities in several authorities, such as the IMF, the Nederlandsche Bank, the Dutch Pension and Insurance Authority, and the Dutch Ministry of Finance. But it is in his capacity as FSB chair that he is in Madrid this week, on the occasion precisely of the plenary meeting held yesterday here at this venue, and it has been an honor for us to host this important event. Yesterday marked his final meeting as chairman of the Financial Stability Board. And Klaas' leadership at the FSB has been instrumental in advancing its core mission, which is promoting international financial stability, not an easy task, as we all know. During his tenure, he has led FSB through the final stages of the pandemic and then through a period of financial volatility, geopolitical tensions, and rapid technological change. And very briefly, some of the key achievements under his leadership include a number of policy recommendations in the field of non-bank financial intermediation, the global regulatory framework for crypto asset activities and global stablecoins, recommendations to enhance convergence in cyber incident reporting, or significant progress to improve the efficiency, accessibility, and transparency of cross-border payments, among others. I would also like to highlight his coordination efforts with other standard-setting bodies such as IOSCO and work on climate-related financial risk and support to the implementation of climate disclosure standards. Similarly, his leadership at the Nederlandsche Bank has been widely recognized, particularly for his contribution to financial stability analysis and macroprudential policy, precisely the core themes of this conference. So without further ado, I will now invite Governor Knot to deliver his speech from this lectern and then join Governor Escrivá for a dialogue on current policy issues. Governor, the floor is yours.
So that was quite an introduction, I must say. Good morning to all of you, and thank you very much for having me here in Madrid. And I want to talk with you about how is the water continuing our work to preserve financial stability. And in order to sort of make the link between the title and what I'm about to say, I want to start by telling you a little story. And some of you may actually know it. It's a story about these two young fish swimming along, and then they happen to meet an older fish swimming in the other direction. And the older fish then nods at them and says, "Morning, boys, how is the water?" The two young fish, they swim along for a bit, and then eventually one of them looks over to the other and says, "What the hell is water?" Well, this parable was famously used by the American writer David Foster Wallace in a commencement speech in 2005. Now, just like Wallace, I don't plan to present myself here as the wise older fish explaining to you what water is. But the point of the story, the point of the fish story, is merely that, like he said, the most obvious, important realities are often the ones that are the hardest to see and to talk about. Now, Wallace was speaking to a class of graduates about the benefits of a liberal arts education in life. To have his idea being used by some central bank technocrat at a conference on financial stability would probably have been his worst nightmare come true. But although it may seem a bit of a stretch, I believe that this idea applies to our world as well, because financial stability is an obvious and important reality, because its impact is universal. Financial stability affects households, businesses, governments, and ultimately the trust that underpins our economies. It's the basis of basically everything in economic life. And because of its universal impact, financial stability seems like a natural state. We take out our phone and we pay. And the bread that we buy costs roughly the same as it did last week. And when we wake up in the morning, our savings in the bank are still there. Financial stability is something that seems to be just there, unconditionally. But it really isn't. It's something that we must continuously work for. It demands vigilance, coordination, and above all, a political will to act before the crisis hits. Now, I know that you are aware of this, but many people tend to forget. And as this is my last address in my capacity as chair of the FSB, let me take this opportunity to look back a bit and to take stock, and to ask ourselves, where do we stand? How is the water? In truth, it has been anything but calm. Over the past years, we've experienced quite some waves in the financial system. The dash for cash during the onset of the COVID pandemic. The commodity markets turmoil following the Russians' invasion in Ukraine. The failure of Archegos capital management in March 2021. And the market volatility associated with the recent trade tariff announcements. Central banks had to intervene in some of these episodes to support market functioning and the supply of credit to the real economy. And in each case, parts of the non-bank financial sector played a central role in amplifying the stress. Non-bank financial intermediation, or NBFI in short, has grown into a critical part of the financial system. Its rise has been driven by regulatory shifts, by a search for yield, by technological innovation, and demographic trends leading to asset accumulation. the NBFI sector brings some real benefits. It offers a diversified source of funding and much-needed competition for the banks. But they also bring their own set of vulnerabilities, liquidity mismatches, and the inability of some market players to prepare for them, leverage, and growing interconnectedness with the banks. Historically, regulation of this sector focused on investor protection, on market integrity, and other mandates. But those don't fully capture systemic risks. So we also need a financial stability lens. And that is what the FSB has brought to the table. Our work to date has included policy recommendations to enhance money market fund resilience, to address structural liquidity mismatch in open-ended funds, and to enhance liquidity preparedness for margin calls. Later this month, we will deliver policy recommendations to the G20 to address financial stability risks from leverage in NBFI. Now, a fair question to ask is, have we made a difference? The recent bout of tariff-related volatility in global markets could serve as a test. We saw a global sell-off in equity markets and historic trading volumes. Typical correlations between certain asset classes broke down. We saw some deleveraging, and we saw large margin and collateral calls. Yet, the system held, and that's encouraging. But let's be honest also here, we can't credit our reforms just yet, because the FSB's recommendations have not yet been implemented in full. And recommendations alone don't reduce systemic risk. Implementation does. So that means that authorities must not only put them into national laws and regulations, they must also have the capacity to operationalize them. And one of the biggest challenges that we face here is NBFI data. We need better data. We need more data, but above all, we need better use of data. There is a reason why the non-bank sector was formerly called shadow banking. It is opaque. There are gaps. And those gaps means that we often don't see the vulnerabilities until it's too late. The quality and timeliness of non-bank data are essential for identifying and assessing vulnerabilities and for designing and calibrating effective policies. We must address these data challenges. We can't keep relying on crisis to reveal what we should have seen coming. That's why a high-level group within the FSB is now exploring how to close such data gaps, to support risk monitoring, policy design and implementation, and cross-border cooperation. And let's be clear, we can't just copy-paste banking rules onto the NBFI sector. It is too diverse and it's too different from the banks. We need to look at both non-bank entities and activities. But our goal should be clear, a level playing field across the financial system. Not by weakening the bank rules, but rather by strengthening the resilience of the non-bank sector. Which brings me also to the banking sector. During my tenure as FSB chair, we witnessed something unprecedented, which was the failure of a global, systemically important bank. The demise of Credit Suisse, together with the failure of 3 US regional banks, was a stark reminder that bank failures are not just relics of the past. It brought lessons for banks and financial authorities. In some areas, our work to make the banking sector more resilient is not yet complete. Take the final Basel III standards. These are designed to strengthen the resilience of banks to withstand losses. And yet, they still have not been implemented in many, many jurisdictions. The Credit Suisse case also highlighted that more than 15 years after the global financial crisis, authorities still face challenges in dealing with failing banks. So yes, we have made progress, but we're not done. And in the meantime, of course, we must protect what we have built. Because let's not forget, during all the recent episodes of financial stress, the banking system held up relatively well. In fact, during the pandemic, banks acted as a shock absorber, not as a shock amplifier. They absorbed losses, they kept credit flowing, they helped the economy afloat, or to keep the economy afloat. And that is no small feat. And I believe that that is largely thanks to the reforms that we put in place after the global financial crisis. The years of hard work, the years of tough decisions, the commitment to resilience. But now, more than 15 years later, we are hearing familiar calls again. Calls for deregulation, but also calls for simplification. And let me be clear, those are not the same. I understand the desire to simplify. Banking regulation and supervision has become overly complex. Over the past 15 years, a great deal of regulation has been introduced from various angles. From global, EU, national angles, micro versus macro angles. New risks were added to the plate, old ones were rarely removed. There is some overlap here and there is some friction here and there. And yes, sometimes there's also a lack of supervisory proportionality for smaller institutions. And that is all worth looking into. But keep in mind that beyond some point, simple rules are less risk sensitive. And that means that they have to be stricter. You want simpler rules? Sure. But those rules must then be calibrated at a more prudent level. That's the general thinking behind the standardized approach of Basel III. That's also the thinking behind the leverage ratio. Most importantly, what we must avoid is confusing simplification with deregulation. Deregulation effectively means lowering buffers by relaxing the rules. And that would both reduce resilience in the banking system and increase the likelihood of future financial crises. We cannot afford to undo the progress that we have made, especially not now, in this time of unusually high uncertainty, both on the economic and on the political front. That would be a big mistake. As the late Rüdiger Dornbusch used to say, the crisis takes a much longer time coming than you think, and then it happens much faster than you would have thought. Which brings me to my next point. The developments in both the bank and the non-bank sector are unfolding against a backdrop of major structural shifts. Shifts that could reshape financial stability as we know it. I'm here talking about technology, about payments, and about climate risk. Technological innovation is transforming the financial sector. It is adding new layers of complexity, and it is doing so at speed. The period leading up to the 2008 global financial crisis was marked by balance sheet expansion and financial product innovation. But over the past 15 years, the focus has shifted toward technological innovation. And the FSB has been watching this closely. It is our job to harness the benefits while mitigating the risks. And yes, also here, the benefits are real. Technology has made financial services faster, more accessible, more inclusive, and more efficient. And in some areas, like in the area of AI, we have only started to see its full impact. But it also brings new risks. Why? Because of the speed and scale of adoption. For example, in cyber attacks. Because of growing interconnections with the traditional financial system. Because of concentration in services in a few key providers. Technology creates new interdependencies, and it can accelerate the pace at which a crisis unfolds. Technological innovation is perhaps most visible in the payments space, where new platforms and digital assets are rapidly reshaping how value moves across borders and between users. These dynamics are most visible in crypto assets. This fast-growing market has seen more than its fair share of bankruptcies, of liquidity crises, and outright fraud even as its links with the traditional finance continue to grow. At the FSB, we have long maintained that crypto does not yet pose a systemic risk. But recent developments suggest that we may be approaching a tipping point here. Barriers for retail users have dropped significantly, particularly with the introduction of crypto ETFs. And the interlinkages with the traditional financial system continue to grow. Stablecoin issuers, for example, now hold substantial amounts of US treasuries. And that is a segment that we clearly must monitor closely. The crypto ecosystem will continue to evolve, and so must our regulatory frameworks. Jurisdictions are actively developing these, and the FSB's recommendations form a common foundation. This is especially important given the inherently cross-border nature of crypto. Effective implementation must also extend beyond the G20, supported by strong regulatory and supervisory cooperation. Now, part of the crypto's rise can be traced to the shortcomings of traditional cross-border payments. And this is a very complex technical issue. But solving it has real-world benefits for people, for businesses, and for economies. And that's the goal of the G20 roadmap for enhancing cross-border payments. The aim of the roadmap is to bring about cheaper, faster, and more transparent and more inclusive cross-border payment services for the benefits of citizens and businesses worldwide. Also here, we have made progress. The FSB, the CPMI, and others have done a lot of work. Our goals, however, are quite ambitious. And while they have driven changes by both the private and the public sectors, we continue to see significant challenges, particularly in certain regions and certain payment corridors. As we move toward crafting a strategy for the next phase of work, we are seeking to clarify the issues that continue to impede progress, and we will continue to work with the private sector to get it done. Next to technology and payments, we face another growing challenge. One that is no longer on the horizon, but it's right at our doorstep. And here I'm talking about the challenges related to climate change. Now, climate change may have originated outside the financial sector, but its impact on financial stability is very real. Extreme weather events are becoming more and more frequent. And as they occur, the risks to financial systems continue to rise. These events test the ability of financial institutions to manage risks and to maintain services, especially in the most vulnerable regions. And that is why we must keep strengthening risk management practices. And that is why we must continue to build resilience across the entire global financial system. The FSB's climate roadmap, launched in 2021 and endorsed by the G20, gives us a coordinated path forward. It focuses on 4 key areas: firm-level disclosures, data, vulnerability analysis, and regulatory and supervisory tools. These 4 pillars are not standalone. They are connected and they build on each other. For example, we need consistent and reliable corporate disclosures as a foundation to close some of the data gaps. They help firms and authorities to better understand climate-related financial risks. Better data leads to better analysis. And better analysis leads to better policy. And also here, we are making progress. More jurisdictions and companies are adopting climate-related disclosures. New global standards on sustainability assurance are boosting trust in those disclosures. And tools like climate risk dashboards and scenario analyses help us to understand the inherent vulnerabilities. International bodies are issuing guidance on how to integrate climate risks into existing regulatory and supervisory frameworks, and good practices are being identified. Across the globe, the global financial community shares knowledge and shares good practices here. But let's be honest, challenges remain, especially when it comes to implementation. The groundwork is there, but now the focus must shift to action. Action by firms, action by authorities. We still lack reliable, granular, and comparable data. And that makes it hard to fully assess and manage climate-related financial risks. And let's also face it, traditional financial stability tools weren't built for this. They're not always fit for purpose when it comes to forward-looking, long-horizon risks like those related to climate change. And that's why developing robust, climate-specific analytical approaches must remain a top priority. Because climate risk isn't just an environmental issue. It increasingly is also a financial one. And it's one that we can't afford to ignore. Now let me wrap up. Financial stability is an international public good. Every single issue that I've mentioned today, be it NBFI, banking, crypto, payments, climate, they all cross borders. And so must be our response. If we want to meet today's challenges to financial stability, we have to continue to work together. And we need to stay committed to the international bodies that we build to underpin such cooperation. For example, the Basel Committee and also the Financial Stability Board. In a fragmented world, global cooperation is harder, but it is also more essential. During the global financial crisis, policymakers acted swiftly and they acted in unison. We must preserve that capacity. Because for society, financial stability is like what water is for the fish. We barely notice it until it's gone. Preserving financial stability requires continuous hard work. It is complicated. It's technical. It's not glamorous. Calibrating risk weights for banks doesn't make headlines. It doesn't fill the streets with protesters and the like. But therefore also, it doesn't always get the attention that it deserves from policymakers among all the other issues that they have on their plate. But make no mistake here. A stable financial system is the foundation for almost all public policy. When financial stability is lost, everything else falls apart. Governments can't focus on education or healthcare or climate. They're too busy drawing up rescue plans for an economy in free fall. So we have to continue our work, which means maintaining our ambition as policymakers to take the agreed policies all the way through to implementation. So let's keep our eyes on the water and let's keep it safe and stable. I thank you very much for your attention.
Enough time to touch upon several topics. Let me just start as a follow-up of your intervention, Governor, just continuing with some of the messages that you just said, because definitely you mentioned a lot of areas that deserve further attention. You mentioned NBFI, recognizing that it's a quite diverse sector. You mentioned as well the current debate between simplification and deregulation, the technology and the challenges coming from crypto assets. We can come back to this later. But considering your past experience, your background, not only as the Financial Stability Board, but also 14 years as President of the Netherlands, you also have been very much involved in the Basel Committee. let me just ask a general question on which lessons would you like to emphasize for the future to come, or where do you think we should focus more? You know, where do you think we should be the greater focus?
I hoped that I already
Yes.
drew some of my lessons at the podium there. Now, if I try to perhaps summarize it in one sort of catch-all word, then I would opt for the word diversity. Diversity both in the financial system. As a central banker, you're typically mostly focused on banks, because that's closest to sort of the monetary transmission process, etc. So in the past, I was also quite heavily involved in banking regulation, the whole Basel word, etc. Through the FSB, I became more and more involved in the non-banks sector, and that's an enormously diverse set of institutions. So the whole concept of resilience in the non-bank area is much more diverse than the concept of resilience in banks, which is basically about capital and liquidity buffers. But, well, in NBFI, it's such a heterogeneous space that diversity is really something that you have to keep in mind. And diversity I can also use in terms of the membership. Because we are, most of us are coming from advanced economies, but I think the strength that I also discovered while being active in the Financial Stability Board, while chairing this Financial Stability Board, is actually in the diversity of its membership. So it's a G20 plus committee. We have representatives both from the advanced world, but also from the emerging markets and developing economies. And as a matter of fact, during my tenure, I have tried to sort of be inclusive and reach out a little bit more to that part of the world as well. And I think it has greatly enriched some of our discussions. For instance, on crypto assets and on stablecoins, most of the emerging markets and developing economies are completely on the receiving end of what happens in other countries. And there are serious issues about loss of monetary sovereignty in the developing world, etc. And I think that has, the debate at the FSB table has benefited greatly from diversity. I know it's a word that on the other side of the Atlantic is no longer as permissible, but luckily we are in Europe here, so that would be my central theme.
Perfect. I think that precisely this is why it's important also to highlight this word, no? The diversity. So, Governor Escrivá.
May I say something
yes,
on this?
Ahead.
Because to me, what Klaas was indicating give rise to the following reflection. I mean, over time, and particularly from central banks and bank regulators, we have realized important to strengthen standards and overall regulation. But here the risk is that there is a sort of regulatory arbitrage, both cross-border, but also even within some jurisdictions. So to the extent that we strengthen the standards and the regulation for the core of the financial system, namely the banks, the risk is that other parts of the system are benefiting in terms of lower standards and become more risky and more relevant over time. So that's the reason why an institution like the Financial Stability Board is so necessary to encompass all the regulators and supervisors of the financial system and to try to have a comprehensive view about how this risk may evolve between institutions, between jurisdictions, and try to really avoid that this regulatory arbitrage is moving in the wrong direction.
Totally right. The importance of this international cooperation and avoiding or ensuring the level playing field. So I was going to move moving on to macroprudential framework, and the question to you, Governor, is related to precisely to the available toolkit that we have as authorities to address macroprudential risks, because we know that macroprudential risks are quite diverse. We can say that it is multidimensional because systemic risk has many different phases. And as authorities, we have different type of tools, the ones that we call the capital-based tools, such as countercyclical capital buffer, the systemic risk buffers, but we also have the so-called borrower-based instruments. And we have seen some European countries have introduced in the area of the countercyclical capital buffers, they introduced the idea of positive neutral, others are also experiencing the deployment of the borrower-based measures. So, Governor Escrivá, what are the advances here at Banco de España in the development of its macroprudential toolkit, and how do you see this area evolving in the near future?
Well, that's a crucial issue to us because Spain is a country that, given our experience, past experience, we know very well that lending can be extremely procyclical, leverage can be very procyclical, and then we also know from the past that we lack instruments. We as macroprudential authorities, we lacked in the past the instruments to be able to smoothen this cycle and to avoid both financial stability disruptions, but also macroeconomic ones and the impact on the entire economy. So our history is very telling in this respect. It's not surprising that in the Spanish case, the legislator gave us, to the Bank of Spain, ample room for activating macroprudential tools. The first we have activated is the countercyclical buffer. We have decided to do so in a gradual manner, up to 1%, and over a period of 2 years, and we are in the middle of the process of that. This process of endowing this fund will end up by the fall of 2026. But of course, the capital is a non-target instrument. That's the reason why borrower-based measures, setting limits to lending standards is also a very important tool when the problems are in particular instruments, lending instruments with particular ways of expanding credit more than probably this advisable. Here, we are at the following point. We feel, as in the same we have applied to the countercyclical buffer, is that we have to activate and to deploy the instruments in normal times, or at least not when we are already close to a very strong dynamic in credit in these boom and bust cycles. That's the reason we activated already the cyclical buffer, and that's what we are thinking about the borrower-based measures. In Spain, because of the extremely the high amplification of the previous credit cycle, we started from a very low credit level, so the cycle is a long one. So we are still in the middle, probably. This is difficult to judge sometimes, but we feel that we are in the middle of the cycle. So it's time, and that's what we are working on now, to start first thinking of the metrics that we have to use and the particular type of standards we have to affect in credit, in lending, and this requires a strong analytical work that we are undertaking at present, and when this is completed, it will be the time to decide what instruments should be first employed, and second, what should be the thresholds to be used. And that's something that requires thorough analysis, and we have already told the banking institutions in Spain that we are working on that. It has been also been reflected in a recent financial stability report, and I think this is a priority in the work of the Direction General of Financial Stability Regulation and Resolution. So certainly this is very important to us, and we are hands-on.
Thank you. You mentioned, yes, because you mentioned timing. No? We'll particularly ask Governor Knot, because you also have your appraisal on the use of these measures, the borrower-based measures, and also you have experience in your own country.
Yeah, what I would say conceptually, if you think about macroprudential measures, you can draw a distinction between, on the one hand, those measures that are meant to prevent the build-up of vulnerabilities in your economy, in your credit cycle, etc., and those macroprudential instruments that are meant to increase the resilience of the financial system in situations in which, unfortunately, these vulnerabilities begin to manifest themselves. And if you then look into our toolbox, one easy conclusion is that we have many, many more tools in the second category, i.e. strengthening resilience predominantly in the banking sector, counter-cyclical buffers, systemic risk buffers, sectoral risk weights, and what have you. And we don't have too many instruments that sort of are there to prevent the build-up of vulnerabilities, because these instruments are much more intrusive into other parts of economic life. Take the borrower-based measures, increasing loan-to-value or loan-to-income. Of course, I mean, from a theoretical perspective, that's what you should do if you fear that the credit cycle is getting out of hand. But hey, what does it mean if you tighten loan-to-value, loan-to-income measures? Essentially, you're telling young couples in the economy, you wanted to buy your first house? Sorry, you have to wait a few years longer because we make borrowing more difficult for you. Most macroprudential measures are of the type increasing borrowing cost without increasing borrowing cost. So indirect, making borrowing more difficult without sort of changing interest rates. And of course, then you bump into other public policy objectives, and that has also been the tension in the Netherlands. Why, for instance, despite the fact that year after year the IMF is advising us that the loan-to-value and the loan-to-income measures should be in the toolbox of the central bank, the Ministry of Finance is not willing to give up its competence in this area, because it maintains that, of course, activating these instruments requires a trade-off. It has a trade-off between financial stability and between accessibility of the housing market. And these are two conflicting public policy goals. And that's, I think, an illustration why these instruments of the first kind are much more complicated than the ones strengthening resilience in the banking sector.
Oh, definitely. You raise the concept of the governance of these measures. I think it's quite relevant, precisely because of the conflict of interest that may appear. So if that's okay, let's move on to stress testing, because this will be a question to both of you, and I will start, if that's okay with you, Governor Escrivá. We know the stress testing tools have emerged as a key policy tool to use or to assess the resilience of the banking sector, particularly after the great financial crisis. But however, since then, we can say that the economy has changed, the financial system has evolved significantly, and we live now in a more volatile and unpredictable environment, and additionally, I don't know, through the years, there may be some aspects of the methodology that could be further improved. So, Governor Escrivá, what's your appraisal on the current stress test practices here in Europe?
Okay, I was actually involved around 15 years ago when the stress test started to be designed and used for micro and macroprudential purposes. And now I have come back to, after doing a number of other things, and so I have some perspective. And I would say that we started designing the instrument and using it with, let's say, ambition. But when I now look what we are 15 years later, I would say there is still room for being more ambitious and to continue progressing in the way we deploy the instrument. And I'm going to refer to two things here. One is the methodology that we used and the analytical background. I think this contains important econometric modeling. Seems to me that when on monetary policy we have made substantial progress in the way we use models in a robust and we rely on the state-of-the-art modeling. The instrument that we use in Europe and Europe in general, I mean, for stress tests is not as close to the state-of-the-art as is in monetary policy. So there is room for enhancing how we use it. Also, I think we tend to rely too much on inputs that come from the institutions, from the banks, particularly for the pre-provision profit. And I think that it would be desirable to, and I think this is the case, for instance, in the United States, that they really have gone further in having the capacity internally in the central bank to produce itself pre-provision profits. This also would allow to a further enhancement is not to have static balance sheets for the exercise. So there are here, these are examples of areas which I think we should continue making progress. And the reason for that is because I do believe that stress tests can be a very powerful exercise. Yeah. Not only, but we need to be more comfortable with how we do it in order to go further. Here in Europe, we tend to use it primarily from the EBA exercise every 2 years, which is public and it's linked to, let's say, to Pillar 2 capital requirements. I think that there are other uses which might be very important, primarily for macroprudential, because you do it at the micro level, but by aggregating all the data, you have a macro analysis, and here you can have more, let's say, scenarios for stressing than the one we used at present. Could be a variety of scenarios. And I would say that also we could use it by looking at certain part of the system or group of banks, group of institutions in a more agile way. It would be more an internal work in our assessment of vulnerabilities. And so I see a lot of potential in doing so. But we have to work on both directions, on the methods to be used and how we employ it flexibly at the national level, at the European level, at the micro level, and at the macro level.
And the need to develop this capacity as well. Yeah, no, very important. How do you see that? What would be your insight on stress testing design?
Yeah, I would sort of center my comments around the concept of agility. I mean, I already illustrated that over the last few years we've seen a couple of unprecedented shocks, and also the frequency of these shocks seems to go up. And that means that you have to have a tool that is nimble in the sense that can adjust very quickly to run additional scenarios, which we do also in macroeconomic forecasting, but then to also prepare the banks for the possibility of different scenarios evolving. That means you have to make sure that stress testing, which I agree is a very, very important tool, it's probably one of the better tools that we have in supervision, that stress testing also continues to be sufficiently agile and nimble. Now there is the difference between what we call top-down stress test and bottom-up stress test. And the process in Europe around, let's say, the bottom-up stress test is one that I could have mentioned in my speech also when I talked about examples for simplification. Because I do believe that that sort of whole structure has become so complex, so time-consuming, that the results of the stress test are there probably at the moment in which banks are already concerned about another shock than the one that was simulated in the stress test. So I think we should probably do more top-down type stress tests because they can be adjusted more quickly, more nimbly to the changes in reality. And then I would also say, traditionally we focused on the banks, but I think what the Bank of England has done in terms of a systemic liquidity stress test for the non-banking sector and what the ECB has also announced it is about to start, I think is increasingly important given that non-banks now constitute roughly half of all financial intermediation worldwide and clearly are becoming an increasing part of the financial system. That's of course a different type of stress as the concept of resilience is different in non-banks from banks. Banks more focused on capital, non-banks more focused on liquidity mismatches, etc. But I do think that stress testing will become equally important in NBFI than in the banks.
Yeah, definitely. So we have 5 minutes left, and I would like to devote these 5 minutes on another relevant topic, which is, you mentioned that in your intervention, the digital transformation and the effects that this may have on from a financial stability perspective. All the challenges coming from technological innovations, because new technologies are transforming the provision of banking services through different channels. We have, of course, artificial intelligence and machine learning, cloud computing. I would like to have the opportunity to ask you about artificial intelligence. But first, Governor Knot, there's also a transformation in the structure of markets, thanks to the distributed ledger technology, the DeFi. We have also various forms of crypto assets. You particularly mentioned stable coins. But I would like if you could elaborate a little bit more on this particular segment of the crypto ecosystem and the challenges that may come, or what are the greatest risks that you see in the stable coins coming from the stablecoin sector?
Yeah, I think you correctly pointed out the emphasis on stablecoins because before going there, I mean, there's a distinction between stablecoins and, let's say, other crypto assets and markets. The other crypto assets are, in essence, very risky investments, but we know how to deal with them, right? I mean, people are free to make choices. We don't prohibit people from going to casinos. So why should we prohibit people from going into crypto? As long as they understand the risks. So the regulatory framework is then very much focused on investor protection, on sort of having the governance, separation of funds, separation of duties, the governance structures, etc. Stablecoins is actually more tricky because it has the pretense of stability through a mechanism, a pegging mechanism with underlying assets. But of course, where there is the pretense of stability, there is the potential risk of runs. And these runs could be very destabilizing, particularly when stablecoins were to develop into a sort of settlement mechanism for the other crypto assets, as is increasingly, I think, beginning to happen. So with stablecoins, we have to be very, very sharp on the regulation. The concept behind the stablecoin is not all that different from a money market fund. It's, in essence, you're entitled to a claim on the underlying assets. So within the FSB, we then say, okay, same activity, same risk, same regulation. So we should make sure that at least the regulatory certainty that you get in that area is comparable to the certainty that you have in comparable economic activities. Which means that we have to be really, really tough on sort of being able to confirm that the underlying assets are indeed there and that the settlement mechanism is there, the stabilization mechanism is there, so that the stablecoins indeed can provide the stability that they pretend. Now, whether that is already the case with the existing stablecoins, I have my reservations here and there. And also the fact that these things are cross-border, which also means that some countries are, they run the risk that their sort of domestic payment system is over-flooded by stablecoins coming from different jurisdictions. So not only do we need a good and adequate regulatory framework, we also need global coverage of this regulatory framework. Because nowadays you can take a server under your arm to any place in the world and start issuing digital assets. So we have to make sure that wherever the digital asset is issued, that the users of these assets can have a certain degree of assurance that there is these minimum recommendations are being implemented with respect to the regulation and supervision of these stable coins.
Governor, maybe you want to react to the stable coins. If not, I have a question for you on artificial intelligence, because...
I think
okay.
Klaas
Perfect.
presented
because we are out of time.
Where we are, and it's complex.
Fantastic. Then just one last question on artificial intelligence. It's clear that it's expected to bring significant benefits in many areas, we know that. But it comes also with some risks. and challenges associated that need to be addressed. And in Europe, in the European Union, the use of artificial intelligence is regulated by the Artificial Intelligence Act. And in Spain, particularly here, Banco de España is expected to be the authority responsible for this supervision. So my question would be, Governor, how is the Banco de España preparing to face these new responsibilities, and how do you think these new challenges should be addressed?
Okay, here there are two completely different levels. One as a market surveillance authority, and a completely different one is as practically all agents in the economy, we have to be prepared and equipped for these new technologies in order to enhance and to reap the benefits that from relying on this kind of instruments. So I think the two different levels. On supervision, I mean, it's true that I would say, unfortunately, the European regulation has segmented somewhat the market. They have done on other issues. Probably now with the new spirit, probably we would have done something different. But the reality is that it has been decided that the supervision of the use of AI models by different sectors in the economy, and in particular in the case of banks or in the case of insurance companies, will be the supervisor of the insurers. In the Spanish case, it will, in principle, be with the general supervisor. So we are the supervisors. We will be the supervisors of the use of these models for the Spanish banks. But here there is the risk of segmentation. That's the reason we need to coordinate. In spite of this regulation framework, we need to ourselves to make efforts in order to coordinate first with the supervisor at the national level, at the European level for general purpose AI models, and at the same time we need to explore ways why the ECB should be involved, at least in gathering all the information over time that we may be producing in terms of incidents or experiences, because here, I mean, we should work collectively in order to have a vision of a single banking market. So that's as a first reflection. But okay, the fact is that we will be the market surveillance authority, particularly for what it is stated in the regulation as high-risk models, which is those models that might be used by banks in order to run people according to some criteria for deciding whether or not, or the extent to which they get credit from them. Individuals, not firms. For firms, it's not in principle supposed to be high risk. But it's true that this taxonomy is not closed, that we have to see how these technologies are actually employed. So I would say that at a certain point in time, this taxonomy, and this is foreseen in the legislation, may change. So the kind of models that require more surveillance may change over time. So it's important overall surveillance of how the models are used in various sectors. And that's something we need to do, and we need to be equipped for that with appropriate people, but also with coordinating device with other instances. The second, and we are working on that. I mean, we are working on that. At the same time, we are working, and this is somewhat related, for our internal use of AI models. We have decided to have there are different models, but we think the best model is to have in an organization a critical mass of people working horizontally in how to use it in the various functions of the bank. When we have examined this issue internally, we have realized that practically all the functions of the bank can benefit from, in the future, will benefit in the future for the use of these instruments in different directions. So, but for that to happen, instead of a segmented way of doing that in different departments, we have created a center, what we have labeled as Center for Experimentation and Development of Technologies, with particular focus on AI, that will be located in Barcelona. and in order to try to have the human capital that can be developed there because of being the major Spanish technological center. And we have already, we have, I think, 25 openings now for AI engineers and data scientists to work together horizontally in the bank. And that's important, we feel that linked to the European project of the so-called AI factories, and with one of the factories would be in finance, we can work together also with the Spanish banking system in order for them to experiment in a sort of sandbox. It's not exactly a sandbox, but in the type of sandbox environment to try their models in experimental way in that factory, and we will be also involved. And I think we see benefits in that they do it also in collaboration with the surveillance authority. I mean, this may save time for the future. So that's the way we envisage to operate in this area.
Perfect. Definitely, it's a quite changing environment and needs this flexibility to adapt. So we have reached the end of this session. I don't know if you would like to add something, any of you, but if not, again, it's been a pleasure having you both here with us. Thank you very much for these insightful and fruitful discussions. And I think that we have a break for a coffee break until 10:30. Thank you. Thank you, both of you.
Thank you.
ahora sí, 1, 2, 1, 2.
Vale, perfecto.
1, 2, sí, hola, sí, 1, 2, 1, 2.
Se quita, se pone en el lateral automáticamente. Debería de ponerse automáticamente.
Sí, hola, sí, sí, hola, sí, 1, 2, sí. Hola, sí. Probando, 1, 2, estamos haciendo prueba de microfonía. 1, 2, sí, hola. 1, 2, sí, sí, 1, 2, 1, 2.
first session of this conference. Let me just make two brief comments before we get started with the first paper. The first comment is that we have tried to group papers into topics. I mean, this is not always easy, but I think that you will appreciate that somehow there is some theme that goes through all the sessions in this conference. And the theme of this first session is on interest rate risk, something that obviously brings the connection between monetary policy decisions, interest rate risk, and financial stability, one of the themes of this conference. The second thing that I would like to say is that the time is very tight. The timing is very tight, so I will ask the speakers to stick to the prescribed times. 25 minutes for the presentation, 10 minutes for the discussion, and 5 minutes for general discussion, and I will use these cards to sort of tell you how you're doing with the time. Okay, right. So the first paper is by Rainer Hasselmann and co-authors, and it deals with interest rate risk using a very nice sample of German data. And the second paper by Paolo Varrazzo is also looking at interest rate risk, but using data from the US. So now, without further ado, Rainer, the floor is yours, and you can start.
So thank you very much, Rafa, for the invitation. And my paper is on interest rate risk, deposit rates, and financial stability, joined with Puri Abasi and Ilirina Schala, both from Bundesbank. And given their affiliation, the usual disclaimer applies, especially when I present and give my own views to the story. So what we are trying to do in this paper, we're going to look at the transmission of monetary policy to rates. And on the asset side, there is a large literature on this, and I think by now we have a very good understanding on how this works. There are the seminal papers by Bernanke, Gertler, but also my discussant has written a couple of very important empirical papers that allow us to understand how monetary policy rates transmit to loan rates and then impact the real economy. There has been much less research on the link of monetary policy rates and the deposit rates. And we believe this is very important for particular financial stability reasons, because when banks do extreme maturity transformation, there can be interest rate risk. The current view that we have on this topic is mostly shaped by the work of Drexler, Philip Schnabel, and Savoy, and they identify a presence of deposit franchise value, which serves as a hedge against interest rate risk, which means that banks either have, I mean, there are now a bit controversy in this literature that there might be different reasons for this. It could be market power of deposit rates. It could be what Juliane Begenau argues, uniform deposit rate setting by large banks that is somehow hindering transmission of money of these rates. And by this, banks generate rents and have a protection or hedge against sudden increases in rates. And experiencing the situation in 2022 in Germany, we felt that there are various reasons why we find it hard to believe that this can be the only story, and we try to understand better why there's so little competition. I mean, most people I know or we knew were somehow trying to get higher interest rates, and they were calling up different banks, and banks in Germany at the time did not offer higher rates. And as an economist, I find it hard to understand because they're very profitable business opportunities. There's a paper by colleagues at Bundesbank, by Carol, that shows if you leave as ECB reserves, you already earn very high spreads, but you can of course issue also new loans. And so it's surprising that banks don't bid up the rates, that they remain so low. And so we think there must be something else. that is impairing this transmission, and we do believe that it's actually potentially interest rate risk itself that is impairing this transmission. So that is our conjecture that we're going to test in this paper. We believe that we were before in a period of negative interest rates. Deposits actually had been a problem, particularly for banks that had a lot of deposits. So because mostly they were not fully transmitting the negative rates, they kept zero interest rates. And then banks, we can see in the cross-section there has been some research, again by my discussant, but also Florian Haider has written an important paper on banks being forced to take on excessive risks if they lose money on their deposits with negative rates. And we can see actually that before this interest rate shock occurred, that there's a quite heterogeneity among banks, in particular the regional banks in Germany took up enormous, we have fixed rates on mortgages and there was an interest rate boom, and we can see that banks have actually done a very intensive maturity transformation. And once there is this interest rate hike, you can look at the market-to-market valuation, and you can see that actually many of these fixed rate loans have enormous losses. And once you have these losses, you are somehow hindered in the transmission because you cannot go to the market and fund yourself with these negative NPV loans you have on your balance sheet. And on the other side, you cannot offer much higher rates because then you would make losses. And we believe that this is a very important issue that's hindering this transmission to depositors. So the research question I'm going to present empirical evidence on is whether interest rate risk impairs the transmission of monetary policy to deposit rates. And we're gonna do, actually, this paper has two parts. We're gonna look at the setting in Germany. We use the Euro system data, and that is very detailed by now, and we have two parts. The first part is a little bit similar to the paper that Amit Zeru and his team has written for the US, where they do a market-to-market valuation of the assets of the banks and want to see how the interest rate hike affects these valuations. And we determine these losses, and by doing so, we identify the franchise value and the forgone returns to depositors because of this impaired transmission. The second part, then, we try to identify empirically whether interest rate risk itself is really impacting the deposit rate setting by banks, and we want to see which factors play a role here, how it impacts deposit in and outflows and the profitability of banks. So as I said, there are several data sets. The unaccredited data gives very detailed information on individual loan exposures, on their interest rate, and on actually whether it's a fixed rate loan or a floating rate loan. So this allows us to determine the net present value of a loan at any given point in time. For interest rate setting, we have a smaller sample, unfortunately. There's the Zista, so at least the Bundesbank has actually not so much detailed information. It's just about 240 banks that provide this information here. But then you have very detailed information on different term deposits, on sight deposits and saving accounts. And this is linked with other data sets. So this is the event, a well-known figure to most people in this room. We show the ECB deposit rate, the short-term rate by the blue line, and we have from negative rates, so minus 0.5 to up to 4%, an increase within relatively few months. And the German Bund rate, the 10-year rate, shows that also long-term rates have been picking up by about 3%. So the first thing we do is we compute on a bank level the interest rate exposure by calculating a weighted average of the maturity of those loans. When a loan is floating, we consider this maturity to be zero because the interest rate is then just adjusting. So this gives you in the end a value of 10, for example, that would imply that the assets in the loan portfolio do have a fixed interest rate of 10 years. So this measure we calculate on the bank level, and then we can look at the distribution, and we can see that there's quite some variation, and there are banks that have very, very long maturities, and there are banks that don't have such a high proportion of fixed rate loans in their balance sheet. I have to say these banks are, and that is of course an issue for our identification, not totally comparable. So large commercial banks like Deutsche Commerzbank and these are banks which have not so much deposits. They are more market funded, and they have much less of these very long-term loans and assets on there with fixed rates, while smaller regional banks actually tend to be those where the maturity transformation is very extreme. So what we do next is really just a version that's a little bit more detailed than the CERU paper on the monetary policy rate hike in the US. It's basically providing a market-to-market valuation of loans at each point in time. And so the formula gives you what are the cash flows of a loan, which you can see from under credit for how many years is it outstanding, what amount will be repaid if it doesn't default. You have a probability of default given, so you can predict based on this PD the cash flows. One thing we don't have is the recovery rate, so we plugged in 40% for this one. And then the assumption in this valuation we do is that you cut the bank into two parts. You cut its assets and its liabilities in separate parts, and you assume the bank would fund all of these activities on the market. So we take the forward rates that the ECB is publishing for the different time horizons. So if a cash flow occurs in 3 years, we take the 3-year prevailing forward rate at this moment. And for assets and liabilities, we assume that both of those would be funded at a point in time after the hike or at any point in time at the market prevailing conditions. And this is how we calculate then the net present value basically of each loan, and we can sum this up and can see what impact this has on loans. I mean, I have to put here one disclaimer. We have this unaccredited detailed data on commercial loans only. Mortgage loans, we don't have it. We can approximate it, of course, because we have the overall balance sheet figures. So what we have here is probably a lower bound, but of course commercial loans make up, because a lot of real estate loans are also commercial. So in this case, we do have the data on unaccredited, but the residential mortgages we do not have in this consideration that I'm gonna present you. So this is just telling us that there is a considerable majority of loans that has a maturity longer than 10 years. As you can see in the right bar, this picture, this snapshot is right before the hike in interest rates in June 2022, and the majority of loans has actually quite small interest rate. There are many loans with interest rates below 2%. This now is a result of the asset side valuation, and you can see that before there is a NPV of the loans of banks which are about 6%, and this has then dropped due to these fixed rate loans. You can see if I look at the high interest rate exposure and low interest rate exposure banks, that the drop for those which have these high exposures, which have a larger fraction of fixed rate loans, this valuation has been considerably stronger, and it has been very drastic. There's a loss by having negative 13% here. You can see that this change in interest rate actually had a quite drastic impact here on the valuation. So we can use these numbers now and can see how does this impact the capital of banks. This is a tier 1 ratio, and the tier 1 ratio in the book value, how banks report it, and is a green distribution, and the orange distribution is the market value adjusted based on our valuation. And you can see there is a drastic impact. So in the two upper panels, here and here, you can see that actually the market valuation is better than the book valuation. So if you would do such a valuation, the banks would have more tier 1 capital, but this has shifted drastically. The dashed line is the minimum capital requirements of the tier 1 ratio, and you can see that the majority of banks, particularly on the high interest rate exposure, has shifted below, and that there's a considerable fraction of banks that has shifted to being totally insolvent. If you would have accounting standards that would force banks to do a market valuation, this would have been a disastrous outcome for banks. So we can see that maybe it's also good because we didn't have a crisis so far that we have the prevailing accounting rules. And everything you can see in this table is shown here. You can see below that 70% of the high interest rate exposure banks would be insolvent, and that 81% would be below the regulatory capital requirements. After my co-authors have shown me these numbers for the first time, I went back to my office, and there are these newspapers, and I picked up a newspaper, and I was really concerned about the German banking sector when I saw these graphs. And then I read at the headline that German banks are doing record profits. The profitability at the same time is enormously high for German banks. So something must happen, and I mean the magic is the deposit franchise value, so you don't have to show these losses, and we can do the same exercise with the deposits. You can see here for the deposits, before the hike, actually, they have a negative NPV. So given the negative interest rates, having these deposits are actually have been a liability for the bank. But then if you don't transmit the positive deposit rates, these deposits are very valuable then in the end, because banks can get the high rates for their new loans, and they pay to all depositors in the beginning really a very, very low rate only, and they can put their money as reserves and earn high rates. We can see that in the end, the banks are doing good besides this valuation, and I think it's the depositors who are paying for these poor investments banks have done in the low interest rate period. They don't reserve anything on their deposits, and particularly with the term deposits and sight deposits, you can see that it's actually billions of euros that they are not obtaining. So what we are doing is now that I'm moving to the second part of the paper, and here we are trying to see whether the setting of deposit rates is impacted by this interest rate exposure, whether this is really the factor that does not allow you to transmit the deposit rates, and that's why you're not doing it, or whether it is really the classical story of the franchise value, that you have sticky depositors that are just not reacting, and that are keeping their money as a very stable funding base in the banks. I mean, it's not very easy to empirically differentiate this, but we are doing two separate identification strategies. One is the classical difference in difference. I have already said that these banks are not perfectly comparable. So what we're trying to do is we look into more homogeneous groups. So we are looking in the group within the saving and cooperative banks, which are more homogeneous, and want to see whether those that have been more aggressively in the real estate sector, having higher interest rate exposures, whether those are the ones that are in relative terms are setting lower interest rates compared to others. The other thing we are doing is, in the second part, is a IV strategy, where we say, okay, during this negative interest rate period, those that had relatively more deposits than other banks are also those banks which were more forced to do something with this money and did more risky investments, and doing more risky investments is likely associated with taking up more interest rate risk. And here we are doing the following thing. We are to make sure that this is not just another variant of the deposit franchise value. We want to see whether these deposit rates are explained by whether these high deposits explain the rate only after the shock or also before the shock, and we see that they do actually only explain it before the shock. So having a lot of deposits before did not really impact the deposit rate setting. So that's something that came into play after. So this is the first empirical strategy, the differences. In differences, we do have deposit rates or deposit inflows or outflows in separate regressions as a left-hand side variable. And we're going to look at the coefficient of interest. These are bank level variables. We don't have deposits on the individual level, the coefficient of interest is beta. That measures the different reaction of banks that have high or low interest rate exposure. We use a continuous variable here when we use dummy for top 25 percentile and bottom 25 percentile. We of course lose a lot of observations, but results tend to be stronger. So the first result is here. These are still summary statistics. I'll skip them due to time. You can see already graphically that the interest rate, the deposit rates by the low interest rate banks, with the banks with low interest rate exposures, are considerably higher than the deposit rates after that are by those in the high interest rate exposure quartile. And we see this also in regressions. We can see that actually here, if we include bank controls and deposit type multiplied with bank fixed effects and time fixed effects, we can see that that those highly affected banks, those banks that had a lot of interest rate exposure, they transmit these deposit rates to a lower extent than those with lower interest rate exposure. And the magnitude is not so big. We have, if you compare a bank at the 25th and 27th percentile, it's about 30 basis points. But if you consider the amount of depositors, particularly that old people have, that have most of their savings there, it probably makes up for a lot of money, as I have shown in the previous graph. And we can do the same then for the commercial and regional banks. So for the commercial banks, it's not significant, but there are also quite few banks in this Zister sample by Bundesbank, but within the regional banks where we believe there is the highest variation in the interest rate exposure, we do observe that the magnitude is very similar, and it's likely not to be driven by comparing very large commercial banks to small banks who might set deposit rates for various other reasons and who have likely very different type of depositors. So we can see that these results are driven by sight deposits and term deposits. The saving deposits don't play a big role, and we can see when we look at deposit outflows, I mean, we know that the German banking sector has been stable, so we don't see, again, enormous magnitudes, but in relative terms, you can see that the high interest rate exposure banks who offer lower rates had also higher deposit outflows, and also, as you can see in this graph, they had less deposit inflows. So there is an impact on the deposits. And that's, I think, now when we move to profitability, this is where I think we can differentiate ourselves from the deposit franchise value, because the idea is if everything we have shown so far would be driven by the deposit franchise value, you shouldn't see differences in the profitability. And our argument is that this high interest rate exposure doesn't allow you to competitively attract new deposits and attract and set deposit rates at competitive levels, and that's why you become also less profitable. So you do see this here. You see that the banks with a high interest rate exposure have lower net interest margins than the banks with lower exposures, and this is actually significant for all groups. So this is something that at least shows that in relative terms, despite the German banking sector becoming more profitable after the interest rate hike, those with the highest interest rate exposure did become less profitable. So we have done the same with the IV regression, and the results are very similar, but what we can see is that this is more replicating the insights of Florian Haider, but it's also the paper you have on the U-shape monetary policy, that you can see that in the phase before the interest rate shock, if we take the deposit to asset ratio in 2014, that this does explain the interest rate exposure. So this heterogeneity we have is mostly driven by having a lot of deposits in the rate, in the period before the interest rates increase. So this ultra low interest rates are likely explaining why banks did take up these high interest rate exposures. And then if we use this as an instrument, these 2014 deposit to asset ratios, we obtain very similar results on the deposit rates that I have shown you in the differences regression. So let me summarize our findings and insights so far. So our results are not against the story of the deposit franchise value. As I said, despite having these enormous losses on assets due to this increase in interest rates, the banking sector remained stable, and banks did not transmit deposit rates, which is their main idea. So our paper is clearly not against this. We rather offer an alternative channel and explanation. What we believe is one aspect that I think has not been highlighted with the deposit franchise value: who is paying for this? And if you think about those depositors that have a high fraction of their assets in deposits, it's probably more older people and financially uneducated people who have small stock portfolios. So there is basically a wealth transfer going on from depositors to banks in such a situation, which I think we can put numbers with our exercise to this. When I think about competition, I mean, we did test for market power. We don't find anything in Germany, but I also think that within Germany there is not a lot of heterogeneity in the presence of banks. So we believe that the European bank integration could improve and foster competition, so that we have maybe other European banks coming in and offer better deposit rate. That would be definitely welfare enhancing for depositors. And we believe that there are limits to the deposit franchise value. So after a quite short period of time, interest rates had been again reduced, but if they would have been further increased, maybe due to geopolitical pressures, we could have also observed other situations where maybe depositors would have reacted at some point and not accepted the situation, which would have been a threat to instability. So we don't document here any instabilities, but we believe that there are also some natural limits to it, despite how it went and to our contribution to the current literature. We believe that it's not really market power so much or sticky depositors. It's really also these inability of banks to transmit the rates when they cannot, because they have done this extreme maturity transformation before the interest rate hike. Thank you very much.
Okay. Well, thanks, Rainer, for sticking to the time. Now the discussant for this paper is José Luis Pedro. Let me see if I can get the slides here. Okay, floor is yours, 10 minutes.
Okay, so thanks a lot for the invitation. It's a great pleasure to be here. Thanks, Rafa, for inviting me, and also thanks for the Bank of Spain to invite me. So Basically, this is a great paper. It's a very important question for policy. It's also for academia. They have excellent data, good identification, and very interesting results. There is work in progress. The last result on competition, it was not on the original version. Rainer, we were in a conference at the ECB yesterday, and he sent me over dinner the new version, so I couldn't read the new version. And maybe you have the competition there. But my main comment is going to be about the difference between credit risk and interest rate risk. So I'm going to say that the literature and the policy doesn't differentiate the two. And that's a comment interesting here in a policy institution. But also I'm going to argue that in the paper of Rainer and co-authors, they cannot separate these. And the problem is that for identification, that is going to be a big problem. Okay? So my recommendation is going to be to merge the two of them. Before I say this, let me just start briefly in one slide, the summary of the paper. So it's a paper on monetary policy rates, deposit rates, and financial stability. They use wonderful data from the Bundesbank and the ECB, both deposits and loans, and they use this kind of an expected shock of monetary rates over 2022, 2023. Of course, there an important issue, which I will not comment, is whether your differentiation across banks is only different because of monetary policy and not because of inflation or the Russian exposure. I will not comment on this, but this is something that you should check. Then the result is one key result, separated in two. Is in the period of low rates, going back to the negative period of rates in June 2014 and at the beginning of 2015 with QE, those banks, some banks took more risk, more duration risk, and those banks were the ones that had more ex-ante deposits. Now in 2022, those banks, they have riskier portfolio in duration risk based on the paper. Then the interest rates went from minus 0.5 to more than 4. And so in that sense, what these banks do with the deposit rates. Could you use like a natural hedge? So they are going to lose on the asset side. They are going to recover profits on the liability because they have these dormant depositors, which are fine to have a low rate, okay, like a natural hedge. This is the paper. As I said, my main comment is going to be on interest rate risk and credit risk. Before I go to the details of the paper, let me just say in general. In general, these two risks, they are separated. One is in Pillar 1 for policy, Pillar 1, the other is in Pillar 2. In academic studies, they are also separated. Now, the issue is that credit risk depends on several factors, but one of the factors is on higher monetary policy rates, and it matters, There was a very nice paper, and Rafa and I talked about this, by Martin Helbig in 1993, saying this is a problem, you should merge the two, and he did that, but in a theoretical paper. This was in the 1990s, and he would refer to these problems in the 1980s. But even after that, the US subprime borrowers in the United States, in the 2000 boom, they took variable rates. For that, there wouldn't be any interest rate risk whatsoever because they were flexible rates. But when interest rates, the Fed changed the interest rates from 1% to 5.25%, those borrowers fell. Not only the subprime borrowers, but other borrowers. So in a sense, when you analyze the risk associated to higher monetary policy rates, you should analyze all the risks that are affected, and in particular credit risk and interest rate risk. So my main comment will be that it will be better to do an analysis of both risk. This was in the 1990s, 1980s, the 2000s. One could argue about accounting. Before I tell you about accounting, we discussed in finance, this is a very finance issue, whether banks hedge value, stock value, or they hedge cash flows. In finance, we like cash flows. But maybe banks, they hedge profits. And if you hedge profits, there is one part on provisions. Lately, in the past, with the stage 1 provisions, this came too late. Nowadays, you have stage 1 and stage 2, IFRS 9, or a different one in the United States. if those provisions were perfectly reflecting credit risk, then if banks hedge profits, not cash flows and book value, then credit risk would be there. But we know also part of Rainer research that even if you are in internal rates-based, you apply an IRB model, you tend to manipulate, so you don't, you don't adjust to the credit risk. You might manipulate on that. You, Rafa, in my, you are a bit fast, eh? You are a bit fast, eh? You are a bit fast by more than 1 minute, Rafa. So not so good. But moreover, some of the banks use the standardized approach. And in the standardized approach, you don't even change that. And I've been a board member here in Spain for a bank, which we use a standardized approach. We follow the tables by the Bank of Spain, and they don't change often. And in particular, they don't change often related to interest rates. So you cite this paper as a paper with Gabriel, with Bank of Spain data as well. In this paper, we talk about monetary policy and financial stability. We address both credit risk and interest rate risk. It's a paper which is forthcoming in the Journal of Finance, and it's mostly country-level data, so it complements perfectly because this is bank-level data. And we find a kind of a U-shaped monetary policy path increases banking credit risk, and we analyze this with many cycles across history, 150 years, etc. Let me in one slide summarize this result, which is that when you raise monetary policy rates, you increase basically a banking crisis risk, but only if before you have rates for low for long. Why? And this is unique to banking crisis. It doesn't happen in non-financial recession, even in the worst ones. And this is over and above the rates are too low, are below the systematic component of monetary policy. What is the mechanism, which is consistent in part with the paper by Rainer? In the boom, when you lower monetary policy rates for long, then you create a credit boom, an asset price boom. And this is driven by banks, by credit supply. It's not so much about the demand side. The second part is when you raise the monetary policy rates after this period, you are going to create problems on credit and asset prices. And the problems of the banks are not going to be the pure interest rate risk. It's going to be more the credit risk in the data. And then we have one part with Bank of Spain data on credit defaults and credit supply. Since I know that Rafa, and still I have 2 minutes on my watch, but I know that Rafa is above time. So this goes back to the paper. In the paper, they don't differentiate duration risk and borrower risk. The problem is that you cannot do that. Why? Because those German banks that they took high risk in the 2014-2021 risk, they took identically two risks, the duration risk and the borrower risk. And the Heider paper is on that. Now, if you take both of those risks, the only way to do your IB is to separate one versus the other. But that's going to be very difficult. So my advice to you would be treat both of them. Would be very interesting because the literature treats them differently. And moreover, I think you cannot treat them separately. The last thing I want to say in my last 50 seconds, 1 minute, thank you, is about bank competition. So that was not in the original version. I don't know whether it was in the version that you sent me overnight in the dinner. But we were talking about, like your father being in a village, couldn't go to Deutsche Bank to get a higher interest rate. So you could exploit even that. I don't know whether you have exploited that. Because Germany, I don't know whether you know well, Germany, it has lots of banks, but it's extremely fractured because of the Landesbanks, AB banks, and things like that. So some people cannot afford those higher rates. In those ones, the natural hedge of the deposit franchise is going to be higher. Then you can take more risk on the asset side. So that's something that it would be nice to check. The last thing, and you should not do this because it's complicated, but once you start talking about natural hedge, a question, since you have the data, is the derivatives. So you have all these derivatives on the swaps, on interest rates, and a key question to me is the balance sheet natural hedge. You have the hedging through derivatives. Are they independent? Do they complement? Do they substitute? That will be another layer. Thank you.
Okay, thanks, José Luis, for sticking to the time. Let me give you 1 minute to respond, and then I will open the floor for questions.
So thank you very much, José, for these great suggestions and insightful discussion. I'll just comment on 2 suggestions. I mean, the first one is a very important one, and I mean, I want to hear more why you think it's so difficult to separate. I mean, I know we haven't done it in this paper, but we do have floating rate loans, and we can see exactly what you've said, that if you take the universe of commercial real estate borrowers and you compare the fixed rate loan, those that have a fixed rate exposure and a floating rate exposure, you can see that the probability of default significantly increases for those with floating rates. So we can see this effect, and in the evaluation we do, you can separate this. We haven't done it. It's work in progress. So you're totally right with this. But at least we are trying to address this and see whether how this impacts the market valuation differently from the duration. Through the impact to duration. And the second is on bank competition. In Germany, officially you have thousands of banks, and in fact the Saving Bank Association nationally provides a recommended rate to their banks, or recommended spreads, and this is the same for the cooperative bank organization. So in fact you really have very few banks, and the very large German banks have mostly exited the bidding for deposits because of the low interest rate period before. So it's another thing you can see, consequence of another adverse effect of this time. So I think in fact actually the competition is coming from other European banks, but they are usually then only direct banks and not really present with subsidiaries, and that makes a difference, and this creates a problem that I think we don't have sufficient competition in Europe, and that's why in the US this transmission has been better than in Europe, and that's why in Germany there are enormous rents that banks could earn during the last years, and I'm quite surprised, and this is more now a political opinion, that the financial press has not picked this up, but has mostly written that it's great that banks are doing so well now.
Yes, so very briefly, since you said that you can separate it. So first of all, my point was it would be more interesting to merge the two, like Martin Helbig in the 1990s. Second, you cannot do it. Why you cannot do it? Because the same banks are taking duration risk and credit risk. They are the same banks. When you take the two risks, are either completely independent, which will be weird, or they are complementary or substitute. If they are complementary substitute, the IB doesn't work. Meaning, like, if I want to take more risk, and I take more risk on borrower risk, it will be very weird that independently I take more risk with that borrower either I compensate with risk management and I reduce the maturity, or I gamble and I take double risk and I increase the maturity with the fixed rate.
Okay, well, let's open the floor, Javier and Tomás, and then we'll, okay. Is there a microphone? Okay, you have to speak up.
Have the capacity to pay low rates on deposits, but somehow they only pay low rates on deposits after the interest rate hike if they have previously assumed too much risk. So it's like, I have market power, but I only use it when I'm desperate. Somehow it doesn't fit. So my economics of this is there are two classes of depositors. Some of them will not care too much about interest rates or will simply have no options away from your bank. And the others will react. And your highly exposed banks are somehow not able or not interested in competing for the second class of depositors. And they're happy enough exploiting the market power on the deposit base. But then you said something like the depositors are paying for sort of this excess risk-taking of the banks in the first place. But actually, my reading of your evidence is that these banks with high deposit base, they knew they could undertake higher duration risk on the asset side, precisely because of having this very stable deposit base. So everything that happens is sort of coherent with this business model. I have a portfolio of longer maturity loans that will make me suffer losses when the rates go up, but I have these depositors that will not react and are providing me a hedge. And connected to José Luis' connection to credit risk, I think this is a little bit too pessimistic view of what banks are doing for society, because the offering of long-term loans at the asset side is protecting the borrowers against interest rate hikes, and then probably is protecting the banking system against a hike in defaults when interest rates go up. So I agree market power for depositors, for deposits is in the background and could be bad for depositors, but I'm not sure that there is an overall so negative and pessimistic view about the maturity transformation role of banks. Thank you very much.
Take a second question here, and then we will move to the next paper. Thomas.
Thank you, Thomas Philippon. Actually, it's a related question, maybe a little bit simpler. I don't understand, so I understand everything in the paper, except there is one claim I don't understand or disagree with, is you said that the depositors in the high rates suffer the consequences or stuff like that, but it's a bit like ratings. You have to do it through the cycle. So you have to integrate from the low to the high rate period and then ask, are they fairly compensated? Because the banks were losing money on deposits before, okay? So that means if you integrate over 10 years, the only question is, does that integrate to zero or slightly plus or slightly minus? But you cannot say that just because the rates are not keeping up with the Fed fund rate or the target rate of the ECB in the high rate period, the people are worse off. It's a bit like saying, we have implicit labor market contract. So the fact that I don't fire you in bad times and maybe I pay you a bit less in good times, I mean, we think it's a good thing. So this is just an insurance contract. And you have to think about whether over the cycle, people are better off or worse off. And that's very much linked to competition, by the way, because then competition would improve the outcome if and only if the new entrants are more efficient. It's not so much about whether they're going to follow the cycle, it's can they, on average, pay her, which is if and only if their operational costs are lower. Okay. So I think it's important to make that distinction.
You have 1 minute, and then we'll move on.
Tough and very important questions. And so what we are not saying that there are not sticky depositors and that this impacted potentially in the low interest rate period, their risk taking and their maturity transformation. But what we are saying is that those banks that did it a lot, they are less profitable now in relative terms. They do see deposit outflows, and we do see that they have less deposit inflows. So we are seeing that actually those banks that did take a lot of interest rate risk, that they do have negative consequences at the moment. If this deposit channel would work perfectly, and the main motivation was that the net of the Drexler paper was that the net interest margin is constant. We see that it's absolutely not constant around the shock, and that these, in our case, affected banks are those who are suffering profitability and net interest margin. So this way, I think it is, and those banks are constrained. So the other banks that did not take these risks are the ones that are taking up now they are offering much more new loans, and they can take advantage of now giving new loans and earn the much higher margins. And I mean, I agree with what you said, and I probably maybe should have phrased it a little bit differently, but I mean, you have to see before they lost 50 basis points on deposits, and now they gain 400 basis points on deposits right after the shock. I'm trying to say that this is a bit asymmetric, I think, but you're right, we should present this in a more balanced way. Yeah.
Okay, thanks. We're moving now from Germany to the US, and Paolo, the floor is yours.
Okay. Thanks so much for including my paper in this conference. It's a pleasure to be here. So the paper is going to focus on the role of banks' maturity choices in affecting the transmission of interest rate risk. The starting point is that maturity mismatch is a defining feature of banking, with banks borrowing short-term generally in the form of deposits and lending long-term by issuing loans or purchasing long-term securities. And this process of maturity transformation earns a premium to banks but also creates exposure to interest rates. So when interest rate goes up, the value of bank asset falls and equity capital gets depleted. And at least in the US, the recent tightening episode revealed a significant degree of exposure in the US banking sector. And the common narrative behind this exposure is that the buildup of interest rate risk was partly reflecting a shift towards long maturity assets that characterized the US banking systems in the latest years. Yet, how banks manage the maturity on their asset side is relatively understudied. So in this paper, I'm going to first ask what are the determinants of banks' maturity choices, and then I'm going to ask whether these choices across maturities are important to understand the transmission of interest rate shocks. First, I'm going to approach this question empirically. I'm going to document some patterns related to banks' maturity choices, combining US regulatory data with the off-the-shelf monetary policy shocks. The first question I ask is whether banks adjust their maturity profile in response to interest rate shocks. And I find that they do, and in particular, after a rate increase, banks tend to reduce the maturity of their balance sheets. I then ask whether these responses are heterogeneous across banks. Again, the answer is yes, and in particular, I find that banks with high deposit-to-asset ratios are those that tend to shorten the maturity of their portfolio relatively more following a rise in the interest rate. And finally, I ask whether more generally, there is an association between the maturity and leverage decision of the banks. And here I find that high deposit-to-asset ratios are associated to shorter maturity portfolios. So there seems to be some substitution between leverage and interest rate exposure through maturity. I then build an heterogeneous bank framework to think about how banks choose endogenously leverage and maturity. In the model, banks are going to be able to invest in short and long maturity assets subject to financial frictions. And I'm going to push the idea that the risk premium created by these frictions is an important driver of banks' portfolio choices across maturities. The idea is that when the interest rate goes up, bank net worth falls. This drives up risk premia and make safe short-term assets relatively more attractive to banks. I use the model, I exploit the cross-sectional findings from the empirical section to validate the quantitative model, and I then provide an application to the recent tightening episodes. In particular, the two key findings is that the model replicates the increase in the maturity of bank assets prior to 2022, and it shows that this increase in maturity amplified the effect of the initial tightening. But the effects of subsequent hikes are mitigated as banks readjust their maturity, the maturity of their portfolios by shortening the maturity towards safer assets. So in terms of the empirical part, I'm going to rely mostly on call reports data, which provide information about US commercial banks and bank holding companies. And in particular, it provides information on the maturity of assets and liabilities starting from 1997. This allows me to construct the maturity gap as the difference between the average maturity of assets and the average maturity of liabilities. And it has been shown that this maturity gap is a good measure of interest rate risk exposure for banks. I combine this information with bank holding companies' quarterly filings and off-the-shelf monetary policy shocks. The first question I ask is, how do banks adjust maturity in response to monetary policy shocks? I consider this empirical specification focusing on a sample before 2007. So I regress the change in the maturity gap at different horizons age on the change in the one-year treasury rate, delta RT, instrumented with the monetary policy shock, including time-varying bank-level controls, as well as lagged aggregate controls and bank fixed effects. So the coefficients of interest is beta H, which here I plot at different horizons. So the coefficient is negative. This means that when the interest rate goes up unexpectedly, the maturity gap of banks on average falls. This suggests that there is a shift of portfolios towards shorter maturity assets. Then I ask whether these responses are heterogeneous across banks. So again, I regress the change in the maturity gap, in this case on an interaction term between the change in the treasury rate and the deposit to asset ratio of a particular bank, demeaned as it is done in the literature. Here I can also include time fixed effects because I'm interested in the heterogeneous impact of the shock. And this is again the coefficient at different horizons. This is negative. So this means that banks with higher deposit to asset ratios tend to reduce the maturity gap relatively more. So all the banks on average reduce maturity. Banks with high leverage tend to do it particularly so. And finally, I ask what is the relationship between maturity and leverage decision. So here it's a simple bin scatter plot of the maturity gap against deposit leverage. Importantly, this bin scatter plot controls for bank level controls, and it also accounts for time and banks fixed effects. And there is a strong negative relationship, meaning that banks with higher deposit to asset ratios tend to actually have lower maturity gaps. The inclusion of fixed effects here is particularly important because it residualizes on permanent characteristics of the banks, such as permanent differences in market power. In fact, if you remove fixed effects, this plot would go in the opposite direction. In the second part of the paper, I build a quantitative model that is consistent with these key findings. Just to repeat again, the idea that when interest rates go up, maturity goes down, particularly so for banks with high deposit to asset ratios, and the negative association between deposit leverage and maturity. So the key agents in the model are banks that are heterogeneous. They maximize discounted sum of dividends. And importantly, they are able to invest in both short and long maturity assets subject to financial frictions. Households in this framework are risk neutral with a time-varying discount rate. The risk-free rate in this economy is simply the inverse of the discount rate, and I'm going to interpret this shock Z to the discount factor of the household as the interest rate shock in the model. And I'm going to try to understand how banks respond to this shock. I'm not going to go in the details of the model, but I think it's useful to lay down the bank's problem. So banks have access to assets of different maturities, short-term risk-free bonds that usually mature after one period, and long-term risky securities that mature at a rate delta. These long-term assets are equity-type claims to some underlying physical capital issued by non-financial firms, as in the work of Gertler Kiyotaki and H. Krishnamurti. This implies that the price of this long-term asset is the same as the price of the underlying capital stock, which I denote as Q. The return on this long-term asset is subject to both idiosyncratic and aggregate risk coming from these shocks to the risk-free rate. The key friction is that banks are not able to issue equity. So the dividends are required to be non-negative. And this implies that banks will finance investment using defaultable debt on top of own net worth. So the payoff from investing in a portfolio of short and long-term assets is given by this expression. The short-term asset yields a sure payoff of 1, while the long-term asset yields a risky payoff. Here, omega is an IID shocks that generate heterogeneity across banks, and it is the source of idiosyncratic risk. Interest rate risk exposure in this framework arises through the asset price Q. And the idea is that when the interest rate goes up, the supply of funds in the economy goes down. This depresses the demand for capital and drives down the asset price. So as long as banks are investing in this long-term asset, they are exposed to changes in interest rate through fluctuations in the asset price Q. And in this framework, exposure to interest rate risk depends both on leverage, how much deposits banks issue, and on the maturity of their portfolio. Here is the timing of the model. So at the beginning of a period, the idiosyncratic shock omega is realized, as well as the aggregate shock to the risk-free rate. Each bank enters the period with some net worth and some long-term asset, then with probability sigma receives an exit shock, in which case it either repays and exit or default and exit. With 1 minus sigma probability, there is no exogenous exit shock, so the bank can either default and exit, in which case it gets 0, or continue. If it continues, then it chooses the balance sheet structure for the next period. So it chooses how much short-term and long-term asset to hold and how much deposits B to issue. So here I just want to give you a brief intuition for the main mechanism of the model. So for a bank that holds both assets, it must be that the expected excess return from the long-term asset must compensate the bank for the risk premium associated to that asset. Here, M captures the degree of financial frictions faced by a particular bank I. So if for unconstrained banks, the risk premium would be equal to 0, then the choice is only driven by the expected excess returns. So let's think about an unexpected rise in the interest rate. This has two effects. The first one is that now banks are going to expect capital gains going forward. So this increase in the interest rate depresses the asset price, but the expected price going forward is now higher. The asset is expected to gain value over time. This tends to increase the expected excess return and making the long-term asset relatively more attractive. But there is also an opposite effect. Banks today, they experience capital losses because the price Q is low. So this depletes bank net worth. For banks that are financially constrained, this drives up the risk premium and makes long-term asset relatively less attractive. So if this risk premium channel is sufficiently strong in response to an interest rate rise, banks are gonna reduce their maturity. And the key observation here is that this risk premium component should be more relevant for financially constrained banks, which in the models are banks with high leverage or high deposit to asset ratios. So because they face higher risk premia, banks with high deposit leverage in the model choose portfolios with shorter maturities, so safer portfolios, and following a rise in the interest rate, they rebalance more strongly towards the short-term asset, which is consistent with the empirical findings from the data part of the paper. So I calibrate the model at the annual frequency between 1997 and 2021. I fix some parameters. Then I estimate the interest rate process from the data, fitting the process for the 10-year real interest rate in the model and in the data. And finally, I calibrate the remaining parameters to match some bank balance sheet moments. In particular, I match the average maturity gap and the cross-sectional dispersion of this maturity gap across banks, capturing the idea that in the data, I see a significant amount of dispersion in interest rate risk exposure if I look at this measure of the maturity gap. Once I calibrate the model, then I can simulate a panel of banks from the model, and I can try to see if it can replicate the empirical findings from the previous section. So here I am running a close regression to the one I showed you before. I'm regressing the change in the maturity gap on the interaction term between leverage L of a bank and the change in the risk-free rate in the model, including leverage as a control together with time fixed effects. So in the model, there is no permanent heterogeneity, so it doesn't matter if I include bank fixed effects as well. This regression corresponds to the first column of this table, which compares this estimated coefficient in the model and in the data. Here I also want to specify that I'm doing some normalizations to make the model and the data comparable. That's why the data coefficient here is different from the one from the impulse response functions. The second column includes also an interaction between bank size and the monetary policy shock. And the last column estimates also the average effect, which is in blue. So the average effect is negative in both the data and the model. So when the interest rate goes up, maturity tends to fall. The coefficient is much smaller in the model than in the data, which is a drawback of this calibration. The coefficients on the interaction term is also negative. So banks with high deposit to asset ratio, because of this higher risk premia, tend to respond more strongly to the shock. And I do the same for the last fact about the relationship between maturity and leverage. So here I'm running a simple regression of the maturity gap of a bank on its leverage size, so log of total assets, again including time fixed effects. And here are the results. The coefficient is negative both in the model and in the data. So banks with higher deposit to asset ratios tend to be associated to shorter maturity portfolios. So in terms of aggregate implications, I just want to go through some key features of the model. So here I am plotting the impulse response function implied by the model following a 1 standard deviation increase in the risk-free rate. So let me first focus on the balance sheet structure of the bank. So here we see that following the increase in the interest rate, banks tend to reduce the riskiness of their balance sheets in two ways: by reducing leverage, so by reducing the deposit to asset ratios, and also by reducing the maturity of their portfolios, by reducing their maturity gap. This despite the fact that the expected excess return associated to the long-term asset tend to go up in equilibrium. In terms of other macro and financial variables, the model predicts a sharp contraction in bank equity values, a fall in the price of the long-term assets, as well as some response in terms of output drop and a strong decline in investment. The question that I now ask is how important is bank portfolio reallocation across maturities for macro dynamics? So to answer this question, I solved two alternative models. One, where banks have no access to short-term assets, so they can only invest in the long-term assets. They can still choose the size of their balance sheet as well as leverage. The second is an alternative model where banks invest a fixed proportions of their assets into the long-term and the short-term asset. Again, they are left free to choose leverage as they please. I solve this model, then I go to the data, I recover the sequence of shocks such that the model implied 10-year interest rate matches exactly the empirical counterpart. This is my sequence of interest rate shocks. I then feed them into each model variant, and I compare how the models behave, focusing in particular on the recent tightening episode. And the results are reported in this table. So the upper part compares unconditional moments in the model with endogenous maturity with the counterfactuals. So unconditionally, the asset price is less volatile in the counterfactual models relative to the baseline, while the volatility of bank equity is very close. But the picture looks very different once we look at conditionally to the tightening episode of 2022. So first of all, the baseline model predicts that between 2018 and 2021, banks increase their maturity gap by 2 percentage points. And the model rationalizes this increase in the maturity gap because interest rates in the pandemic and post-pandemic period were surprisingly low. So with low interest rates, banks in the model tend to increase their maturity gap, which is consistent also with what was observed in the data. Once the tightening happens, and here I invite you to look at the last column of the table, if banks are prevented from increasing the maturity of their assets, the decline in asset prices and bank equity values is lower. Here, banks do not increase investment in long-term securities, in long-term assets, and this mitigates in the counterfactual the effect of the initial tightening. But the effect of the subsequent tightening between 2022 and 2023 is actually amplified. In fact, the effect under the fixed portfolio share model is significantly larger than under the baseline. The reason is that in the model with flexible maturity, once the initial tightening happens, banks readjust their portfolios towards shorter maturity asset, and they insulate their balance sheets against further rate increases. If we take out short-term bonds in the model, there is no way banks can self-insure against this type of risk. And as a result, in the second column of the table, you can see that without short-term bonds, all the effects of the tightening are significantly amplified. So let me now just conclude. So in this paper, I document that banks respond to interest rate hikes by shortening the maturity of their asset. The response is more pronounced for banks with high deposit leverage. I develop a macrofinance model which endogenizes both leverage and maturity choices. The model matches the empirical patterns and highlights the role of risk premium in shaping these maturity choices, which are important to understand the transmission of interest rate risk and the effect of monetary policy tightening. And in the paper, I also discuss some implications of these frameworks in terms of banking policies, so both liquidity and leverage regulation. Thank you very much.
Okay, well, thanks, Paolo. Now let's move to the discussion of this paper, who is Rustan Jamilov from Oxford. So the floor is yours.
Okay. Thank you very much to the organizers for asking me to discuss this very nice paper. So what this paper does is it introduces endogenous exposure to interest rate risk into the canonical Gertler-Kiyotaki-Karade class of models, which has been very influential both in academia and also in policy. The long-term asset is exposed to interest rate fluctuations while the safe asset is not. Banks have a choice to expose themselves to the risky asset versus the short-term asset. It provides a self-insurance mechanism that is absent in the standard model, and on average that strengthens financial stability because the banks have an additional margin of adjustment to withstand aggregate shocks. The short-term asset, it's a hedge against sudden policy rate hikes, and in the standard models, the only choice that the banks have is to adjust their leverage ratio, but within portfolio composition is the same. And I think this is precisely the correct margin for the analysis of the recent inflationary and hike and subsequent banking crisis episode. So I think it's going to be a very important paper from the policy perspective, and it's a much awaited addition to this literature, which has so far lacked a proper modeling of endogenous interest rate exposure. So a bit of an overview in order for us to see Paulo's contribution in the bigger picture. So this is the standard macro banking model. It's a standard representative bank macro banking model of Gettler, Karadik, Kiyotaki. You have an infinitely living financial intermediary. It borrows via one-term deposits from the household. The deposits could be insured, could be not. It invests into the risky asset. In the standard model, the asset is just the neoclassical capital. It could accumulate, or it doesn't have to. The bank usually has an incentive to leverage to infinity, so we limit the leverage multiple either through a hard constraint, which is in the original papers, or you could do it through exit choice that is priced into deposit rates, as in Paulo's case. So the financial accelerator logic is clear and obvious here, because changes in asset prices can hit banks through tightening of collateral constraints in crisis, for example. The appeal of this modeling device is the linearity and aggregation. That's why this framework has been so influential. But the drawback is that the distribution of banks typically does not matter, because everything aggregates explicitly. We don't really have any cross-sectional heterogeneity. And another drawback, for tractability, there is only one asset, aggregate capital. So over the years, people have introduced heterogeneity into this framework. The simplest way to do is through the ex post way of the Bewley-Huggett-Ayagari approach of introducing ex post heterogeneity into the decision problem. So here we have this Xi object, which is uninsured idiosyncratic bank return risk. It generates a distribution of banks, because banks now are identical, exposed, they're different because they draw bank-specific returns on the same portfolio. It could be autoregressive, it could be IID, so there are different ways of doing it. Now, in this situation, the distribution of banks is an endogenous state variable, and it's usually dynamic if you have aggregate uncertainty. So you have to forecast this distribution. You have the Crosell and Smith logic, and sort of people have done it, and I have a paper on that also in the past. So now within this environment, you still have only one asset. So you don't have the maturity, the proper modeling of the maturity choice. So this is where Paulo comes in, and he says, well, it's a severe limitation of the standard models. Let's introduce short-term government bond, AS. It's a safe asset. So now on top of the standard dynamic banking problem, which is already not easy, now you need to solve an additional portfolio problem. So banks choose the optimal leverage ratio, and on top of that, they choose the composition of the balance sheet, the share of long-term versus short-term assets. So the maturity gap becomes endogenous, and it responds to discount factor shocks, which could either amplify or dampen the monetary transmission mechanism, and it has first-order effects on financial stability. So I have a few comments, mostly to improve the paper, but otherwise I think it's already an important contribution. So the first comment is immediately came to me when I was reading it, the households are risk neutral. If banks are risk neutral, I think it's totally fine. But if households are risk neutral, the assumption is very strong. Having at least log utility would go a long way of fixing it. The issue is that the risk-free rate will not react to any aggregate shock except the discount factor shock. So Paul is very smart, he understands that. But that can potentially limit the analysis, especially with background aggregate risk. There is no margin for the household to smooth consumption because there is no precautionary savings motive if the household is neutral. So for instance, if you want to do TFP, cost push shocks, which would be nice to do in this environment, to simulate the inflation surge, for example, you cannot do that credibly because the interest rate will not react. It will only react to the discount factor shock, which it's designed to do for exogenous reasons. And it could have first, you could say, well, it's a numerical or a quantitative issue, but actually it could have first order effects on the macro transmission. And so I have this picture from the same paper before. So here, just for example, you can see impulse responses to a TFP shock with log utility or with risk neutral households. If you compare the red lines and the yellow lines, you have qualitatively different effects on the return on capital and vastly different effects on how banks respond and how output responds to the same TFP shock if you have a risk neutrality and if you have risk aversion. So that's something to think about. So the second comment is on the empirical test in the paper. This is the main empirical regression. So you have the maturity gap as the dependent variable. So you have the monetary policy shock as the main independent variable, and you also have characteristics to look at the heterogeneous treatment effects. So I think this is a fine exercise. It's useful both empirically and to discipline the model. But I think the perfect exercise is actually the second equation which I wrote. So here, the outcome variable is something that is important for sort of welfare. It could be bank level lending. It could be market values if you manage to do high frequency, or deposit growth. So some quantities, changes in quantities on the left-hand side, and then on the right-hand side, you interact the interest rate shock with the lagged maturity gap. So because one of the conclusions in the paper that the maturity gap amplifies financial, it's a source of financial amplification, or it's dampening on average for financial stability. So the right way to think about it, or a complementary way to the way you already think about it, is to look at the heterogeneous effects of monetary policy on investment, on lending, where the characteristic of heterogeneity is the maturity gap. And I think it complements the existing literature very well, because this particular regression, I don't think it has been run in recent years. So it would be great to see something like this. So this is from O'Tonnell and Winbury, where the dependent variable is firm investment. And so this is for non-financial firms. And on the right-hand side, you have the interaction of the monetary policy shock and lagged firm leverage. Or you can do something like this for banks, when you have bank lending on the left-hand side, and then on the right-hand side, you have the interaction between the monetary policy shock and a lagged bank default risk or bank assets. Again, to look at the heterogeneous effects of monetary policy, where the maturity gap is the characteristic. Finally, I have a few minor comments, and then I conclude. So these are more just to clarify things. So there was this unclarity for me with regards to how you deal with deposit insurance. So there was this word that triggered me a bit, the bailout, because we all know that the bailout is an additional externality, and it wasn't clear whether banks internalize it. I think what you actually mean is just deposit insurance. Then I think that's fine. Labor supply could be endogenized, and it would be nice to see that the distribution of banks actually in terms of histograms or densities, how close they are to the data. And finally, because you use bounded rationality methods, numerical solution accuracy is important, so it would be nice to look at some enhanced statistics or accuracy statistics in the paper. So to conclude, I think the standard models with bank heterogeneity abstract from endogenous interest rate risk exposure, not because we think it's not important, because it's very hard to do. And Paulo provides an important contribution to this literature, with some minor refinements, I think this will be an influential paper both for us academics and for policy as well.
Okay, thank you, Rustam. 1 minute response, and then I'll open the floor.
Thanks so much for the discussion, Rustam. So for the risk neutrality, I agree it's like a strong assumption that I not necessarily like. The issue here is that it would require to have consumption as an additional aggregate state variable. So it makes the computation of the model harder, but it is for sure the first dimension I would try to improve the model to have some degree of risk aversion. So about then the regression, I completely agree. I started looking a little bit in the effects on market values, equity prices for banks, and you indeed see that banks with higher maturity gaps tend to respond more, which is consistent also with the other papers in the literature like English and co-author and so on. But I think it would be a very useful empirical moment to have in the model to try to match and discipline some other parameters. Already. And yeah, yes, deposit insurance is just deposit insurance. And I would definitely need to plot the densities. It's just that since I don't have permanent differences in banks, that may make the comparison of raw distributions a bit more complicated and cumbersome.
Okay. Well, time for one question from the audience, if there is any such question. Okay, well, let's thank the speakers and discussants, and we move to the next session, which is on bank heterogeneity and monetary policy transmission.
Voy a abrirlas todas.
Villacorta y San Cibrián.
Villacorta. ¿Están las cuatro, verdad, Rafa? Sí, están las cuatro. Ha llegado alguna nueva, pero luego la cargo, ¿vale? En la pasada.
Vale, ok, están ahí. Te dejo. Esto es para por si quieren utilizarlo. ¿Cómo vas a hacerlo? No, eso lo tienen que hacer ellos, supongo, ¿no? El primer paper es el de...
So welcome to the second session on bank heterogeneity and monetary policy transmission. We're going to have two papers giving different perspectives on bank heterogeneity. And the first one is by Joël Marbat and co-authors. 25 minutes.
Thank you very much, Luis. I just make the pointer. So this is titled The Heterogeneous Bank Lending Channel of Monetary Policies, joint work with Jorge Abad, Salomon Garcia Villegas, and Carlo Nuno, who are working here with me at the Bank of Spain, and Saki Bichio from UCLA. So there's a very large literature on the transmission, There's a very large literature on the transmission of monetary policy and how it transmits to lending, and in particular how this depends on bank level characteristics. Now, this literature has been mainly empirical and has shown, among other things, that it depends on how much liquid assets these banks hold, on the size of these banks, whether they are very leveraged or not, on their interest rate risk exposure, or also on the loan rate fixation, so whether they issue variable rate or fixed rate loans, which is very close to what we have seen just now. Now, what this empirical literature has in common is that because of the identifying assumptions that you have to make, typically you can only identify like a differential impact, that you can estimate how much more banks with high leverage respond relative to how much banks with low leverage respond, for example. And here is where structural models can kind of complement this empirical work by allowing to recover the effect of heterogeneity on aggregate responses, and also by allowing to implement counterfactual exercises. Our contribution is then as follows. So we develop, or first of all, we document several statistics about euro area banks and how they are heterogeneous in their capital ratios, and also in loan rate fixation, so whether they issue variable rate or fixed rate loans. And then we take this evidence as kind of a guideline for developing a heterogeneous bank model with ex-post heterogeneity in capital ratios, as we find it in the data, and also that takes into account that there's this ex-ante heterogeneity in loan rate fixation. To give you a sneak peek of the results, we show that our model can replicate long-run distributional features of euro area banks. So on the one hand, it's consistent with these capital ratios that I mentioned before, but it's also consistent with the distribution of assets, or the size distribution of banks. And then what we show is that the aggregate and the individual impulse response functions to monetary policy shocks indeed do depend on these bank level characteristics in the model, and in particular that there's a stronger, banks that issue fixed rate loans, they respond more strongly to monetary policy shocks than banks that issue variable rate loans. And also banks that have lower capital ratios, so banks that are more leveraged, they respond more strongly to monetary policy shocks in terms of the credit that they grant to households and firms. Now, to tie this to the theme of this conference, which is on financial stability, I will also briefly discuss some implications this model has for financial stability later on in this presentation. Okay. So the first stylized fact that I would like to show you is related to the heterogeneity in bank leverage. I'm showing you here the CET1 capital ratios across European banks. And you can see that there's a substantial dispersion in these capital ratios. So some banks are very close to the minimum capital requirement of 4.5%, while other banks have capital buffers that exceed 25% and are even high, or even higher than that. Now, part of this is due to differences in the buffers that they are required to have, but even if you take this into account, there's still a large dispersion in these capital ratios, or in the buffers that the banks hold. Now, the second stylized fact is related to the loan rate fixation. And what I'm showing you here is the share of variable rate loans that are issued by banks for households in the left panel, and the same for non-financial corporations in the right panel. And you see that there's a substantial difference across countries. Some countries like France, Germany, Belgium, or the Netherlands, they have almost no variable rate loans in their portfolio. They mainly issue fixed rate loans. while other countries like Finland or Spain or Portugal, they have substantial shares of variable rate loans in their portfolio. And this does not change very much between households or non-financial corporations. And these patterns are also persistent over time. So this is not just in one particular moment that there's this large heterogeneity in loan rate fixation. Okay, so we have this large heterogeneity in leverage and this heterogeneity in loan rate fixation. And with these things in mind, we now turn to the model setup. And because the banking sector is at the heart of this model, and this will allow you to understand kind of the main mechanisms that of how monetary transmission works in this model, I will mainly focus on that part. So in this model, we have a continuum of perfectly competitive banks. These banks hold assets on the both short and long-term assets. On the short-term side, we have reserves that are simply remunerated by the policy rate. On the long-term side, they can issue risky loans to entrepreneurs in the model. And these loans are either issued with a fixed rate or with a variable rate. And then stochastically mature. So the duration of the loan is determined by how long an entrepreneur needs this for operating its entrepreneurial project. And afterwards, it will, every period there's a certain probability that this project will end. And this is also when the loan will be repaid and it will kind of vanish from the balance sheet of the bank. Now, issuing new loans incurs an origination cost, and I will briefly discuss this later on. And this is simply to kind of get some persistence in leverage in this setup. Then on the liability side, we have that these banks are funded through short-term deposits and equity. And what is important to note here is that equity has to be accumulated over time through retained earnings, so there's no equity issuance in this model. Then it captures, we try to capture several aspects of regulation that I already alluded to before. There's, on the one hand, the minimum capital requirement. If banks fail to comply with this minimum requirement, then they are simply shut down and taken control of by the regulator. There's also a buffer requirement. They are in principle can allow or can violate this buffer requirement, but if they do so, they are restricted in their dividend payments, so they cannot pay any dividends. So this gives them an incentive to keep a buffer in excess of the buffer requirement so that they can actually pay dividends. And then there's also a liquidity requirement where the banks are required to hold reserves proportional to the deposits that they have. Now, the problem of a bank is then relatively straightforward. They simply maximize their expected discounted dividend payments. So they need to choose this loan origination, the deposits that they want to hold, issue, the reserves, the dividends, and they do this subject to several constraints, among other things, these bank regulation constraints that I've mentioned before. And what this gives us is a situation where these banks are then exposed heterogeneous in both equity and leverage. And this is arising because of this long-term risky loans. I mean, every period there's some idiosyncratic loan default shocks that have hit these banks differentially. And this is generating part of this heterogeneity in equity and leverage. And then, because there's these fixed rate loans and the variable rate loans, there's also this ex-ante heterogeneity that I mentioned before. And for simplicity, we're going to treat this in a particular way. We're going to consider an economy that only issues, or where banks only issue fixed rate loans. So you can think of Germany or the Netherlands, for example. And you can think of the other economy where they only issue variable rate loans as an economy such as Finland or maybe Spain or Portugal. Now we then embed this in banking setup into a general equilibrium framework where we have entrepreneurs that demand loans and need to fund their long-term investment projects. And I mean, as I said before, these projects are stochastic in their length. And the entrepreneurs are also going to be sensitive to the loan rates. So they will take into account, especially in the fixed rate case, if interest rates are higher because the central bank recently raised interest rates, then the fixed rate entrepreneurs will take into account that they will have to pay a high interest rate over the whole horizon of the loan. Then there are also households. In the model, they solve a consumption savings problem, and what is important for what we see today, or going to see today, is that they will supply these deposits and also own these banks. And there's a central bank that implements monetary policy by setting the policy rate, and a government that runs a deposit insurance scheme. So, because I'm not going to show you any equations, and I apologize to anyone that likes to see a lot of math in these presentations, I'm going to briefly recap the main frictions that are in this model. So there's deposit insurance and limited liability, which gives banks an incentive to increase or maximize the leverage in the model. And this is simply because, I mean, this is a typical friction that is added to these models, simply because the banks benefit from the upside potential of issuing these loans, but they only have limited downside risk because all they can lose is the equity that they have in these banks. Then on the loan, and the second point here, there's these loan adjustment costs. So every time a bank issues a new loan, they have to pay this adjustment cost. Together with the slow-moving equity that arises from the fact that banks accumulate equity over time through retained earnings, there's also going to be slow-moving leverage. And because we have credit risk in the model, and because of this minimum capital requirements, banks will actually have an incentive to keep a precautionary buffer above the minimum requirement, because this allows them to absorb negative shocks. So this gives rise to these endogenous capital buffers, which are additionally amplified by the slow-moving leverage in the model. And then the main amplification channel works here. I mean, whenever the central bank increases interest rates, so there's this monetary policy shock, then this reduces profits, and we will see this in a second. So this will kind of reduce equity accumulation, and then will also map into lower lending in the medium to longer run. Okay. So in terms of the calibration, this is calibrated to quarterly frequency. We try to be consistent with different euro area bank balance sheet statistics, such as capital ratios and liquid assets and loan maturities. We also try to be consistent with Basel III requirements, given the regulation that we have as part of the model. And we then target the empirical response of loan rates on impact of a monetary policy shock to calibrate some of the responses in the aggregate. What is going to be important for today is that I will present a version of the model, and this is also the version that the discussant received, where there's a full pass-through of monetary policy shocks to bank liabilities. So, I mean, if the central bank increases interest rates by 1 percentage point, this fully passes through to the deposit rate. This is somewhat counterfactual, but we're working on a version of the model where this is not the case anymore and where we have imperfect pass-through. Okay, so this brings me then to the first result, which is this. I mean, we term this a long-run result because I mean this is a steady-state result in the model. What I'm showing you here is the capital ratio distribution in the model, and you see, as similar to what we had in the data before, there's substantial heterogeneity in these capital ratios. And it's important to note here, this is oftentimes in banking models, the banks have incentives to go all the way to the minimum or the minimum capital requirements. So there's not really any dispersion here, and this is something that is where our model differs from a lot of these other papers. And so let me briefly recap for why the banks have this dispersion. So the first reason is related to the fact that they have incentives to hold a buffer above the minimum requirement so they can absorb these shocks. But then they also have incentives to stay above the buffer requirement because this allows them to pay dividends. And you can see that the banks also ultimately have substantial buffers with respect to this buffer requirement. Now, the second result that I would like to show you are these marginal propensities to lend that arise in the model. So their marginal propensity to lend is defined here as the additional amount of lending that a bank does if you give it one additional unit of equity capital. So if you think of a bank here at the 90th percentile, for example, in terms of leverage, if you give this bank 1 unit of additional capital, it will lend 2 units of, make 2 additional units of loans. And you see there's a substantial heterogeneity here in terms of these NPLs, which is related partially to the fact that, these banks at the higher end of the leverage, they are more constrained, and if you give them equity, this relaxes these constraints more than it does for these less leveraged banks. Which then brings me probably to one of the main results in this paper, and these are the aggregate responses to a monetary policy shock. So what I'm showing you here is a central bank that increases the policy rate at time 0 by 1 percentage point, and this is what you can see in the upper right corner here. And because of what I told you before, because of this perfect pass-through to deposit rates, the impulse response function for deposit rates actually looks exactly the same. So they have also the 1 percentage point increase there. Now, if we just focus on how interest rates are affected in the model in response to this monetary policy shock, you see that the pass-through to the loan rates is actually imperfect. So there's a lower pass-through than 1-to-1 to the loan rate. And there's an even lower pass-through if you look at the fixed rate economy, which is the red dashed line. And this has to do with the fact that in the fixed rate economy, the entrepreneurs take into account that a higher interest rate, if there's a higher interest rate, they will have to pay this higher interest rate for the whole duration of the loan. So they're a bit more sensitive to loan rate increases, which then means that the banks cannot pass through this policy rate increase as much to these entrepreneurs as they can in the variable rate economy. But I think more importantly is the panel here in the middle, or more important is the panel here in the middle, because here you can, if you think about the balance sheet of one of these banks, on the liability side you have mainly deposits and equity. The return on deposits goes up 1-to-1 with the policy rate. But on the liability, on the asset side, you have loans, newly issued loans, as well as legacy loans. And in the fixed rate economy, these legacy loans have an interest rate that is fixed. So even though the loan rate on new loans increases, the loan rate on loans that have been issued in previous periods stays constant, which then means that the effective loan rate that these banks get actually does not rise very much in response to the monetary policy shock, while there's a full pass-through from the loan rate to this effective loan rate in the variable rate case. Now, what this means is then, again, that there's a much stronger compression in net interest rate margins for fixed rate banks. And this then maps also in several other aspects or several other impulse responses that you can see here. So equity, because net interest rates margins are compressed, profits are going down, and equity falls in both economies, and it falls substantially more in the fixed rate economy because banks have less equity, they also are less able to pay dividends. So some banks will fall below the buffer requirement and will not be able to pay dividends anymore. And even the ones that are above, they will pay less dividends. It also has a negative effect on capital ratios and a negative effect on new lending. And it's always that because there's this stronger contraction in net interest rates margins for these fixed rate banks, that there is a stronger transmission to new lending than for the variable rate banks. Now, I promised you one result, at least related to financial stability, and this has to do with the fact that, because these capital ratios are eroded in response to this shock, banks are a bit less resilient to future idiosyncratic loan default shocks, right? So you have actually that the failure probability of these banks goes up as the central bank increases the policy rate. And what's interesting here is that if the policy rate was not increased would not follow this path, as you can see here, but it would have more hump-shaped path, so a more gradual increase over time, the central bank can produce a similar effect on new loans, but it has less of an impact on the failure probability. So the extent of the speed of the interest rate increase actually matters for financial stability here in this model. Now, this is what I wanted to show you. So this brings me to the last result that I wanted to show you, which is the cross-sectional heterogeneity. Because we have this fully heterogeneous bank model, we can not only look at the aggregate responses, but we can also look at individual responses in this model. And what I'm showing you here is essentially this panel here, only the zeroth period, so an impact of the shock, but across different percentiles of the leverage distribution. And you can see that it's not only that banks that have fixed rate loans transmit monetary policy more to new loans, but there's also banks that have variable rate loans that transmit monetary, banks that have more leverage transmit monetary policy more strongly than banks with less leverage. Okay. So this brings me to my concluding remarks. So we documented some stylized facts about euro area banks, and we use this as kind of guidelines for developing a heterogeneous bank model that can produce this ex-post heterogeneity in capital ratios while taking into account this ex-ante heterogeneity in loan rates fixation. And we use this to study aggregate and individual responses to monetary policy shock and show that there's this stronger contraction if banks issue fixed rate loans, and also if they are more leveraged or have lower capital ratios. And that's it. Thank you very much.
Thank you very much, and thanks for sticking rigorously to time. The discussion will be Federico Puglisi from Banca d'Italia.
Very good. So thank you very much, Luis. Thank you to the Banco de España, to CEMFI for inviting me to and giving me the opportunity to discuss this great paper. Joel did a wonderful job presenting it, so it will make my discussion easier, and also great contributions before, so I'm very happy to be here at this conference. So my name is Federico Puglisi, I'm from the Bank of Italy, which means that the standard disclaimer applies. To go to what is this paper about. So basically, they start from really two empirical observations about bank heterogeneity. The first one is has a long tradition in the literature, and is the heterogeneity about leverage and regulatory capital ratios. In particular, in this paper, they do show that the distribution of the CET1 ratio is fat-tailed. There is a large tail of high CET1 ratios, and on the other hand, also that there is a lot of heterogeneity in the precautionary buffers that banks keep above and beyond their capital threshold, their regulatory thresholds. The second key heterogeneity they highlight in the motivating facts is the fact that countries do differ a lot in the loan pricing policies that banks apply. So there is a bunch of countries, mainly normally called the core euro area, let's say, so Germany, France, Belgium, Netherlands, which are characterized mainly by fixed rate loans, and then there is a bunch of countries that are instead mainly characterized by floating rate loans. So the key question that comes natural at this point is there a meaningful and relevant interaction between these two types of heterogeneity which actually shapes the transmission of monetary policy? Okay? And the way they approach this question is by constructing this general equilibrium model where banks are ex-ante identical and exposed heterogeneous, however, in leverage due to various shocks that they have in their balance sheet. They calibrate this to the euro area, and the model comes in two versions. One in which loans are only fixed rate, and one in which loans are only variable rate. And the key exercise will be to compare these two. Joel didn't put any math, so I'm happy to complement at least a little bit to the presentation. I will do some math, but this is probably unflattering to the model, which is much more complex and elegant. In any case, so we have a bank balance sheet. Liabilities are made of deposits and equity. Assets are made of reserves, new loans issued today, and legacy loans. Legacy loans is the stock of loans that I'm bringing from the period before. For simplicity, let's think that all loans mature in 2 periods. So in any given period, I only have the loans that I issued today and the loans that I issued yesterday. The core of the action of the mechanism that is highlighted in the model comes from net profits. So net profits in a floating rate system are going to be given by the interest rate that I gain on new loans, the interest rate that I gain on old loans that is still set in time t, because this is floating rate loans, so I have the ability to adjust them every period, even the loans originated in the previous period. Then I'm earning some interest on the reserves, and then I pay interest on deposits, and I have a convex origination cost. When I move to the fixed rate system, then there is one main difference, which is that now the interest rate I earn on loans depends on whether they're new, then I can set whatever rate I want, or whether they come from a previous period. In that case, I'm fixed to whatever rate I fixed at issuance. Okay? So the stock of loans LT now earns RNT minus 1. Let's assume that there is perfect pass-through from the policy rate to the deposit rate, and let's complete this small sketch with the equity that evolves by accruing profits and regulatory constraints, which implies that loans are a multiple of equity. Okay? And so what is the key mechanism? Why is the fixed rate, why are fixed rates a little bit of a problem here? Well, the key mechanism and the key difference with the floating rate system is as follows. It's exemplified in this chain of events. Policy tightening, we have a policy tightening, the interest on reserves goes up, the interest expense goes up with perfect pass-through, 1-to-1, so the deposit rate goes up. Now, the interest earned, on the other hand, doesn't go up 1-to-1, and that's simply because the effective rate that I earn is the weighted average of the rate that I set today on the new loans and the rate that I set yesterday on the originated loans. Why the rate today is free to increase with respect to yesterday, the rate that I fixed yesterday is fixed. And so basically, the pass-through to the interest earned on loans is much lower. Very good, thanks. Net interest margin goes down, hence profits go down, equity goes down, and through binding capital constraints, we have new lending going down, okay? So basically now the papers model is much richer, and we have loan defaults, deposit shocks, and endogenous bank default. Loan defaults will create the ex-post heterogeneity in leverage. And the key takeaway picture that I take from this key contribution is really this interaction between loan default, between leverage heterogeneity and fixed versus floating rate systems, okay? And you can see that there is a clear non-linearity in the way new loans contract to a tightening of monetary policy when we are in a fixed rate system. They contract by much more. Look at the last orange bar when we are in a fixed rate and the bank is highly leveraged with respect to when we are in a floating rate system. Okay? Now, my comments will be mainly 3 comments, and then I'll have some more, but in the interest of time, those are homework for the authors, and I'm happy to discuss offline, of course. So the first one will be about the contribution with respect to other models with heterogeneous banks. Then I will be touching upon the deposit stickiness, then the floating rate channel, and as I said, more for the authors. First of all, so there is models out there already about heterogeneous banks and about how this interacts with the bank lending channel. So there is this Wang et al., which is a structural banking model in partial equilibrium, where they have all these different channels, reserve requirements, capital regulation, market power, and they quantify those. Then there is Corby and Erasmo, so they have idiosyncratic funding shocks, aggregate shocks to the fraction of performing loans. This is also related to the banking channel. Then there is Belli-Femine and Rassam is here, which is a G dynamic macro model with various types of risks that again is again touch upon the bank lending channel. And finally, we have Mendicino et al. Caterina is also here, where ex-post heterogeneity in risk exposure and default outcomes are interrelated, and they create non-linearities in macroeconomic outcomes. So my question, so the paper really contributes. There is one thing that is clear, modeling-wise. Legacy loans are introduced. There is a whole bunch, there is a state variable that runs around, which is the stock of loans. And this is very important for the average pass-through of the effective loan rate, in creating stickiness in the pass-through of the effective loan rate. However, it would be nice to have more guidance on the novelties, on the other novelties of the paper, and also more discussion of the role and purpose of the model, and also, is it safe, leading from number 1, is it safe to actually abstract from market power? The second one is about deposit stickiness. So Joel did a great work, so I'm gonna go really fast on this. The pass-through to the loan interest rate is much lower than 1. The pass-through to the deposit rate is exactly 1-to-1, which means that the net interest income is always decreasing. Now, this is a problem in the sense that this might be a problem, but it's gonna be fixed, so I'm not gonna be talking too much about it. Sticky deposit betas, so we might have to have a lower pass-through. However, there is another problem, that is that actually the deposit franchise should at least help a little bit hedge in interest rate risk. Now, we had 2 contributions about it before, so we'll have to think about that. But what they show is that NIM doesn't respond too much to monetary policy. What am I doing here? Well, I will try to provide some help. I have a new paper where we actually show that NIM response is on average 0, but if you look at some samples and different interest rate regimes, it's actually very positive and significant in low interest rate regimes and negative in high interest rate regimes, okay? And there is also this other paper about convexity in the deposit betas. So it might be useful to add these 2 additional environments, low and high deposit betas. Finally, floating rate channel. This goes a little bit, is an alternative to your channel in the sense that we have a monetary policy tightening. The defaults of floating rate are actually increasing much more, which means equity goes down, binding capital constraint, new lending goes down. So there is literature about it on the bank side and corporate side. This is a potentially competing mechanism in your model, potentially important to be included. And one way could be to adjust the Vasicek module so that you can actually calibrate it to the 2 versions of the model. And yeah, overall, very interesting paper. It's very topical. As we see, there is a huge heterogeneity in fixed rate and floating loan rates. It is non-trivial and important effects on the bank lending channel and monetary policy, so I look forward to the next developments. Thank you very much.
Thanks very much, Federico. Would you like a minute to react to?
I mean, first of all, thank you very much, Federico, for this excellent discussion. I mean, these points are very well taken. Regarding the market power, this is something that we were thinking about. One reason why we have not included it yet, it was kind of for computational reason, because it makes it more difficult to solve the model then. But I mean, if there's, we will definitely continue to think about whether this is something that we can incorporate into this setup. Then regarding the deposit betas, this is something that we are trying to improve, and we have kind of a very preliminary results on this, but I didn't want to include this today because we haven't fully converged on what we would like, I mean, the calibration and everything that we would like to achieve. And then in terms of the floating rate channel, this is also a very good point that might be something that we should incorporate in a future version of the model.
All right, we have time for a couple of questions from the floor. Please. Can you hear?
It's not working.
Not really. Yeah.
Financial Stability Partner from Banco de España. So you have motivated the paper on the distribution of capital across European banks. This depends on many factors, many more than would be tractable to include the size, larger banks, or rather smaller banks may be more prone to confidence shocks, and then they need more capital, or banks are exposed to different sectors. But yet okay, let's try this. With the model, I understand that you're still able to replicate well this distribution, even though you don't have all these factors. No? So maybe you can elaborate a bit more on the calibration, how you fit that. And the other point is that when looking to monetary policy transmission, it's important also the impact on public debt, no? And the possibility and the incentives that banks have to invest in securities, in particular public debt, fixed income. Do you think that it could be tractable or interesting to include that in further iterations of the model, or rather it makes it too cumbersome? Thanks.
Okay, thank you. So, yeah, regarding the first fact, it's true that there are a lot of other reasons for why these banks hold these substantial capital buffers, and part of them is due to regulation, and as you mentioned. But even if you take this out of this figure, I mean, I have in the appendix, I have a figure that only shows the buffer. Then you still have substantial heterogeneity there, and so. Ultimately, we didn't have to do anything special in the calibration to be able to match this remaining heterogeneity that is there. Then regarding the public debt, so in a sense, you can take probably, I mean, the way we calibrate the model, the reserves, we interpret them actually a bit more general, that this can also be, I mean, part of this is also government debt that these banks hold. So, I mean, in a sense, this is already there. I did not exactly understand what the mechanism that you had in mind that would be interesting for what we're trying to do, but yeah, maybe this is something that we can discuss later on in more detail.
Very good. Thank you very much. We're going to have to move on to the second paper by Alonso Villacorta from UC Santa Cruz and co-authors on unobserved heterogeneity in the bank lending channel.
Can I get that?
Let me put it up for you.
Thank you. So first of all, let me say thank you very much to the organizer for including our paper in this great conference. It's a pleasure to be here. Presenting this paper, which is co-authored with Brian, who is at the University of Minnesota, and Luciano, who is at the Bank of Chile. Now, in this paper, we study empirically the bank lending channel, which we're going to refer to as this mechanism by which shocks to banks, shocks to their balance sheets or to their cost of funding, end up being transmitted to firms. And in particular, we want to emphasize heterogeneity in this transmission across firms. Okay.
So our paper is motivated in the following key question for the macrofinance literature, which is how important are credit supply shocks for firm outcomes. Empirically, answering this question is hard because when we observe credit fluctuations, this could be driven either by credit supply factors or demand factors. Disentangling supply from demand is challenging. So state-of-the-art methodologies now exploit credit registry data, where we can exploit these multiple connection features from the data. We observe banks lending to multiple firms, firm borrowing from multiple banks, and that's going to help us disentangling supply from demand. Right? So the typical intuition is if I observe a firm borrowing from 2 banks, and the firm borrows less from bank 1 but not from bank 2, and I think something bad is happening to bank 1, it's credit supply, cannot be credit demand because otherwise I would observe that the firm borrowing less from both banks. Right? So a seminal contribution exploiting this idea is Kwajamian, but there have been many influential papers using data from the Banco de España as well, following this type of approach. Now, most of this paper follows these key identification assumptions of an homogeneous transmission of credit shocks. However, in certain contexts, we could expect the transmission to be heterogeneous. Okay? For instance, if it exists interactions between banks and firm factors, that I think could naturally arise if we think about bank specialization. There is a recent paper by Paravicino and co-authors using data in Peru that show that there exists a specialization by export destination markets. So it's a bank in Peru that specializes in lending to firms that export to Europe, and another bank that specializes in lending to firms that export to the US. And when something happens to these banks are going to treat differently the firms depending on what they're exporting to. Another example is this paper by Billikel and co-authors that show that there exists a specialization by industries in US banks. Okay, and there are other examples about bank specialization. We could think that the specialization works in other margins, and maybe some of these margins are unobserved to the econometrician. Maybe it's about theories of relationship lending, that banks create relationships with certain firms, then we should expect them they're going to treat them differently. Maybe it's about firm productivity or the type of contracts that are used. Okay? So in this paper, we're going to ask how important are these bank-firm interactions for the transmissions of credit shocks? And if these interactions exist, then what can we do to answer these important questions of the importance of credit supply shock for firm outcomes? So to think about these questions, in this paper, we develop a methodology that estimates the impact of credit shocks, allowing for bank-firm interactions, allowing for this heterogeneous transmission. Our main assumption will be that the effect of credit shocks can vary across firms, but across different groups of firms. And we're going to treat this group of firms as unobserved, and instead we're going to identify them through machine learning techniques. So this method will be valuable, for instance, for researchers when they are uncertain about the specific dimension of specialization that is relevant. Or maybe they have a sense of what is the margin that matters, but they lack access to the data. Still, our methodology would apply. We're going to apply our methodology to Peruvian data. We have access to the Peruvian credit registry. We document in our data set that there exists significant evidence of heterogeneity in the transmissions of shocks. Once we learn about this heterogeneity, we conduct different applications which highlight the importance of learning about heterogeneity in order to learn well about the importance of the bank lending channel. Okay, and hopefully I have time to go through all of them. So in the literature, this literature that estimates the bank lending channel is extensive with many important contributions. Let me highlight in the second bullet some recent papers that highlight this heterogeneity in the transmission as well, but by looking at observable characteristics. So I told you about Paravicino and co-authors that look at export destination markets. There is another paper by Bashina and co-authors that show that there is heterogeneity in the transmission depending on the type of contract is used. Instead, we're thinking about unobserved heterogeneity. What if we are not sure about what's a relevant margin or multiple margins? So we're going to instead rely on the econometrics literature to try to identify this heterogeneity. So first, I'm going to give you a quick review of this standard framework that relies on the homogeneous transmission of shocks. Then just directly by looking at the data, I'm going to show you some evidence of heterogeneity in the data set. And then I'm going to go to the full model with interactions and then show you the results. So let me start with this standard framework that assumes homogeneity in the transmission. So let this YFB be the growth rate of loans between a bank B and a firm F. Typically, the literature assumes a linear specification that looks like the following. So a lending from bank B to firm F can depend on alpha F, which capture firm-specific factors, typically interpreted as credit demand factors. Beta B, which capture bank-specific factors, typically interpreted as credit supply factors. And then any interaction between banks and firm, any factor varying at the bank firm level, is going to be captured by this epsilon. Note, of course, that we observe the lending of bank B on firm F if it's in our data set. We call that if a connection exists, and we call that with D equal 1. Now, typically, the literature, or many papers in the literature, rely on an observed measure that is associated with a credit supply factor. So in this case, instead of treating beta B as an unobserved factor, we're going to have an observed variation xb. For instance, in the seminal paper of Kwashamian, this is exposure of banks to a liquidity shock. And in that case, we're interested in the treatment effect, which is the parameter theta, right? How exposed banks end up transmitting that shock to the lending to firms. Now, in any case, either we are thinking of beta as an observed factor or interested in this observed treatment effect. This model would rely on the following assumptions. First, the one of homogeneous effects, which is that these bank shocks, beta B, are transmitted equally to all the connected firms. Firm shocks, alpha F, are transmitted equally to all the connected banks. Right? So that's embedded in the linear specification. Moreover, we would need what we call an exogenous network assumption, which is that these interactions captured by epsilon have to be idiosyncratic. Okay? Meaning that they cannot be correlated with our demand or supply factors, nor with a network connections. Okay? So the idea is that when I observe a bank lending to a firm, that shouldn't tell me anything about the particular interaction that they have. Okay? That is going to be an important assumption. Moreover, credit registry data typically give us multiple periods of data, so we can add subindex T to all the parameters here, but for simplicity in the presentation, I'm going to drop the T's. How can we estimate this? Well, given multiple connections, we can just estimate this by using fixed effects. What's the intuition? For instance, if we want to identify beta B, I could look at the differential borrowing of the same firm F from two banks. Because I'm looking at the same firm, the factor alpha F would disappear because it's homogeneous. Then the lending of bank B relative to B0 to the same firm have to be explained either by the differential credit supply factor beta or the interaction epsilon. Right? But now, given the exogenous network, I can average across a set of firms borrowing from both banks, and that is going to wash out the epsilons. Okay? So that moment condition identifies the parameter of hysteresis, the betas, or in case I'm relying on observed bank exposure, that is going to identify the parameter theta. So what is intuition? All systematic difference in the lending of two banks to the same set of firms is going to be attributed to a credit supply shock. Now, moreover, this moment condition should hold for any common set of firms, right? Because the parameters are homogeneous. So now let me show you this moment condition directly in our data set. So here I'm showing you in the x-axis the 4 main banks in Peru. And I'm just plotting that moment condition, the average differential credit across different banks to the same set of firms, borrowing from the 4 banks. So we can see there, for instance, that Bank 2 lends around 12% less in this particular year relative to Bank 1. So it looks like something bad is happening to Bank 2. It's a negative credit supply shock to Bank 2. Bank 3 and 4, they are showing little shocks. Okay? Now, let me take all of these firms borrowing from the 4 banks and divide them in 2. So now on the right, we have the red firms and the blue firms. And we can see that we already see considerable heterogeneity, right? If we look at Bank 3, we look at the red firms, Bank 3 is lending more than Bank 1, so it looks like something positive is happening to Bank 3. But when we look at the blue firms, we see the opposite. Now, in this case, we made the cut depending on the size of the firms. But we use this as a first evidence that heterogeneity may be present in the data. So then we need to take into account when we estimate. Okay? So now let me go to the full model with interactions that can account for heterogeneity. So the full model will look like the following. Now we have this factor psi varying at the bank firm level, which now could capture systematic interaction, right? It could be correlated with the factors or with a network of connections. So in order to separate epsilon from psi, we need some structure. So in our preferred specification, we're going to model these interactions or heterogeneity at the group level. The idea is we're going to assume that every firm belongs to a discrete group G, where there are big G number of groups. And now we're going to allow a factor to vary at the bank group level. This would capture, for example, that the bank shock can affect differentially firms in different groups, under the assumption that within the group, then the shock is going to be homogeneous. In the paper, we motivate this empirical model with a theoretical banking model in which there is lending specialization. We show that this type of empirical transmission of shock would arise. And moreover, this is motivated by this empirical evidence, right? So we say that Paravicini and co-authors show that export destination markets are important, so we could define the groups. Firms that export to the US belong to one group. Firms that export to Europe belong to another group. Another example would be that using the paper of Yashin and co-authors. So it's the type of loan what matters. So firms using certain type of loans would belong to one group. Firms using another type of loan belong to a different group. Now, we would now replace this exogenous network assumption with one that works within groups. Okay? The idea is that these epsilons are idiosyncratic. Okay? They cannot be correlated with the network connections. However, the interactions that happen at a group level can be correlated. Okay? So that's important because that will allow now that the probability of matching one, that a bank matches with a certain firm can depend on interaction. The interaction happening at the group level. So our model allows, for instance, that firms that export to the US have a higher likelihood of connecting with banks specialized in the US. And that's something that actually Paravicini and co-authors show that happens in the data. Okay? The standard framework wouldn't allow for that, so I think that's important to highlight. Now, how can we estimate this model? If groups were known, this would be easy, right? So we just use the fixed effect approach, but conditionally on groups. Groups, firms that belong to one group, I do the estimation separately from other firms that belong to different groups, etc. What is the issue? That these groups may be unobserved. Okay? Maybe the data is not available, or maybe the heterogeneity depends on multiple variables, and some of them are unobservable. What is going to be our solution? Well, let's follow recent developments in the econometric literature that allow us to cluster observation and find these groupings. We're going to follow in particular this paper by Bonon and Manresa. Now, let me say that typically clustering techniques are based on some observable dissimilarity measure. The idea is that firms that look similar across some observable characteristic, we put them together. In our case, the groups are defined by how banks treat them when they are affected by an observed credit shock. Okay? So we're going to combine the ideas from the clustering literature with this bank lending framework. Okay? And the algorithm would look in something like this. Okay? Give me a summary of the algorithm that we use. So we're going to assume that we know the number of groups, big G, and we're going to repeat the exercise for different numbers of groups. We're going to start assuming some group assignments. So let's say that firms belong to group 1, this to group 2, this to group 3. We're going to take this guess as if it was the truth in step 1, and then estimate our factors through the standard approach, conditional by groups. So we're going to have parameters that change at the group level. Then in step 2, we're going to use those parameters to make predictions about what credit growth is supposed to be. The prediction is going to vary depending on the group that the firm belongs to. So now we're going to assign the firms to the group that gives the best prediction. That is going to give us a new grouping. So with that new grouping, we're going to go back to step 1, estimate again, and keep iterating until convergence. Okay? That's the idea. So in the paper, we show the theoretical properties of this estimator. We show that it's consistent if we have enough numbers of firms and banks. Moreover, we conduct many types of simulations to see the performance of our algorithm. And we show that it performs well, even for data sets calibrated to our data set. Okay? So, but let me skip this discussion. And before going to the empirical results, let me do a discussion on interpretation of what we are finding. So we show theoretically that our algorithm will detect any interaction occurring at the bank firm group level, okay, that is systematic. Now, this is an interaction. So we see that banks treat, or there is this variation in the lending of banks by these groups. But how can we interpret these factors? For instance, we could have a supply interpretation in which this is a shock to bank B that is transmitted heterogeneously to the different groups. But maybe it has also a demand interpretation. It could be a common shock to the group of firms that they decide to borrow differently from the different banks. Okay, so we cannot escape this issue of interpretation. So first message is, once we think that there is heterogeneity in the data, then you have to be careful of how you interpret your fixed effect approach. Okay? So we're going to explore 2 potential solutions to this, because our idea is to understand the importance of credit supply factor for firms. So in the first one, we could add an instrument. Okay, so if we rely on a credit supply shifter, observe variation at the level XB, for instance, associated to an event study, as in the case of Kwajalein, then in that case, we could clean all of the part from this beta B at the group level that comes from this credit supply shifter. Okay, the assumption is that XB is uncorrelated with the bank specific credit demand. Now, one may wonder, okay, if we're relying on a credit supply shifter, then do I have to care about heterogeneity? No? For instance, if I'm just interested in an average credit supply effect, now that I found a credit supply variation, can I just use a standard homogeneous Kwajalein estimator? And in the paper, we show that not in general. Okay? So even if the heterogeneity is a heterogeneity in credit supply, you have to be careful on how you find your average effects. Okay? So if banks and firms were randomly matched to each other, then you can use the standard approach. But if they don't, then that is going to be a bias estimate. Okay? And actually what matters is if the probability of banks of matching with certain firms depends on how banks are going to treat those firms, then that can be problematic. And the problem can be so big that you can get even an estimate with the opposite sign. Okay? But I'm going to defer you to look at the paper to see the details on that. Our second approach to try to, if we don't rely on this credit supply shifter, if we don't have it, we propose an approach that goes directly to a real effect regression. What is the idea? The goal of finding this credit supply factor is to see how important are those for firm outcomes. Okay? So in this real effect regression, we're going to take this credit supply shock and see how important are those, for instance, for firm investment. In that regression, we can control for group fixed effects. What is the idea is that the demand shock that affect the common firms, is common to the firms in the group, should lead to similar effects on these investments for all firms that work within the group. We can control for that in the real effect regression. Okay? Our assumption is going to be that we could have firms within the group that are differentially exposed to banks. Okay, and then the question could be, why is that if they belong within the group, why are they differentially exposed? So there are different explanations that we provide in the paper, but the point is that's a testable assumption that we can look in the data, and that's what we do. Okay, so I'm going to show you exactly the specification in a few slides. So now let me just jump directly to the results. So we have data from the Peruvian credit registry. So first, let me show you, once we apply our methodology to this credit registry, first, evidence of heterogeneity. Here I'm showing you exactly on the left the same graph that I showed you at the beginning, the 4 main banks of Peru. I'm looking here at differential credit growth across banks. But now for the groups that come out from the algorithm. Okay, so we can see substantial differences, right? These differences are going to be then reflected on the estimates. So on the right, we have the estimates of this beta that vary by groups. So for the red firms or the blue firms, for now, these different groups of firms are defined by the algorithm. Okay? So now once we have learned about this heterogeneity, what can we do? So we conduct 3 different applications. The first one is an event study. Okay? So here we're going to follow this important paper by Paravicini and co-authors, which follow a similar approach to the Kwajalein. The idea is that we have an observable variation measuring a credit supply. In this case, we're measuring the exposure of banks to the crisis. The idea is that we have, in Peru, certain banks that rely more on foreign credit, so we thought that they are going to be more exposed, relative to the banks that rely more on domestic deposit, they're going to be less exposed. And so we want to see how more exposed banks end up lending to firms relative to the less exposed banks. We're interested in the parameter theta. Okay? Now we're saying, we learn about these groupings, so now this treatment effect, how the exposed banks treat differently the firms, may change at the group level. Okay, so now let me show you the result of the estimates of this data, which vary by banks and groups. Okay, so here we're looking at 2 different exposed banks. You can see first, in the case of G equal 1, here is assuming that the effect is homogeneous, we have a significant effect. Okay, that's a significant effect. It's small, but it's significant. So exposed banks lend less than non-exposed banks to the same set of firms. But that hides a lot of heterogeneity. Once we go to more groups, we see that, for instance, with G equal 2, there is some group of firms that get destroyed, while other firms are not much affected. And actually, if we go to G equal 4, we can see that there are some group of firms that are protected. Now, it's not that all banks protect the same group of firms, that G equal 4 is protected by the first bank, not by the second exposed bank. So that points to this idea of a specialization, right? So certain banks maybe create relationship with those firms, and they are willing to treat them, but not all banks are going to treat them in the same way. Now, who are these firms? What are behind these groups? So let me just give you a bit of idea. We have some observable characteristics at the firm level that we observe that differentiate the groups. For instance, collateral matters, the size of the debt matters, if the firm exports or not matters. Okay? Let me highlight on G equal 4, for instance, debt size. So we can see that debt size is important. So actually the firms that are getting destroyed by banks are the ones that have higher debt, okay, relative to the other ones. But now debt size is not the only thing that differentiates the groups, right? So for instance, if we look at the low debt firms, we're going to miss part of the heterogeneity. This group of firms that the first bank was protecting are the firms that have low debt, but also have low exports. Okay, so maybe it's a multiple margin of characteristics that are going to help us to understand these ideas behind bank specialization, and our algorithm can help us in detecting those multiple margins. Okay, so as a second application, we go on the real effects. Okay, the idea, again, is that we identify this credit supply shock. We want to see how important are those for firm outcomes. In this case, we have data on firm investment. Okay? So the first step is to create a credit supply shock at the firm level from the bank shocks. The idea is if a bank is experiencing a certain shock, we're going to assign that a weighted sum of those bank shocks to the firm depending on the importance of the bank for the firm, where the importance is measured by the importance of the bank in the borrowing portfolio of the firm in the previous period. Okay? So once it has this supply factor at the firm level, we want to see how important is that for firm investment. Now again, highlighting the discussion before, it is important to control for firm group effects here. Okay? So the idea is we're looking at firms that belong to the same group. If part of that beta has demand, it should generate a similar effect on investment. So that is going to be controlled by the group fixed effect. Okay? These are the results for the beta 2 estimate. That's an interesting estimator. We can see that the homogeneous estimator is very imprecise, have actually a point estimate that is negative. Okay, it's not significant. Instead, once we go for the heterogeneity, even starting from G equal 2 up to G equal 5, we find a significant estimate. The point estimate is between 4 and 6%, the elasticity. Okay? And I think these results make sense, at least the fact that the homogeneous estimate is very imprecise, once we have seen all of the heterogeneity in the data set, right? So I told you, there is a bank that lends more to the red firms. We should expect those firms to invest more. But the same bank is lending less to other firms. We should expect those firms to invest less. When we go to this regression and we assume homogeneous effects, we're trying to associate all of these differential investments with the same number, because all of them are connected with the same bank. Once we open for heterogeneity, we say, no, actually the bank is lending more to the red firms, and those firms are investing more, while it's lending less to the blue firms, and firms are investing less. That is going to help finding the right elasticity. Okay, so it's important to consider heterogeneity if we want to find out the real effects, which is important. In the end, the ultimate goal of this exercise. As a last exercise, we go and highlight the importance of the network of connection between banks and firms. The idea here is, if heterogeneity in the transmission is important, then how banks and firms connect to each other may be crucial for the aggregate transmission of a shock. Imagine that the exposed bank is mostly connected with firms for which the transmission is strong. Then we're going to expect a much important transmission on aggregate than if the exposed bank is connected with firms for which the transmission is weak. Okay? So our empirical model allows us to calculate what would happen in a counterfactual in which banks and firms are connected in a different way. So for instance, we look at a random assignment. So we say, if we observe a firm borrowing from 3 banks, we're going to try to say what would happen if that firm was borrowing from any random 3 banks. For any counterfactual connection that we don't observe in the data, what would happen, we're going to use our model. Now, of course, the prediction of the credit growth is going to depend on the match between the bank and that group of firms that we learned already in the data. Okay? So this is a result. This is the random. For the random network of connections, we want to calculate the aggregate credit growth and compare it to the observed network. So we have that on average, there is the random network generates 20% less credit growth than the observed network. Okay? That means that banks and firms in the data are creating matches that helps expanding credit growth, okay? So which is good. Now, this is for a particular year. I could go to a year of the crisis and we get the opposite. Actually, it's going to amplify the negative effect. So let me just say, in terms of financial stability, it's important to understand how banks and firms are creating a connection with each other, to understand, in the end, how, on aggregate, a certain shock is going to impact the economy. Okay? So I'm going to leave it there. I show you a new method to understand the bank lending channel, considering this heterogeneous effect, and I show you that this is important for different exercises. Thank you.
Thank you very much. The discussion by Victor Sancibrián from around CEMFI.
All right. Well, thank you very much to the organizers for inviting me to discuss this paper, which I very much enjoyed reading. So thank you. So I'll start with my own summary of the paper, and then I'll follow with 3 comments, and then conclude with some remarks. So in this paper, the authors are interested in characterizing heterogeneity in transmission of bank credit supply shocks to firms, right? And the starting point here is this seminal contribution by Kwajamian in 2008 that exploits match bank firm credit data and postulates a two-way fixed effects specification, right? So we have here the long growth rate of firm F with bank B over any 2 periods as explained by firm fixed effects and bank fixed effects. Now, for the two-way specification to be a reasonable model of average credit growth, well, any systematic component beyond the fixed effects, such as any predictable bank-firm interactions, must be accounted for, right? And the authors emphasize here market specialization by banks. So in order to get around this, one possibility is to group similar firms together and then re-estimate the two-way model, right? So if we think that bank specialization happens mostly along firm sectors or along export markets, well, we would first group firms by sectors or by export markets, and then we would re-estimate Kwajamian. So to say the same thing with equations, essentially given a rule that assigns firms to groups, this is analogous to specifying this equation that now allows for bank fixed effects to be group specific, right? So here they're indexed by J. And notice that conditional on a given group, then we are back to Kwajamian's set. So the key empirical innovation in this paper is that the authors allow this grouping to be based on unobservables, right? So that is, they allow group membership to be left unrestricted. And this is in the spirit of K-means or clustering algorithms, right? That sort of group similar firms together into a pre-specified number of groups. Now, in this particular case, the estimator and the statistical properties are developed in this paper by Stéphane Bonhomme and Elena Manresa in 2015. Now, the authors bring this to Peruvian matched bank firm data and repeat the analysis for every period in the panel and uncover substantial group level heterogeneity. And importantly, they find that, you know, these group effects correlate with certain observables, but that's not the whole story, right? So now, you know, this is the basics and helps me sort of set the stage for a few comments, but there is, of course, a lot more in the paper, as we've seen. So, for instance, there are results of what happens when we do Kwajamian and we ignore heterogeneity, on estimation with credit supply shocks, on the implications of these interactions for aggregate credit growth, and so on. Okay, so my first comment is a bit technical, but I think it has important implications. So there is these group fixed effects, right? These betas, and they might capture both credit supply shocks from banks to firms, right? Which is sort of the direction we're interested in, but also, as you've discussed, demand shocks that might, from groups of firms to banks that might lead to differential borrowing, right? And when these credit supply shocks are observable, well, a possibility is to just bring them to the equation here, and in this, in this particular case, allowing for group-specific effects, right? But I think that given this emphasis on both credit supply shocks and credit demand shocks, I think there is value in decomposing these group effects more explicitly as the sum of these heterogeneous credit supply shocks, and then any other unspecified interactions that could be these demand shocks, right? Now, I think this is worth for two reasons. First, because it makes explicit that we're allowing for additional factors beyond these supply shocks, which might not be totally obvious if we just look at equation 3. But also because it suggests more robust estimators. Okay, so in particular, given uncorrelatedness between these supply shocks and these demand shocks in the errors or mean independence, then a two-step estimator that basically first obtains these beta hats and then regresses them on the supply shocks will be more robust than one based on this first stage directly. And the reason is that this only requires this mean independence condition, while here above we are also imposing mean independence with respect to the heterogeneous loadings, the heterogeneous coefficients. Okay. Now, my second comment is on quantifying and observed heterogeneity, right? So I think that, given the goals of the paper, it is sort of natural to try to quantify the extent of how much heterogeneity there is. And a very simple summary is given by the variance of these group level coefficients over groups, right? So this is the population variance. We have here the betas, and we have here the type probabilities. So these are the population frequencies of each group. And this is also identified in the same way that the mean is identified, right? So one could calculate this for over groups, but for across banks or across time, or maybe for these betas, but when they're net of certain observables that we can control for, and so on. Now, in terms of estimation, a feasible counterpart could directly use these beta hats and these sample frequencies by fixing these group membership that were also estimated in the procedure. Now, an open question is whether this is a good estimator. So whether we can construct or we can construct bias-corrected estimators. So the idea here would be that every firm in the same group has the same beta. So those are essentially repeated measurements for the same betas. And those ideas can be exploited to construct bias-corrected estimators. And Arellano Bonham 2012 is a good reference. And then my last comment is about matching of firms and banks. So basically, you could go to the original equation and do this variance decomposition, right? With the variance of the firm effects, the bank effects, and the covariance. And an alternative way to think about the paper is about endogenizing sorting. So the idea here is that while sorting is definitely allowed in the Kwajamian setup, because you could have positive assortative matching, let's say that better firms borrow also from better banks. Here, the paper allows for group-specific sorting, right? So, for instance, heterogeneous borrower-bank matching patterns along, say, bank specialization. And you could look at this over time. So, for instance, you could look at persistence over these sorting statistics as suggestive of endogenous matching based on fundamentals. And again, here, from a methodological point of view, there is also interest in studying the finite sample biases in these variance components. There is a limited diversification bias, which is sort of totally analogous to the limited mobility bias in the AKM literature. Okay, so I'll just conclude. I think it's a great paper. I think it's a substantial step forward relative to current applied practice, and And it uses sort of fancy methods, but they're very much sort of grounded in empirical content, right? They're very much motivated. And the other reason why I think it's a great paper is that it opens the door to several potential extensions and methodological questions, and we've talked about some of them in comments 1, 2, and 3. And let me just wrap up by sort of emphasizing that it is worth keeping in mind the parallel of the data and the methods here with those from the matched employer-employee data literature. And this paper here by Stefan and co-authors is a good reference for recent advances. Thank you.
Thank you very much. Would you like 1 minute to react to the comments?
Sure. Thanks a lot for the discussion and the suggestion. I think they can be very useful. So one key point is once you identify this interaction, again, as I was discussing before, is it credit supply, is it credit demand? Once you have the credit supply shifter, you can always project these interactions to the credit supply shifter, and then you have the part of the credit supply and then the rest. That's actually one option that I think we discussed a bit in the paper, how to estimate these heterogeneous treatment effects, these heterogeneous supply effects. But in the end, in application, we use the other more standard approach that you're saying, okay, it's a bit weaker, so we should go with the option. So that's a great comment. On how important is heterogeneity and how we can quantify it, we show in the paper R-squares of how these G's are changing, but I'm going to look at your proposal. That can be nice. And yes, the part of sorting, what you think on heterogeneity, then thinking about how banks and firms are creating connections becomes like something that is key. No? And it's key for all the literature, no? And that's going to make us rethought our assumptions. Now here we're thinking if the relevant margin is at this group level and you're able to identify it, then you don't need to worry much about how they are creating it. If you are not identifying that would still be a problem. And we were thinking about some tests that maybe I can discuss with you later to see if you like them or not. But thank you.
We have time for 1 or 2 questions.
How do we interpret the number of groups that you're going to put to examine heterogeneity? What happens if when you have 3 groups, heterogeneity doesn't matter? When you have 4, it does matter? I mean, is there any discipline here? Can we test to which extent the G number is a number that we should stop at a certain level? I mean, again, other than testing the idea that heterogeneity is important or it's not, can you test any other hypothesis here?
Let's take another question, and then
yeah.
we'll reply well.
So I think it's a very interesting paper, but let me be a bit critical. So first, as the discussant said, you can test, even with multiple groups, you can test whether the covariance, when you leave these fixed effects for the different groups, they are in the error. So you can test whether the covariance and observed covariance between that demand and the supply shocks, they are 0 or no. They can be 0 or they can be with a different sign, as the discussant said. Second thing is we had a paper a long time ago in Econometrica in which we show different risk-taking motives through the credit supply. So, and this could be on observable characteristics and unobservable characteristics. Also, the first paper today was talking about risk-taking. Once you have that, you might think that that's a demand issue, but it might be a supply issue on different incentives of risk-taking within the credit supply, and this could be within observable characteristics and unobservable characteristics. And the last point, which I think is missing in your analysis, is that in order to understand better credit supply and credit demand, this is not like the typical thing in econometrics that you have one variable and you can do group fixed effects. You have not only credit volume, but you have non-credit, non-volumes, like pricing, like collateral, like maturity, which are very important to understand credit supply versus demand.
Last question.
Hi, my question/comment will echo what has been said before. The your method seems very complicated, but as an alternative, why not just do old school standard cluster analysis? Because essentially that's what you're doing. You're coming up with some groupings, reduction of a large dimensionality into groups for which we don't really know the label. So we arbitrarily label them with small, the group 1 could be small banks, group 2, large banks, then high capital ratio lookup. But a cluster analysis in step 1 would do the same thing. It would cluster the cloud of firms into groups that look similar, and then you can run your regression with cluster-specific or group-specific fixed effects. So that would yield very similar results, but would be more simple.
Okay, thanks. 2 minutes. What you can reply to?
Yeah, no, thanks a lot for the question. All very well taken. I mean, those are issues that we are always thinking and see how can we improve on them. So on the number of groups, yeah, I mean, our preferred approach is to try to just see how the results change for different numbers of groups. For instance, for the real effects regression, which are from G equal 2, we already find an elasticity which is around 5%, and we're still going up, and we find something similar. There is always an issue that as you increase the number of groups, then you're going to have every time less firms inside a group, which is going to affect your power on estimating the effect. So everything works nice theoretically, and we have kind of the theorems to show that it works. But in the end, in the practical case, yeah, it's hard. I think that the best approach is just to try different numbers of groups and see the results, see how they change, see how firms start changing the groups, I mean, in terms of the characteristics when the groups are changing. So that's something that we kind of explore in the paper. But yeah, I mean, completely well taken that type of concern. It's yeah. Then yeah, I mean, it would be, I guess, something that we try to do on the covariance of the effects, like the supply and the demand, and how important that covariance is. Yeah, we're not computing that, but we could. Something that speaks to that is the last exercise in which we do this counterfactual when we start matching banks and firms differentially. So if the covariance was not important, then that aggregate effect wouldn't be that important. So if banks and firms are not creating connection in a way in which these betas are larger or lower, then that wouldn't be that important. If it does, then it would be important. That's why we kind of a different way of going into, I think, into that direction. But we should be computing those covariances and showing them. Of course, contracts are more than volume. They have maturity, prices, and all of those can help us identifying supply versus demand, and we should be doing that. I think most of the literature relies on just using volume because that was kind of what we have better data. Now I think the new data coming from credit registry have better prices data, and there are some people that are actually going into that direction to try to improve this distinction. So yeah, completely. And on the method of the clusters, yeah, I mean, I think what you're saying is let's use the observables to cluster firms across observables, and then see if banks specialize across those clusters or not, right? We're going the opposite way and say, let's see how banks are treating differently firms, and we're going to create the clusters by looking at how differentially banks are treating different set of firms. And then we can go and look at the observables. And also a big point is that maybe the clusters that matter are not driven by the observables that you have, maybe driven by other things, right? So that would be our...
Thanks very much to everybody. Now, any housekeeping announcements, or we just move on to lunch? Move on to lunch.
Should we start? Should we restart? So welcome back to the conference. I hope you had a great lunch break and opportunity to chat among each other. So we're going to start the session on climate risk and banking. It's going to be 2 papers. The first one by David Marquez Ibáñez and the second one by Andrea Polo. And Omar Rakedi and Sergio Mayordomo will be the discussants. So like before, you have paper presenters, you have 25 minutes, discussants 10, and hopefully lots of questions for the 5 with the floor. So David, let me just open your presentation. Yeah, control that, right? Yeah. No? I guess you heard. Did you hear me before? More or less? Well, we're just starting the next session on climate. David.
So can you hear? Okay. Loud. Okay. I'll speak extra loud. So thank you very much to the. No, yes. Yes? Now yes. Excellent. So thank you very much to the organizers both from the Bank of Spain and. Sí, sí, están aquí.
¿Están aquí? Ah, ¿por qué no se ven los slides? ¿Ahora se ve? No. Sorry, we see the slides in this master laptop, but they're not there. I don't know why. No lo he tocado, pero esto solves the issue. Okay, now solved. Solved. Great. We finally start. David.
Okay. So I'll be a bit quicker. So thank you very much to the organizers, both at the Bank of Spain and CEMFI, for selecting our paper. This is joint work with Patty, which is currently at Columbia, but she's moving soon, and Emil, who is at MIT Sloan. Now, the question of this paper is pretty simple. It's very intuitive. The idea is, can we actually rely on banks' promises to solve climate change? So that's very much what we wanted to. Now, as you probably know, there is a massive need for financing to finance the green transition. And the question going back to the issue is, can we rely on private actors to bridge this gap in the absence of other direct policy tools? That's in a nutshell what we wanted to look at. So, in a way, we are not dogmatic as to whether we should use other tools. In fact, we think we should use other tools. But the question is about this idea from Mark Carney and other actors, in which they seem to think that relying on the private sector is the way to go forward, rather than other. And there is good reasons for that, no? Because you might think that this is a global problem, so maybe you need a global alliance. And in fact, banks over 70 trillion in assets have made pledges. In this case, we focus on the net zero commitments. This is about twice US GDP. And again, our idea is whether these net zero bank pledges contribute to decarbonization. Now, Let me tell you a little bit about these promises. So banks select targets at the sectoral level, which vary across banks. So you know, if you're a whatever Santander and you're exposed to certain industries, then you focus on those industries, and then you focus on the reduction of scope 1 physical intensity by 2030. Now, in terms of contributions of this paper, this is the first paper to study sectoral targets and commitments. There is some other work on the syndicated loan side, and there is other work by colleagues at the ECB looking at other dimensions of this issue. Something important is that we focus on the use of proceeds effectively. So one question is, what are they doing with the money? You get the funding, but what are they doing with the funding? Before I continue, let me just say that the origin of this paper. So 4 years ago, after the Paris Agreement, we did a paper with colleagues on the policy side, 4 colleagues on the policy side, in which we showed that there was a reduction in lending on the relative side, you know, the relative sides of lending to brown sectors. Frankly, you know, we wrote a box EU, and you know, the policymakers were happy, etc. But I was not very satisfied, because effectively we saw that there was an increase in lending to brown sectors. So we were I was a little bit uncomfortable. So I was very happy when Pari and Emil asked me to revisit this issue. And I have to say, we did not have an axe to grind. We had no views ex ante of what we are going to find effectively. So we let the chips fall where they may, and we focus on this. Anyway, so this is an example of the net zero target for the Deutsche Bank, and in this case, Deutsche Bank have a net zero targets in 4 key sectors. So what do? We use administrative data sets from the ECB. They include, now, this is 4 years. We've been working on this paper for 4 years, and we've been working on this for a very long time, and tried to understand actually what was actually going on. So effectively, we use global lending by sector. I think the global component is important, because obviously you could effectively lend outside the euro area. We have bank firm credit registry, which is one of the perks that we have from the creation of the SSM, thanks to our former Governor Mario Draghi. And then we have a credible measure of banks' portfolio exposures. We have other things that I'm not mentioning here. For instance, we know which bank belongs to whom, which might sound trivial to you, but we have to use three different data sets to do that, because sometimes the banks have different incentives regarding the size or the exposure that they have, and that would be a paper in itself. Anyway, now, the empirical setting is the Net Zero Banking Alliance, a little bit about that afterwards. The key finding is not much. So it's very much business as usual. So there is all this fanfare and talk about the pledges from banks, but we do not see a differential reallocation of banks making the pledges versus other banks. We do see a aggregate reallocation away from brown into green, but it seems to be driven by credit demand rather than credit supply, which is what you would expect if that was the. So our policy implication would be limited economic impact of these promises. Okay. So we have global lending. Again, I will go relatively quickly on the ingredients, but we have 330 banks. They are all large banks, so we try to make banks as comparable as possible. We look at the pre-trends of these banks in terms of their lending. And we have an accredit, so we have all the exposure. And we aggregate the data at the parent level using the ECB group exposure. Let me tell you a little bit about the Net Zero Banking Alliance. Now, why did we take this specific alliance, as there are other alliances? And this is by far the better organized and a more comprehensive alliance. And according to the members, it would be the more stringent. But of course, we double check our results with other alliances as well. And now, the key, when you look at whether banks are going to be the ones driving the green transition, would be, so you could actually drive the green transition in 3 ways, right? Either you stop lending to brown, more toward green, or you engage the borrowers you are lending to invest in a more greener fashion, or you actually look at actual issuances. So effectively it would be the divestment versus engagement. Now, the Net Zero Alliance requires banks to set sectoral targets, and there are some requests in terms of they have to be the most emission-intensive sectors in the portfolio. We have some interim targets and some long-term emissions. Now, let me show you a little bit of what it looked like. So we have the signing dates. The majority of banks sign in 2021. Column B, you see that there are a number of targets, and the majority of the sectoral targets appear in the usual suspects of power generation, etc., etc. Now, what are we looking at? The first thing I'm going to look at is who promises what, where. So the first thing is you're promising something. Are you promising of something you're doing something about? Then I will look at divestment versus engagement with a special focus on demand versus supply shocks. Now, the first point, who promises things? So, and the banks who promise are mostly, but not only, the largest banks in general. They are banks who have more exposure to brown sectors and less exposure to the green taxonomy. So there seems to be evidence against green selection into commitments. If anything, it's very clearly brown selection into commitments. So you're already lending brown, and then you promise to maybe behave a little bit better in terms of lending less to brown. So this is the global lending across sectors by banks. This is just descriptive statistics, but the bottom line, if you compare, which is difficult, so I'm going to tell you the story. Effectively, you do not see a differences when you look at the aggregate lending between NCBA banks, effectively banks who promise to do something, and non-NCBA banks in terms of lending to the major sectors. Now, you go, well, so you are telling me that there's nothing much going on, but what happened in terms of actual emissions? And it is crucial to understand that there is no obligation as to now for banks or firms to provide actual information on emissions. There's a new directive by the European Commission, which has been watered down tremendously recently. So we do not have the data on emissions. The ECB calculates some data on emissions effectively, but so we spend a fair amount of time looking at verified emissions using a cap and trade scheme. So this was a tremendous. Effectively, what I'm showing you now is that not only banks lend less to brown, but we don't see a differences in terms of NCBA and non-NCBA borrowers So effectively, if you're an NCBA bank, what happened with your main borrower? And we do not see that borrower is borrowing from NCBA versus non-NCBA bank experience a different behavior. Now, let me go in the next 5-7 minutes straight to the results. So let me see, maybe we could even show something here or no? No, there's no pointer. Okay, anyway, so let me tell you the story. Effectively, what we look at here is... yeah, maybe we could do that, yeah. So effectively, yeah, here we are. No, we are not going to use this because this is too complicated. Or maybe not. Yeah, anyway. So the bottom line here is like, here we are only looking at banks who already select. So the question is, in which sectors bank that already select are they focusing on? And we see that this is the bank's targets in sector that they already have more exposure. And if you look at columns 3 and 4, it is not due to credit risk consideration. The next question is what happened with credit? Exposed. So here we move from the bank level to the borrower level, and we move on to all banks. And then what we see is that banks effectively, we look at the intensive margin, and then we see what happened in terms of what happened with banks, and banks when they joined the NCBA, lending to a specific target. And you see a negative sign. If you look at column 1, you see a negative side. Also, when you incorporate firm and time fixed effect. So there is a decline by NCBA banks to firms operated in targets that they have targeted, in areas where they have targeted. Now, the question is, okay, so this is good news. It's very similar to what I found last time. There's a decline in lending. The question is, we do not see that there's an increase in exit, but there is less lending to those brown sectors. Now, so fine, NCBA lenders reduce credit on the targeted sector. Now, the magnitude suggests that we are exaggerating, broadly on track to meeting the targets. This is hard to say. I would say they are slow off the bat, but anyway. The question is this because NCBA? So effectively what you need to compare what's going on banks who have signed versus banks who have not signed. Meaning, you need to have an understanding of the differences in lending by NCBA banks on targeted versus non-targeted sector and compare the two, right? So you need a benchmark effectively. This is a triple diff in diff, and then we cluster at the bank level. So it's fine. Yeah, so effectively we are comparing lending to firms in targeted and non-targeted sectors after a bank adopts NCBA relative to non-NCBA banks. So if I'm signing, sorry to repeat myself, but effectively what we're looking is, I want to see the effect of NCBA on targets versus the effect of non-NCBA on non-targeted sectors of both banks. So, and again, what we find is interesting. So we initially find that there is a decline in lending to the targeted sectors, but when we incorporate, and you see on the below, firm time fixed effect, the effect disappears, which means there's no supply effects. There seems to be no supply effects, so it's mostly linked to demand effects, which bodes well with what we find, because we also see a decline in interest rates when we incorporate firm time fixed effect in our estimation. So effectively, we do not find that NCBA has been leading to a decline in the supply. So we don't see a differential effect. So basically, you're promising something, but we don't see much action compared to people who have not promised anything at all. Now, you may argue, well, the second part of the paper, but what happened with the borrowers? What happened with the borrowers in which they have set up a target? So maybe I'm lending less to Sergio. Maybe I'm lending less to Sergio, but if Sergio has promised to behave very, very well afterwards, what happened afterwards in terms of quantities or interest rates? And something similar happened. The moment we incorporate firm time fixed effects and we look at demand in this way, we see that there is no impact on the demand side. Now, you may argue, well, okay, so you are lending less to brown, We don't see that you are lending more to well-behaved, potentially borrowers. But what happened with the money? Where's the money going? And then we look at project finance. And do banks lend more to green projects? So we look at project finance, which we could identify through an accredit. And we identify the bank's share of renewables in project finance. And both in terms of bank share and the logs, we see that there's not increase in lending by NCBA banks. We see an increase in project finance in general, but not to renewables. This again, the increase in project finance is related to demand, blah, blah, blah. But just let me conclude with something which I think is interesting, that we use the only measure in which we have verified emissions through the ETS verifying scheme. So we go from the plan level to the borrower level, and when we see what happens after your main bank joins the NCBA. And we see no increase on firm emissions if your main bank joins the NCBA. We do the same thing with sectoral targets, and we do not find much either. So effectively, we use this administrative data set to explore whether voluntary commitments led to changes in lending behavior, but we find no evidence that this is due to systematic divestment or engagement by lenders. So we conclude that there is limited economic impact on the voluntary net zero commitments, and we believe that this supports recent efforts by government to improve the credibility, but also we actually need data. So if we don't even have data on emissions, it's not possible to have a solid assessment. Thank you.
Thank you very much, David. We're going to move to the discussion by Omar Rakedi from ESADE. Here. Let me make sure you see.
Perfect.
Yes.
So, thank you so much. Thank the organizers for giving me the opportunity to learn from the paper of David and co-authors. So, again, like what the paper looks like is like the impact of voluntary bank net zero commitments on lending, and leveraging the granular data that the ECB has, and also important, also looking at global lending patterns, looks at the effect of these voluntary commitments, and find that basically they do not generate anything, okay? So similar to kind of greenwashing, these banks say, we're gonna do some good stuff, they don't, but still then they benefit from higher ESG ratings, and then potentially also on lower funding costs. So, like, this is a very nice paper, even though they're telling an unfortunate truth. Like David and co-authors take a lot of effort in thinking how to address this question. I'm gonna focus on some little room of improvement to make the paper even better. But like, if you have to take two main points out of this paper, is like, first, there's an important paper, the one of David and co-authors, on finally checking whether banks walk the talk. And the answer is they do not. Okay, so this is like the two things you need to bring home from this paper. So the first part I want to talk about is the identification strategy. So basically what they're looking at is a triple difference regression. And basically what is the triple difference doing is comparing how lending to targeted versus non-targeted sectors change after before and after these net zero commitments, and whether this change is different among these banks that make these commitments relatively to all the other banks. Okay, so this beta 1 captures this triple difference. Now, this triple difference, that why they are doing this triple difference is like this is a way somewhat to tackle these banks' endogenous decision on which sector they want to target whenever they want to reduce their lending to some polluting sectors. Now, in a simple diff and diff, the idea is like absent treatment. The idea is like what is the main important assumption is this parallel trend assumption, that is the outcome evolution in the treated versus untreated would have been the same. And this is valid when either treatment is random or it's like as good as random, conditional on observable, or somewhat driven by some exogenous shifts. Here the problem is that this is instead an endogenous decision, and so this could bias the estimate, and that's why David and co-authors rightly put this triple level in order somewhat to help out absorb part of these confounding trends. And so the first thing I want to say here is that however, the problem is that what this triple difference and difference setting does is allows to make this ex-ante parallel trend assumption to be relatively more valid. But the problem is that since this is an endogenous treatment, what cannot capture is kind of forward-looking behavior. So that the banks think that these sectors, some sectors going to have some moving forward different expected trends, and therefore this will be violating still the parallel trends assumption. So a way somewhat to deal with that will be to focus on say the common set of sectors among all banks, say power generation, because this is most banks target power generation. So rather than allowing banks somewhat to play on which sector to target, if you were to make a subset on the banks making commitments only on power generation, at least there you're going to take out any concern related to targeting endogenously some subsectors. Now, so in this way, absent any issue on the membership to the Net Zero Bank Alliance, in this way, the triple diff and diff will be a valid approach. However, the problem here is that what this approach does not tackle is the endogeneity, the further endogeneity of joining the alliance. Okay? And so this is a strong selection, like those that make this alliance are 10 times larger in total assets. This is a diff and diff between 2018 on. A lot of things happen, especially in 2020, and like it's very hard not to think that banks that were 10 times larger than others have been going through the same things throughout these years. Now, a way somewhat, the way I suggest here, a way to wash out this concern is somewhat to take out, to reduce this concern on this endogeneity on joining the alliance, and way would be somewhat to instrument it. So a way to be instrumenting would be potentially to looking at the orientation of the board members. So Di Giuli and Kostovetsky, they look at, for instance, the political orientation of founders to see whether firms make zero net commitments. This would be a similar approach, but in this case, focusing on the board of banks. And so instrumenting NZBA decisions will allow you, to take out this endogenous concern and therefore to make the approach relatively more valid. The second point is more on the fact that this is a staggered approach. That is, banks has been showing in the histogram have been joining at different times from 2021 on, even though most of them throughout 2021, but still adoption is staggered. Now, I would like to see a bit more details, especially on what is the sample of banks, what type of banks you're actually considering. But what is the problem with the staggered approach is that, all the new diff and diff literature, what it tells us is a mess. That is, what you are capturing is not the average treatment effect, but it's a kind of weird weighted average of the different treatments in which some weights can even be negative. That is, usually if you have like different treatments, you could think, okay, those closer should be mattering more, like weights are larger, those far away in time should be mattering less, weights are close to zero, but in this case there are also negative weights. And so here what the literature is telling us is this is an issue that biases the estimates, and there are alternative approaches to deal with that. One is, for instance, to use this group time average treatment effects of Callaway Santana. Santana has been studying with me, so I'm pushing his research. Another way would be, this is a conference jointly organized with CEMFI. It's looking at a paper of a CEMFI professor, is to use synthetic diff and diff as in Dmitry Arkhangelski and co-authors, but somewhat to kind of tackle the issue of this staggered treatment. The third point is on the interpretation results. So here what you're seeing is the lending share to, for instance, mining goes down in both net zero banks and all the others, right? And so the fact that there's no effect, right, one way to think about it is that it's not that there's greenwashing, but rather than greenwashing. That is these banks that do not announce that they're going to cut on brown firms, but then they do. And so once you're taking this difference into the regression, you find no difference, but it's not because the banks that joined the alliance did not cut, but rather is that the other ones cut nonetheless. No? So this is to say that the zero result is unclear on what dimension it directs, whether on greenwashing or greenwashing. And the last point I want to make is like, okay, so making these commitments are fantastic. You're saying you're going to save the world. You will not. It costs zero, makes you enjoy higher ESG ratings, lower funding costs. So the question is like, why not all banks do that? No? So something that I would like to see maybe a bit more discussion will be along these lines. And I mean, since they're not stopping me, I can go in the last slide. Would be like, 1 minute would be, okay, so there's also some potential for like further heterogeneity here, no? That is, maybe if you're a bank in which many of your customers are connected to the brown firms in your portfolio, I mean, we know from Janetti's ID that maybe you want to take into account your entire portfolio, and so maybe what you will do is like you will try to cut to brown firms which are not connected to green firm customers which are on your loan portfolios. And so here maybe you can exploit input-output linkages to test whether this is somewhat a potential action mechanism in your data, and that's it. I'm done. Thank you so much.
Thank you, Omar. Maybe I could gather some more questions before and you answer all of them together. Is there any question from the floor? Immediate reaction? No? Yeah. So you want to answer? Okay. Sure.
And also, just to make the point of Omar more clear, is that maybe when you don't have a substitute, you cut it. When you have the other substitute, because these are all European banks, they are all cutting. So then within a time fixed effect, you wouldn't find the effects. But they are cutting, they are cutting, they are cutting. And you find the cutting when you don't have an alternative bank.
Tough job. Yeah, Luis. Let's give some time to David to respond. I don't see more hands raised, no? David.
So thank you very much, Omar, for the very thoughtful discussion. I think you raised 2 key points, which are also connected to what Jose was mentioning, which is the first point is that, look, they are all declining lending to brown anyway. And that's true. There's no way for us to check that out. So this is something we don't look at. We look at the differential behavior from those who promise versus those who don't promise. So this is something we don't look at. And I'm very sympathetic. This is 3 years' work in terms of looking what's going on. I'm very sympathetic to the political economy. And I think the political economy is something to be worried about, because the trend seems to be on this direction, but something which I think is natural to ask. What will happen in Germany, for instance, when certain political options will take power in terms of the brown versus green? So this is also attached to that. No? So, okay. Now, regarding the actual comments that Omar had, very quickly, so it would be incredibly unlikely that there is a demand shift at the time from the borrower side at the time that the NCBA banks join. So we have pre-trends for joiners and non-joiners, and we see not much, we don't see much. We've done Santana, we've done Staggered. We also have compared the results with early joiners, so just the banks who joined at the very beginning. And something I didn't show you, which speaks to our results, is that we see that the impact is much higher if countries implement other policies. So we classify European countries in those more stringent and less stringent, and you do see an impact. The same way that after the Paris Agreement, you see a relative change in the behavior of US banks after Trump withdrew on the Fed, so the political economy again. And Professor Hasselmann had a very good point, I think, which is, look, some of the banks actually withdrawing, and I'm not sure, but in the German press, there was a big complaint by the chairman of both the UBS and Deutsche Bank, said, look, we live on the real world. We do not live on the NCA world, which means that it's costly for them to join in terms of maybe political economy, but actual lending they're doing. Thank you so much again for the great discussion.
So let me thank both David for the excellent discussion, excellent presentation summarizing 3 years' work, and Omar for the excellent discussion. And we move to the second paper of this session by Andrea. Is that one? Yes. By Andrea Polo on climate risk and lending and monetary policy. Can we have them? Yeah, here. Would you need the pointer? No? Okay, no.
Okay, many thanks for the invitation. So the paper fits well from the title, you see, fits well with the previous one. So the two research questions we're asking is whether banks incorporate, banks independently whether they commit or commit, no? Going back to one of the comments, incorporate this climate risk in their lending decisions, okay? And whether monetary policy change these, if there is a climate risk premium, so if they charge more, the brown firms, whether monetary policy changes this. Okay. And this is relevant because we understand whether banks help us with this climate transition, and whether central banks, on the other hand, can do something to support this role of the banks. So specifically, we ask whether banks price this climate risk, and exactly in the same definition of the risk. So we're thinking of transition risk, so we're thinking of carbon risk versus physical risk, when granting their loans. And in general, we don't assess only whether we're looking at the current emissions, but also we're interested in the forward-looking emission. Okay? So the plan to reduce emission, whether these two different measures of climate risk are priced or not. And in a sense, we will also dig a little bit into this issue, whether the banks which commit, they do these things differently. But then the central question of the paper is whether monetary policy affects this pricing of climate risk, and so in which direction. So in a sense, we are going to check whether there is a so-called, such a climate risk-taking channel of monetary policy. Okay. There are many models of risk-taking channel of monetary policy, and maybe we can extend to encompass this climate risk dimension. Okay. If this is the case, monetary policy expansion, banks lend more, they reduce rates, and they will do this more to brown firms, which are the riskier firms. No? So there is a lot of evidence that security markets price climate. No? There is this big debate on greenium. Now there are recent surveys where they say, okay, basically we can conclude that in many of these assets there is these greenium, stock market, option markets, bond markets. For credit markets, the evidence is a bit limited because we know something, but this is for syndicated loans. Now, syndicated loans in Europe are around 10% of credit markets. And here also for syndicated loan, there is a paper by Stephen Ongena who say, no, there is not. If you compare bonds and loans, well, there is not much in loans, there is in bonds. While another paper says, well, no, after Paris Agreement, we see something. The issue of commitment, there is, again, a bit of debate, because so there are papers like the one of Caterina here and Maria Assunta, which says, well, when banks speaks a lot about this issue, they actually don't walk the talk. in a sense in line with this net zero alliance of David. On the other hand, José Luis here is a paper where instead they find that the one after the Paris Agreement, the one which the commitment via SBTI, which is a different type of commitment, this seems to be actually associated with reduction in lending. And as far as we understand it, there is nothing on this issue of monetary policy, whether monetary policy has an impact on these things. Okay. So risk-taking channel on monetary policy, the idea is that when there is monetary policy expansion, banks lend less, lend more or reduce rates, and they do this more to riskier borrowers. No? So there are several theoretical reasons. There is no one theory model of this. There are this paper of Acharya, Naqvi, which says, well, if there is abundant liquidity and the loan officer is related to the pay is related to the quantity of the loans, is abundant liquidity, this guy will reduce the monitoring effort, lend to the marginal borrowers, which is riskier. But there are other models based on the sticky rates. For instance, when rates goes down, since banks or institutions have a target, then they, in order to get yield, they go to higher risk. There is plenty of evidence of this now in this institution, with data from this institution. There is this famous paper which says that when interest rates went down, less capitalized Spanish banks lend more to riskier borrowers. And there is now this paper which is more related to us, this Anderson and Cesabianchi, say when there is monetary policy tightening, credit spreads go up, and they go up more to riskier high leverage firms. Okay, so here the prediction is that maybe we can expand to, if there is a risk, this climate is risk, maybe we can expand to climate as well. So, and therefore, here what we think is that, well, okay, then monetary policy tightening should be more restrictive for the brown firms rather than for green ones. So these are unaccredited data from September 2018. Remember, this is the first moment where we have this data to December 2022. For each credit, we're interested in interest rates, in price. Going back to this question on this morning, whether price and quantity, we're interested in price specifically. And we're interested in a measure of risk, of traditional risk, because we want to control for traditional risk. We don't want to capture traditional risk. And so we also have the PD, the probability of default, the banks attribute to the borrowers. And then we merge this with data from Refinitiv on listed firms, emissions, so current emissions, scope 1, scope 2, but also their plan, their declaration that they will reduce or not their emission. Okay? Now you can say, well, a declaration by the firm to reduce, this could be cheap talk, where there is now a paper by Bolton Kabersinski, just published on the Management Science, which says, well, actually the one which, the companies which declare they will reduce in this carbon protocol, actually we see a reduction in emission afterwards. And they find that in Europe, there is a higher, so firms tend to declare more if they are the emitters. So the high emitters, so the polluters are the ones who do declare more that they will reduce. Then the funny thing is that globally, so if you go North America and Asia, they find that the ones which declare that they will reduce are the ones that don't pollute much. Okay, so this is different in Europe. Okay, we complement this data on banks commitment. Since at the time there was this paper, the Kabersinski-Pedro, and Kabersinski-Pedro were using this SBTI commitment, we use this SBTI commitment for the banks to see whether these banks committed. And this is a kind of this is a commitment which with medium target, there is an external validation, and we look at this, whether this matter. And then for monetary policy, we look at monetary policy shock, high-frequency monetary policy shocks. Okay, so descriptive statistics here, the only thing I want you to pay attention on is that, so we're talking about listed firms, okay, in Europe, so and we're looking at the spread, so spread meaning that we remove the reference rate, so interest rate, but we remove the reference rate, and the average is 150 basis points, and the standard deviation is 76, okay, so it's pretty compressed. And carbon, so it's interesting to see that in Europe, the 90 percentile of emission is 0.5, which is thousands of tons divided million of net revenues. dollars, it's 0.5. Now, if you go globally, it's 1. So the European companies are the one which pollute less. Around 58% of our data our firms commit to these to reduce targets in the future. Okay, so if we don't do anything, if we don't touch the data, and we just look at the interest rates between these two different groups of firms, on the left-hand side, we see firms with high carbon emissions and low carbon emission, and we find that the spread are lower if you are a green firm. Okay? So firms with low carbon emission is the green one. The same if you have a target. So if you declare a target, the rates are lower than the companies which don't declare a target. Okay? Now you see a spike. The spike comes in 2022 due to the increase in interest rates, and the spread went up. Now, what is the size of this? Is the average is around 14 basis points in the first graph and 20 basis points in the second. Then we want to do this in a regression, and we control for PD. Now, hold on this. I've lost a lot of my nights on this, so I'll come back on this, on why controlling for PD, what does it mean. So we want to control for a measure of risk, okay? But let me come back on this. So if we control for a measure of risk, so these two variables go in the opposite direction. So if you have high emission, you have higher interest rates. If you declare a target, you have lower interest rates, okay? And if we multiply these two, we find that this mitigating effect of declaring a target is particularly large if you have high emission. Okay? What are the economic significance of this? So 4 basis points for high emitters, 10 basis points for firms committed to reduce emissions. Is it large? Is it small? Well, I told you that the standard deviation of this is pretty small, 76 basis points. So in percentage of standard deviation is not trivial. And the other thing is that this is in line with the other papers that we have on greenium, for instance, in syndicated loans, which is around 7 to 10 basis points, or in bonds, which is around 6 basis points. Okay. Now, so we have a series of fixed effects. So bank fixed effect, time fixed effect, industry location size, the same sector, the same size, at the same, for the same industry. And then also industry location time, firm fixed effect, we cannot put firm time, because firm time is exactly our variation. Okay. Now, let me say this, why sometimes I didn't sleep. PD. So I want to control for PD. But what if PD already incorporates climate considerations? Right? Because PD is the probability of default. So what is transition risk? You are afraid that in the future the government come in, put a tax, and this company suffer and they cannot repay. Okay, there are some theoretical reasons for which I could take some sleep, because the horizon is different. So PD is defined as the probability of default within 1 year. Now you may imagine that climate risk has a much longer horizon. Now, there are no incentives at the moment to incorporate climate risk in PD, because the regulator is not asking you so far to do that. The other thing, how do you do it? So banks, this is what they say. Maybe you would like to do, but how do we do it? PD is a Z-score. Z-score is a statistical method based on the past. How do I incorporate this? I add an epsilon. Empirically we find zero correlation between PD and these two measures of emissions. And then if we remove PD or we put firm observable, we find similar results. So I got a bit of sleep afterwards. Now, commitment. So our variable, we want to see whether there is a bit of heterogeneity in this pricing of climate risk by banks. We commit with SBTI, and we do find that, in fact, the effects are larger for these banks, around 16 basis points less for uncommitted banks. In lending to firms with target for the committed banks, so it's a type of for committed banks with a target, and a bit more for firms with high emission. But then let me go to monetary policy, okay, which is the central part. Now, the question is, when you increase, so you have monetary policy shock, you should increase rates, and in the first column, you will see that by monetary policy, you increase the spread, okay? So the spread go up for everyone. Then traditional risk-taking channel of monetary policy, let me do the interaction with PD, so the traditional type of risk, and we find that this is significant in this direction. So you increase the spread in particular for the riskier borrowers, the traditional risk-taking channel of monetary policy. Now let me add instead my variable, this climate risk variable, on top of the one on the PD, and we find that also there we find significant results in the direction that we expect. So that is the increase in interest rates has a bit of an additional rise in premia for high emitters, 1.4 basis points, and 5 basis points smaller, mitigating effects for the firms which declare that we reduce emissions, so opposite direction. Then we say, well, monetary policy maybe it is not just on impact, okay, maybe it's with lags, and so we look at local projections. And if we look at local projections, what we find is that, so the first graph on the left is just monetary policy. So when there is monetary policy, do spread increase? Yeah, increase at the beginning, so 25 basis points lead to around 40 rise in premia, and then so 40 basis point premium after 12 months, so increase a bit and then it goes up. There is an additional 2 basis points for high emitters, and 5 MTP as basis points, as we already seen, for the firms which commit, which goes up to 9 basis points after 1 year. Then the other question is that this is price. What about quantity? Well, I still have 10 minutes, I speak too fast. I can drink.
You don't need to stop. Go on.
We can start talking about something else.
Go on.
So then the question here is to say quantity, no? Why quantity is important? Okay, we start the paper on price, because there is this greenium. But then, of course, quantity is important, because going back to the point of José Luis before, price and quantity in banking helps us to say something about where demand or supply. So we look at quantity and we find a similar picture with the opposite sign. No, but we don't find much on impact, but we find that there are lags. So 25 basis points increase with the first picture. There is a negligible impact on impact, negligible impact effect on impact. But then there is a reduction of 2.5 percentage point after 12 months in general, for everybody. And then there is an additional 2.7% drop for high emitters after 12 months. And instead a mitigation, so you remember always with the opposite sign, no mitigation of this effect for if you are a firm which commit to reduce emissions. Okay. Now, the question is that monetary policy shocks is an identification strategy that we know we are using a lot, because it's the frontier, but there are also concerns with the high-frequency identification shocks. So what if we do a different strategy, that we take the change in the monetary policy stance in December 2021? Remember, the cycle starts in July, but the first time that the ECB signaled that it's going to change the monetary policy stance is the quantitative tightening of December 2021. And here again, if I do the same results and I look at the spreads on the polluters and the spreads of the firms that wants to declare that they will reduce emission, we find they go up for emitters and they will go down for the one which declare that they will reduce emissions. Now, a concern, I think it's a nice identification strategy, but I had the concern, again, lack of sleep, because I said, well, there is a climate stress test. The climate stress test is exactly in 2022. But the nice thing is that, so I have a student at the Bank of Italy who is doing the PhD, and she's working on climate stress test, and the announcement of the climate stress test is in November 2020, so outside the my pictures. When the ECB for the first time published this guide on climate-related environmental risk, and in this document they say, pay attention that at some point we will do a climate stress test. And she finds that there is a reaction exactly on the month of the announcement. The other thing is that in the climate stress test, of course, all the significant banks were involved, insofar that all the significant banks had to send these questionnaires to the ECB, but actually the banks which participate to the actual stress test were only 41, and we removed them, and we still have the results. Now, the last picture is this. For the first time, in July 2023, the ECB, in the bank lending survey, added a question about climate risk to the banks and say, well, what do you do with this about climate risk? And I mean, of course, I do not have a time series, no? I have only one data point. But this is July 2023, and they ask, what did you do during the last year? And the last year has been a year of very high interest rates. And what they say, terms and conditions, this is basically price. Credit standards, this is, you can think basically as quantity. And the black bar is the net percentage. So it's the difference between the percentage of banks that declare tightening and the percentage of banks that declare softening. So what we see is that there is more tightening from brown firms and instead expansion to green firms. And with the data at the ECB, we could also see which banks were doing this more. And in fact, in particular for the green firms were the banks which committed via SBTi to do this more. Okay, so let me conclude. So we find that these banks charge higher rates to firms with larger emissions in general and lower rates to firms to commit. And the commitment via SBTi seems to matter insofar as these banks do it a bit more. And we find this evidence of this climate risk-taking channel of monetary policy. What is the bottom line? Why this is relevant? Remember that at the point of the ECB, when there was a tightening in 2022, one of the concerns, there is this famous speech of Isabel Schnabel, one of the concerns is that by increasing rates, there is the chance that we stop the transition, right? Because you increase rates, everybody suffers, and firms who need to do the investments to move technology, they cannot do it. Now, what we find is that, well, yes, it could be the case, interest rates go up for everybody, but via this climate risk-taking channel by banks, the ones which are more penalized are the brown firms and less the ones who instead want to decarbonize more. Many thanks.
Thank you very much, Andrea. Let's move to the discussion. I believe it's this one. Yes. By Sergio Mayordomo from Banco de España.
Thank you. So thanks a lot to the organizers for the opportunity of discussing this paper. I think this is the third or fourth time that I've seen this paper, and they have addressed a lot of the comments that I've seen, so it's not difficult to do this discussion. So the paper is great, because I think this is the first paper that considers not just climate risk, but also monetary policy. So the two main research questions and the answers, the first is, do banks spread climate risk? And the answer is yes. Not just current climate risk measures, which is measured through the emissions, but also future exposures, which is measured through the targets, to the commitments of the firm. What is very nice is that the effect is stronger for banks that are committed to do these environmentally responsible lending policies. And the second part of the paper, that to me is the one that contributes more to the literature, is the one that considers a new climate risk-taking channel of monetary policy. So it extends the standard risk-taking channel of monetary policy, and what they find here is that when there is contractionary monetary policy, the cost for brown firms increases, the quantity that they can obtain decreases, and the efforts, in some sense, are milder for the firms that are committed to decarbonization. So I think that this is the very nice contribution. This is very unique in the literature. So I have three comments. The first one are related to the first part of the paper. So when the authors study climate risk and loan spreads. The first comment is a very easy comment and probably unfair, but it's true that all the measures trying to deal with the emissions and the climate commitments are firm and bank choices. For instance, the emissions, they are voluntary. In many cases, they are an estimation. So I'm not saying that is wrong, but probably you can do something else to deal with this. The firm target is also a firm choice. So you mentioned that there is a paper that showed that when there is a target, they commit and they decrease the emissions, but I think that would be nice also for your sample to show that they invest to reduce carbon emissions or that they are really reducing carbon emissions. The bank-related variable is also a bank choice. I mean, their commitment. No? I mean, the previous paper by David said that there could be some limits, no? Based on the commitment of banks for decarbonization. It's true that the measures are different, but I think that this is a common weakness in the literature, and I think that could be nice to exploit some shocks that are specific to some countries or exploit pressures affecting specific firms or banks, or something like Omar was suggesting before, no? To use some type of ESG orientation of board members in order to deal with these bank commitments. Another possibility probably is to use the data vendor estimated or the ones that David had in order to say, look, I have the same results if I use these self-reported variables or if I use a different one. So my second comment about this part is about the potential role of relationship lending, right? So I really like these results. The point is, if I focus on table 2, that is the one that the column that uses industry location size times fixed effects, that is the one that I like the most. The absolute value of the effect associated to the target, that is to the commitment, is almost 7 times larger than the one associated to carbon emissions. So the effect is 1 basis point, it's true, it's small, but the one associated to the target is very large. So my point is that probably banks are rewarding for setting climate risk targets. And this is very new, and this is very nice. So I think that the authors, in fact, have some nice results when they interact, the carbon emissions and the target, and this is very robust, and they say that there is an extra discount in the price there. So probably there is something related to relationship lending here. No? There is a recent survey by Aguilar and co-authors, a survey to bankers, and they say that they try to prioritize long-term relationships with their clients. So in some sense, they say, look, we are not going to get rid of the dirty clients. What we want to do is to help them, in some sense, to go towards a transition path. And this is something that is shown also in the paper. So it's consistent with this survey, and I think that probably it explains the differences in the results referred to the emissions and the target. And I think that probably you can test very easily, if it's the case, considering new brown firms. So when they don't have previous relationships with the firms, are they increasing the spreads or not? My second set of comments is related to the case in which they interact not only climate risk, but also monetary policy with these emissions and commitments. So my first comment is about the data aggregation. No? I mean, the dependent variable here is the interest rate of a given loan minus a risk-free rate. Depending on whether the loan is fixed or floating, we're talking about that over the lunch. They consider the fixed rate, they consider the swap with a similar maturity. For the floating, they consider the reference rate of the mortgage. Once they have this spread for each loan, they aggregate all of them through a weighted average in which the weights are proportional to the loan size. So the point here is that loans could differ a lot across countries, as we know, and across firms, so there could be a composition effect here, and I was wondering whether it would make sense to use individual loans at origination rather than aggregating the information in this way. So if the authors continue with this strategy of using loan portfolio, I think that there are some interesting controls that could be used here. For instance, the residual maturity of the loan portfolio, because the term premium could be different to the one observed for the risk rate. So there could be a risk premium in loan spreads. The loan age, the proportion of fixed, floating, and so on. My second comment is about the period that they use. No? I mean, they use local projections. I think that for using local projections, it matters, no? The length of the sample period. And as you can see in the left figure there, I don't know if it works, you can see that the vertical line refers to the end of the period. But there is a lot of tightening, right, after December 2022. So I think that extending the sample would help you in order to improve the local projection exercise. And what is interesting, probably you can consider the easing as well. My second point is in favor of the authors. No? You focus on the first figure, you see, in which we have the new bank loans, that is the cost of the new bank loans. Since January 2022 till December 2022, the cost increased by 200 basis points. But the authors are using the stock of credit, so they are using the amount outstanding. And if you go to the right figure, you see that it takes time, right? So, I mean, the period that you are using, you see that the increase in the corresponding interest rate when you consider the portfolio is just 70 basis points. So probably the effects are not so small. The issue is that they are referring to the stock of credit, and if you consider the new loans, probably the threat is larger. So 7 basis points based on this is like 10% of the increase that you see for the stock of credit. The other comment is about which is the real channel of this climate risk channel of monetary policy. So the authors say in the paper that when there is contractionary monetary policy, banks could increase the monitoring efforts to see the emissions of the firms, and then cut lending to the firms that are high emitters. So my point here is that they are large corporations, they are listed firms, so this information is public. So through which channel occurs this monitoring? Why is different to consider this in terms of firm heterogeneity? And the second is why emissions monitoring would be stronger during tightening of monetary policy. So the other alternative is to based on risk-taking, right? But I think that here it would be interesting to know that, I mean, probably brown firms are not riskier, as you say, but I think that one is here to split separately the climate and the credit risk. And I don't know, probably the PD has a non-linear effect, the one that you are using, and one could use, for instance, I don't know, industry location size, risk buckets, and time fixed effects in order to compare firms that have exactly the same level of credit risk. So in some sense, why good transition risk materialize more in monetary policy tightening? I think that's something that have to be better explained and addressed in the paper. Probably this is a reputational risk channel. My second comment is, my last comment about this part is you merge floating and fixed rate loans. So the floating are established before, so it would be nice to split them because, I mean, floating rates represent more than 60% of the loans granted. So they are very different. The way in which you clean them, the way in which you obtain the spread is different depending on whether they are fixed or floating. So I think that the split of these two types of loans would help to understand the results. Another comment is about something that you mentioned in the paper. No? You say that there is a slowed down investment aimed at reducing carbon emissions. So restrictive monetary policy could lead to this. So I think that this is something that you can test in the paper, and probably you don't do this, is just considering the triple interaction of the monetary policy shock, the carbon, and the target for interest rates and for quantities. And I think based on this, you can give an answer to this question, whether really contractionary monetary policy is slowing down investments or not. Also, the role of committed banks. No? I mean, you consider committed banks when you analyze what happens with the emissions and the targets, but what is the role of, let's say, committed banks in the transmission of monetary policy? And this is something that can be addressed very easily in the paper, and I think that it could, in some sense, complement the first part that you saw. And my last comments are related to the effect of quantity. No? Here, you saw that lending to carbon emitters declines for all banks, but committed banks decrease lending much more. So I think that you can align the findings with the loan spread part, considering this effect of commitment and so on. And in the BLS, it's true that you report separately green and brown, but I think that merging all of them and to show whether you obtain the same result based on some statistical tells would be helpful. So you find that there is not an immediate impact in terms of loan volumes, but it occurs gradually. And here is where you use the local projection. So I think that extending the period would improve probably the results in that part. And something that I found in this section is that there are no firm controls when you try when you estimate these local projections. So I think that the loan size could be correlated with some firm characteristics. For instance, the size, probably brown firms are smaller, and it explains the lower amount of credit, or if they are larger, probably they are able to tap funding in financial markets. No? So it would be nice also to see whether credit is reallocated towards firms with targets instead of focusing on the differential effect. In some sense, whether carbon emitters can substitute banks such that they can switch their lenders. This is something interesting. And that's all I have. Many comments here, small comments, but one is that I think that you have a great opportunity to compare your paper with the literature on syndicated loans, and then you can see why do they obtain different results. And there are many puzzles in the literature, and I think that with the data that you have, you can do a lot in those terms. So thanks a lot.
Thank you, Sergio. So we have now some minutes. Let me, before you prepare to answer, Sergio, let me gather some more questions. José Luis, there.
Yes, so one question is, thank you. So you're analyzing transition risk, not physical risk. I guess we are analyzing scope number one. So this takes time, no? And, you know, we might think, I don't know, 3 years, 5 years, 10 years. And the monetary policy, these surprises could be shorter, could be more 5-year forward guidance, or could be QE more 10 years. So it will be super interesting to see what these differential effects of monetary policy whether they are different depending on the QE, forward guidance, and short-term interest rates.
Any more questions? So while you prepare the next round of questions, let's give the floor to Andrea.
Okay, not to José Luis. So we use the target, which is the one which consider all the term structure, but give more weights at the short term. But we could look at the long term versus short term and see where the effects are. Wonderful suggestion. So many thanks to the organizer for giving us these excellent discussant. So these were all good points. So I just took a very long to-do list. So many thanks. So just a few clarification. So for instance, you mentioned this thing called the PD. No, the PD, of course, is given only by the RB banks, and but we take the average of the PD so that we don't consider only RB banks. No, we can consider all the banks. The important is that at least there is one RB bank, so that we can have that can construct the variable. This non-parametric. Controlling for credit via non-parametric is important, and you gave us suggested the way to do it. This triple interaction in a kind of speak exactly to the issues of the decarbonization and the monetary policy, which so it's a very nice way. We didn't think of this. The reallocation, is this coming from divestment? No, as David was saying, it's coming from the divestment of the brown or more investment in green. So we can also we can do this split versus fixed versus floating. So just a very useful list of super useful suggestions. Many thanks.
We still have a couple of minutes if you want to pass more questions. Any? No? Rafa.
Why is it that you are referring to transition risk and not the combination of transition and physical risk?
I don't think there is an answer to this question, and the answer is we should look also at physical risk. So we think that so we started a project with this issue of transition, but we can do exactly the same because we think that exactly the same is at play with physical risk. So if physical risk is a risk that is priced by banks, we think that it should behave exactly in the same way, and we want to expand the sample to do exactly what you suggested. No, we can distinguish. We can distinguish in the sense that for transition risk, we think of the firms polluting, no? And here we use emissions or the decision to decarbonize by the firm. Instead, for physical risk, the way we interpret physical risk is to say firms which are subject to the fact that if there is an earthquake, they suffer. And so typically, the heterogeneity that people use at firm level is to see whether firms are close to as close to place where there are typically earthquake or there are flood. So there are other measures of physical risk that we can use exactly in the same format, in the same structure of what we are doing.
More questions? So I think we all, but especially the presenters and discussants, deserve the coffee break now. They did an excellent job. So let me close the session here, and we break for a short coffee break now. Thank you again.
Empiezo. Good afternoon, everybody. It's really a pleasure to welcome you to this session. We have two very interesting papers on CCYB and around CCYB and positive neutral. But before I pass the floor to Javier, let me thank the organizers for your kind invitation. It's really an honor and a pleasure to be here. Rafa and myself, under Governor Linde, we organized the first conference, and like a father that is very happy that seeing growing the children, I'm really very happy to see how this conference has evolved, grown, and I'm really very proud of what we started 8 years ago. And of course, thank you very much, Rafa and the CEMFI, for the support, which is key for this conference. With any further comments, the floor is yours, Javier. You have 25 minutes, 10 minutes for the discussion, and you will have 5 minutes to grill the presenter. Thank you very much.
Okay, good afternoon, everybody. I will present the paper, Simple Implementable Financial Policy Rule, a joint work with Mauricio Calani, also for the Central Bank of Chile, and Marco Piña, PhD student in the University of Virginia. First of all, let me start with the motivation of this paper. In this paper, we study the countercyclical capital buffer, the CCYB, from the point of view of the policymaker. And the question is why this is important. Because as you can see in the graph, we show a panel for the level of the CCYB for different countries. There are a clear pattern that, or better, there is no a clear pattern regarding when and how much we have to increase the level of the CCYB, and also what is the neutral level for this new macroprudential policy. However, there are some theoretical studies and also macro banking models, as your paper, Manuel, who study these issues. So in this research, we're going to try to answer two main questions. The first one is how should the implementable financial policy rule looks like? And the second one, if there are any space for a neutral level of the CCYB. But before that, what do we know in terms of the literature regarding this topic? We can split in three different subjects. The first one is that macroprudential policies can smooth the credit cycle, and also the macroprudential policy can act as a mitigator of the systemic risk. And also there are some papers who give us some guidelines regarding the design of the CCYB. And what do we learn about this study? If we want to study this problem from a macro modeling point of view, we have to include two main frictions or two main features in the model. The first one is that we have to include financial friction in the intermediation problems in terms of the limited liability or deposit insurance, because these generate an excessive leverage in the banks that justifies a steady capital requirement. And also, we have to include a dynamic social externality in line with the paper from Helver, for example, that generates overinvestment during the bumps. So this justifies a dynamic capital requirement in the economy. So what do we do in this paper? First, we build an estimated GSG model with a prominent banking sector. Specifically, which is the model is thinking for the Chilean economy, is a small open economy new Keynesian model with intermediation problems. We will have savers, bank, and borrowers. And in terms of the financial frictions, we have incomplete markets, specifically costly state verification, a la BGG, deposit insurance, and limited liability. And one important thing, or more interesting thing of our paper, is that we take into account the occasionally boundary constraint in the design of the CCYB. Then, with this model, we consider different financial policy, and specifically simple implemental financial policy, and we will evaluate it with the consumption equivalence. Last but not least, we explore different implications of put a neutral level of the CCYB. So our main findings are two. The first one, and in line with your paper, Manuel, and also other study, that price-responsive roof generates higher welfare gains rather than other policies that follows quantities. And secondly, it's welfare optimal to have a positive level of the neutral CCYB. Okay, let me go directly to the model, and I'm going to explain the model with two main blocks. The first block in the model, the blue box, is the typical neo-Keynesian model with nominal rigidities, sticky prices, and so on. But the most important thing in the model is the green blocks. The green blocks is the financial blocks. In this block, we have savers, patient household, unrestricted, in terms of what kind of asset they can save. These savers lend money to the banks in terms of the deposit and long-term bonds. And then these banks lend money to the impatient household and also the entrepreneurs who need money to buy capital and the impatient household to buy houses. Sorry. Oh, oops. Let me go back. And obviously, because this is a small open economy, we have an external sector, a government who implement a deposit insurance, and monetary policy, and principally a financial policy. Okay. In terms of the policies of the model, the monetary policy follows a typical Taylor rule with GDP gap. And one of our main contribution in the paper is propose a financial policy, a kind of Taylor policy. As you can see, the CCYB follows the expression that you can show that governs the inertia of the CCYB by the parameters θ1. This reflects how fast we can move the CCYB. And the financial policy will react to change for a variable xt. Also, how fast and in what direction the CCYB will react in terms of the change in xt will govern by the parameter θ2. And also, we allowed some forward-looking degree in the policy. Then, the CCYB that comes from this financial policy will affect the capital requirement in the model, also for the commercial banks and the mortgages bank, and obviously this will affect the balance sheet of the banks. Okay, now let me go directly to the results in order to the time. But before that, since we are using a general equilibrium model, it's straightforward to define the welfare in the economy. And we will define the welfare as the weighted discounted flow, the utility, and it will depend for the parameter θ that try to reflect what is the financial policy behind the model and the parameters of this financial policy, and also if we put some CCYB neutral in the economy. In this line, we also can define the baseline welfare, which is the perpetuity in the stochastic steady state of the economy, without any policy and without a neutral CCYB. Then, with these two objects defined, we simulate the model using perturbation techniques with second-order approximation and planning also to find the consumption equivalence. And what is the consumption equivalence? Is the weight in the consumption of the baseline welfare that have to increase or decrease in order to equate the welfare that we obtain for a configuration of the economy, for different policies and different levels of the CCYB. So in a nutshell, is the consumption equivalent is positive, it implies that we have welfare gains for the certain configuration or certain financial policy. Okay, but now let me explain a little bit about the simple and implementable. Why this is simple and implementable? Because we only take into account X variable that we can observe. For example, the commercial spread, as in the paper from Carrillo, and also in your paper, I think you use the same, credit to GDP gap, which is the baseline guidance for the BIS, overall spread, which is the mean between the mortgages and the commercial spread, funding premium, and also we take into account some quantities rule, which is how fast growth the total credit and also the commercial credits. So in our exercise, we will keep fix the θ1, which is the inertia of the CCYB, that we assume that the CCYB will have a mean life of 4 quarters, and we're gonna find what is the parameter of θ2 in real variables that maximize the welfare of the consumption equivalence of the rules. And also we allow 3 difference of level of forward-looking degree in the financial policy. Now this is our first result of our model. First, let me explain a little bit the graph. In the horizontal X, you have the value of the θ2, which is the degree in which the financial policy will react. And in the vertical axis, you can find the consumption equivalence in percentage. So the first message that we can abstract for this figure is that the price responsive rule generates higher welfare gains, almost 3 times higher, for example, for a spread RL or a spread RB, which is the overall spread, is 3 times higher rather than the credit to GDP gap, which is the baseline guidance for the BIS. And also, you can see that for these 2 observable variables, there are not a clear gain for using different forward-looking degree. However, for the spread RD, there are some difference between the level of the forward-looking degree, but later on in the presentation, I will go deeply in this term. Now, but let me go back. We're gonna put the emphasis in the maximum of each graph, but remember that behind that, there are 2,000 simulations, or n equal to a big number that we calculate, that we use to calculate the consumption equivalence. So this graph, represents the histogram of the simulation of the CCYB in the maximum value of each figure. And the red dot lines represent the feasible band. Because remember, the CCYB can only live between 0 until 250 basis points. And as you can see, more than half of the time, if we don't take into account this feasible band, the CCYB live outside this region. So it's clear that we have to implement some filter pass band for the CCYB, or try to evaluate some non-linearity in terms of the, for example, the 0 lower bound for this new macroprudential policy. So how we do implement this effective band? With a quadratic filter. What is the quadratic filter? It's a quadratic function that we evaluate the results that come from the financial policy, and then we find the parameters A, B, and C who minimize the error function. What is the error function? It's the difference between the quadratic filter and the real value that we want that the CCYB take. For example, if the CCYB filter take 300 basis points, the maximum value is 250, so the difference between both quantities is the error in the approximation. However, if we are in the feasible band, we want that the CCYB filter take the same value of the rule, So this is the difference or the error in the error function. And finally, the minimum value that the CCYB can take is 0. All variables below 0 is the error of the approximation. So finally, in the model, the CCYB that will apply is the quadratic filter of the CCYB. That's come from the rule. It had to be said that this algorithm is applied for each rule, for each parameter, and for each configuration of the economy. So, okay, here we can see the results of applying these techniques to avoid the occasionally boundary constraints. Obviously, behind that, we try to approximate a sigmoid function with a quadratic function. So therefore, it's not a perfect approximation of the effective band, but increase a lot the accuracy in terms of the how is the mass or what amount of the mass of the CCYB lives in the feasible band. So we can avoid the bias of the result of the consumption equivalence that I showed you before. So this table summarizes all the exercise that I told you so far. Here, in the bottom, in the top of the table, you can see the consumption equivalence without effective band, which is the maximum value of the 3 lines color that I showed you before. And then we show the consumption equivalence with effective band for different degrees of forward-looking degree. And the first message is, if we apply in the effective band, obviously the consumption equivalence reduces. This is because now the CCYB cannot take values, negative values, and we have this 0 lower bound, and therefore the maximum welfare gains decrease. And also, we still have that the rules that follow prices generates higher welfare gains rather than policies that follows quantities. For example, spread RL or spread RB is almost 3 times higher than the credit to GDP, and also is higher than spread RD or the growth of the different credits. And one interesting thing about this policy is that the rules follow or inherit the characteristic of the observable. What does it mean? For example, for spread RL or spread RB, the banks in the model can react very quickly in order to change the variable or the value of this spread. And on the other hand, the spread RD follows very closely the monetary policy rate. So because we are using an initial model, we have sticky prices. So the higher welfare gains that we obtain is when we have a forward-looking degree for spread RD. In contrast, spread RL and spread RB, the higher welfare gain comes from the 0 forward-looking degree. Okay. Now, in the last minute that I have, let me show you the exercise for the positive level of neutral CCYB. But before that, let me explain the intuition behind that. Remember that our model is a very big model, but the main friction in terms of the financial friction is a costly state verification. So follow the BGG paper. The external financial premium plays a key role in order to understand the channel and the amplification in the model. So the supply of the credits will depend positively in terms of the minimum capital requirement, and also with the level of the shock in the economy. And the demand for capital is typically the expression that you can see. But now, what happens if we hit the economy with a financial shock? If we hit the economy, the probability of default of the entrepreneurs or the household mortgages will increase, and therefore increase the external financial premium. And in the new equilibrium, the amount of capital in the economy is lower, and therefore the amount of credit in the economy is lower. But because we don't have any neutral, this is the new equilibrium in the economy. On the other hand, if we put some neutral CCYB in the economy, without shock, we know that the capital in the economy is less because we have a higher capital requirement, so a less amount of credit in the economy. But now, if we hit the economy with the same shock, the old channels stay the same, but the quantity or how the contraction of how is the contraction of this supply curve is lower rather than the case without neutral CCYB. But more important, now we have the ability to release the value of the CCYB. And so therefore, we can move the red line to the green line. So in a nutshell, what is the trade-off behind the neutral CCYB in our model is that in the steady state, we will have less credits in the economy, but on the other hand, we have the ability to react to shocks in the steady state. Obviously, all of these analyses don't take into account the general equilibrium effect and also the dynamic of the economy, but now in the exercise, it will. So what we do in terms of the calibration of the CCYB, we repeat the consumption equivalence strategy. We increase the level of the minimal capital requirement, but we shift the filter. We shift the filter in terms of the level of the neutral CCYB. For example, if now we have 100 basis points of neutral CCYB, the maximum value that we can increase is 150. Now to 250 because we already have 100 basis points. And on the other hand, the minimum value that we can take is minus CCYB, minus 100 basis points. So we can shift the feasible band of the CCYB. So now this is the main result regarding the neutral CCYB. In this graph, in the horizontal X, you can find the level of the neutral CCYB, and the vertical axis, you can find the consumption equivalence. All the rules take the optimum value that we find before in the previous exercise. And first, we can see that this trade-off exists. And how we're going to realize its behavior? Because the concavity of the function. So, therefore, the concavity, we can find an optimal level of the neutral CCYB in terms of the welfare. In addition, for all financial policies, the neutral CCYB increase the welfare, and we still have that the financial policies who react to prices generate higher welfare gains rather than financial policies who react to quantities. However, all the results that I showed you so far are assuming that we are in the optimal static capital requirement. So what happens if we move from this optimal level of minimal capital requirement? We obtain the following figures. In the left-hand side, you can find 100 basis points below the optimal minimum capital requirement, or the static capital requirement. And the left-hand side, the right-hand side, you can find 100 basis points higher than the optimal minimal capital requirement. So, in a nutshell, what do we find is the same mechanisms still have, but the quantitative results are different. So how we can explain this? Because remember, in this case, when we have the optimal minimal capital requirement, the higher welfare gain is roughly 2%. But if we put less capital as a minimum capital requirement, the maximum consumption equivalence is a little bit more than 3%. And on the other hand, totally the opposite for a higher minimal capital requirement. So how we can explain this? Because if we are in the left-hand side for the, this is the stochastic steady state for the welfare for different value of the minimal capital requirement. And if we are on the left of the optimal, the gains that come from the neutral CCYB is not only for the ability to release in bad times, but only because in the steady state we need more capital. On the other hand, if we put more capital in the economy, we have too much capital in the steady state. So, in a nutshell, the two main messages is that price responses rule generate higher welfare gains rather than rules that follow quantities. And it's welfare optimal to have a positive level of neutral CCYB that it's explained because the CCYB has a zero lower bound or effective bound, and also the optimal level of the neutral CCYB depends critically of how is the minimal capital requirement. Thank you very much.
Thank you very much, Javier. Remarkably perfect timing. So let me see if I'm able to find the next presentation. Is this one? So Manuel, the floor is yours, and you have 10 minutes, please.
Can we make them bigger, the slides? Control L.
Control?
Control L, I think.
Yes.
Yeah, thank you. Yeah, okay. So first of all, thanks a lot to the organizers for the invitation. It's a pleasure to be here. Last year, I discussed Georgia's paper at the ECB conference. Very happy to discuss Javier's paper here today. First of all, let me say that I have that I think it's a very nice paper. I have a lot of questions, but I had to select just 5 in the interest of time. So please allow me to skip the summary of the paper. I'm just going to briefly motivate my discussion, and I will quickly jump into the questions I have for the authors. So first of all, let me begin by saying that there's a broad consensus based on both evidence and theory that competent authorities should release releasable capital buffers in extraordinary crisis times. However, in recent times, in recent years, there's been an intense debate on when and how should these capital buffers be built. As you know, the Basel III Accords gave birth to the CCYB in 2016, and the idea was that credit to GDP caps should be used as a key common reference for the guidance of these capital buffers. Now, there's recent empirical studies, including the one by Bedallo and Galan, which clearly show that when banks have headroom for building these capital buffers, it is not only that there's no negative and significant impact on short-term lending, but actually lending can increase at longer horizons through a strengthening in banks' resilience. Now, in this regard, I would like to highlight that in the recent tightening cycle, there's been an increasing number of competent authorities that haven't started to build this capital buffer as net interest margins were increasing. And despite the fact credit gaps were in negative territory and these monetary policy shocks and other contractionary shocks were exerting a downward pressure on aggregate demand. Now, what does the theory say about this? So, Javier's model belongs to a general class of quantitative macro banking models that give that provide a reasonable and good rationale for prudential bank capital regulation by allowing for bank risk failure with idiosyncratic asset return shocks, limited liability, and deposit insurance. Now, a common result in many of these papers is that optimal static capital requirements are very hard to beat. There's very few exceptions, importantly the paper by David Duke 2017, that find that it's optimal to have cyclical capital requirements, but these respond optimally to macro indicators such as GDP and credit.
In my recent paper by Muñoz Asmets, which I will be referring to, and apologies for being home biased, but I think it's going to be helpful in illustrating the comments I have here today, we saw that it's optimal to build these capital buffers when there is headroom for doing so, even if credit gaps are in negative territory. So moving into the questions, the first one is, how does the model speak to the evidence on the CCYB I just mentioned? Well, if I interpret this figure, the first two panels of this figure correctly, my understanding is that the CCYB should be accumulated when spreads are compressing, because I see that the value for θ2 is negative, and when credit gaps are increasing, because I see a θ2 being positive. This is basically opposed to what many national authorities did recently, but not only that, it goes against the intuition that, and the recent evidence that one should build the buffers when there's more headroom for doing so, meaning when bank profitability is going up. Now, the second quick question is, why do net interest margins enable the largest real and welfare effects for the CCYB in this environment? Authors mention risk shocks, but my question is, what about the no default condition that is common in all these models, according to which the threshold below which bank defaults is fully determined by the bank capital requirement and by the components of the net interest margin? That is really the origin by which in these models it is optimal to build in response to net interest margins. But of course, typically, one additional channel or externality is needed to activate the entire full transmission mechanism such that dynamic capital buffers are optimal in this environment, as I will explain in a bit. So what we do in our paper is basically to allow for two externalities. The first one, which is due to bank risk failure in this, and that I just explained, and the second one are basically, are pecuniary externalities due to collateral constraints in the real economy. Due to them, ultimately, there's mutually beneficial gains from trade between savers and borrowers, which can be exploited, and therefore the externality can be corrected by precisely building the capital buffer when the net interest margins are going up, because then savers are going to save more as the bank risk failure goes down, and borrowers are going to get more credit, and they're going to be able to consume more and invest more, and basically dynamic capital buffers are going to correct at the same time both externalities by managing bank resilience over the cycle. And basically, we saw that when shutting down these pecuniary externalities, the CCYB is ineffective or even counterproductive, and there's no welfare gains from this macro-prud tool. Now, importantly, these models are particularly useful to talk about the transmission mechanism, right? However, the authors do not really talk about the transmission mechanism of the CCYB. But when talking about the transmission mechanism, they basically assume what happens in the face of an exogenous tightening in static capital requirements, by assuming an exogenous shock to static capital requirements, but it's more about temporary effects of changes in static capital requirements. The story can be completely different, as the evidence says, and as we saw in our paper, if you really look at and distill the channels around the transmission mechanism of optimal dynamic capital requirements being built, in this case, in response to net interest margins. And finally, and I think this is very important because this talks about the entire analysis and discussion authors develop on the positive neutral. So how does the CCYB parameter interact with the other key policy parameters you have in your rule, meaning inertia or capital buffer smoothing parameter and the static capital requirement parameter? So first of all, in these models, there's complementarities between static capital requirements and dynamic capital buffers, because both provide stability to the system through two very different mechanisms, but there's also a trade-off for the same reason between these two. Actually, we find that there's an effective lower bound for the bank default probability, below which dynamic capital buffers are not effective. The transmission does not operate because you cannot reduce the bank default probability by accumulating this buffer because it's already very close to zero, and eventually you get welfare losses with dynamic capital buffers. I think you can kind of signal to something similar in your paper when you talk about the need of reducing static capital requirements in order to have a positive, neutral, and overall effective dynamic capital buffers. But I think you may want to elaborate more on what is behind these complementarities and behind this trade-off, and how you really want to calibrate the positive neutral. Because in this model, you may want to relate the neutral phase of the cycle to the concept of steady state. And therefore, the positive neutral may speak to the space you may have below the steady state or static capital requirements to be released. And you may find, as we do, apologies again, actually that with the optimal rule, which I'm not sure you compute by maximizing social welfare with respect to all these three policy parameters, which I think is crucial, also because inertia dramatically changes the trade-off between static and dynamic capital requirements, and you may end up finding that it's not really needed to apply the filter that you are using. I'm going to leave it here. Thanks a lot.
Thank you very much, Manuel. Perfect timing. So maybe before giving the opportunity to Javier to answer, I would like to open the floor to the audience for a few questions. And as I was expecting, Javier is the first one in addressing a question. So please, Javier, go ahead.
Thank you for the presentation. I'm familiar with these models, and I like to see them used also for small open economies, which implies enriching the model in very interesting dimensions. I had essentially two questions. The first is on, and is connected to something Manuel was saying in the discussion. It was unclear to me whether you eventually optimize simultaneously on the size of the capital requirement, the reference level, and the size of the CCYB, which will be like the releasable level. A connected question is, I think your results are probably confirming the perspective that you need sufficiently high level of capital requirements to be able to benefit from a release of the CCYB. If you were planning to releasing requirements when starting from low levels, that would be a problem. And the last question is, one of the main results in your reading of the paper you presented is that price-based rules are much better than quantity-based rules, but I would like to have 2 sentences intuition for why. Thank you.
Javier, another question, please.
Thanks for the presentation. It's very connected to the last point that Javier was doing. So I was wondering, is it the price-based rules, are they more efficient because simply prices react faster, or to shocks, or is rather because their variance, if you simulate the model, is mostly explained by the shocks that you're trying to smooth out with the CCYB measure? Yeah, thank you.
Maybe time for a last question, please.
Yes, I'd like to make reference to the graph of the curves where you show the movement of the curve of the capital requirement and the releasable turning again to the right side. I'm thinking in that movements that you explained there, I suppose that they are based on the banks working without voluntary buffers, capital buffers, because usually banks have over and above the regulatory buffers, they have voluntary buffers, usually much larger than what would be the neutral positive CCYB. So in that case, the banks could use that voluntary buffer for a temporary stress period. And in that case, they don't need this neutral capital buffer to be in place. Additionally, the experience has shown in the last years that the banks are not making use of this space that releasing buffers gives them because of stigma issues, or just because they see that this release of buffers are temporary and they will reinstate very soon. So even that that movement that you mark with the green curve, maybe it's not will not be in the practice.
Thank you very much, Javier. Please, a couple of minutes to answer.
Okay. Thank you very much, Manuel, for your comments. Obviously, you are also very familiar with this topic. And let me say, first of all, about the externality behind the welfare gains that come from CCYB is because we have the same externality as in the paper from Alherbe 2020, which is the price of the credit. It's before the realization of the shock plus an deposit insurance. Then the banks does not internalize the externality in the probability of default of the other banks. So then it's optimal, not optimal, it's welfare improvement to have welfare gains with the dynamic capital requirement. Also, we are totally agreed that we have to go deeply in terms of the mechanisms. We still working on, because we have some exercise, we are doing some exercise regarding the general impulsive response in order to understand different conditions in terms of the different level of capital that we can understand the mechanisms. And I totally agree that we have to understand the trade-off between the change in the theta 1 and theta 2. We have some exercise, but in terms of the practical view, this is a conservative way, because we know, or probably the intuition, if we want to release, it would be very fast, but we want to accumulate, is slower. So then, because it's a symmetric movement, and then it could be even more difficult to solve computationally, we take this assumption. And regarding the Javier questions, for why the prices? Because the prices, and also related to your question, reflect very well the effect of financial shocks. This is why the welfare gains come, and also because it's too fast. It's kind of both effect of your you said, and yes, the voluntary buffer. Let me give you a caveat. We are currently extending the model in a similar way as your paper, Javier and Caterina, in the twin deficit, in order to have some compliance region in order to endogenize the voluntary capital buffer. So then we can understand how is the effect of the decision of release or decision to increase the CCYB, and what is the consequences in the credits and also on the supply of credits. Yes, I think that.
Okay, yeah. Thank you very much, Javier. Of course, there will be plenty of time for you to bilaterally interact with anyone that is interested in further. Can you pass me, please? I'm really sorry, but I cannot resist to make a comment before passing the baton to Georgia. It's, I mean, you Javier, you call this paper simple. The first word is simple. To me, and admittedly, I've been away from this world for more than 5 years, is everything but simple. Even the discussion. But I'm surprised that a very practical issue has not popped up in the discussion, or maybe I've not been able to understand it. For me, this positive neutral, I think it's a weird thing. It's a concept that you have developed, I don't know why, probably because the CCYB was not able to be activated at some point. But I'm sure that after listening to Georgia, we may have time to discuss on these real problems and why we invent concepts sometimes to deal with other issues. Thank you.
Okay. Thank you very much. Let me see. Okay. Okay, so thank you very much to everyone to keep your presence here in the room. So first of all, I would like to thank a lot the organizers for including this paper in the program. It's a great pleasure to be here and obviously also to be in Madrid. So this is a joint work with my co-authors Anna Pereira, Mara Pirovano, and Florian Stamwitz. We work in central banks, so the usual disclaimers apply. So the paper is called From Losses to Buffer, Calibrating the Positive Neutral CCYB Rate in the Euro area. So just a quick remark on the motivation. So to be everyone on the same page, what do we mean here by positive neutral CCYB? Essentially, we refer to the early build-up of the CCYB when cyclical risks are not yet elevated. And since as also was mentioned in the previous presentation, since the pandemic, an increasing number of EU jurisdictions have introduced a framework with a positive neutral rate for the CCYB. The main motivations that emerged for this new use of the CCYB essentially was mainly the desire of building up the CCYB in a timely manner in order to have a higher availability of releasable buffer, but also to increase the resilience against a wider spectrum of shocks going beyond those stemming from domestic cyclical risks. And finally, also to address the potential under-calibration of the CCYB, which can stem from mismeasurement of cyclical systemic risk. So despite this increasing use of the CCYB in this way, the quantitative methods to inform its calibration are still a lot under development, and what this paper is essentially to contribute to this literature that aims to inform or to provide some quantitative framework to inform the calibration of the CCYB through the cycle, including with this positive neutral rate. So obviously we are not by any means the first one in providing some work for informing the CCYB calibration, so there is a lot of work based on risk indicators in the early days, then structural macroeconomic approaches like the work that we have just listened, and the work by Emmanuel with SMETS, and also there is all a strand of literature which includes stress testing and historical bank losses analysis, and this is where the paper sits. In particular, is very close to the work by Langen, Forletta, and Fasigna and Pereira, which essentially differ from, because while they focus on the calibration of the CCYB to address cyclical systemic risk, we include in the framework also, we integrate the calibration for the positive neutral rate. There are also some technical differences that we will see later on in the presentation. So what do we do in a nutshell? So the main idea is essentially to look at the historical bank losses and disentangle the impact of various factors on historical bank losses and then map those factors into the CCYB calibration. So we look at the impact of cyclical systemic risk, and we use this information to calibrate, to inform the calibration of the CCYB to address cyclical systemic risk, so when those are elevated. Then we look at the impact of unobserved systemic risk factors, and we use this information to calibrate the positive neutral rate for the CCYB. And at the same time, we control for a number of bank and country-specific risk factors that with the aim to mitigate or to minimize the overlap with other instruments. So with the idea that those bank and country-specific informations are mainly affecting the calibration of other micro and macroprudential capital requirements. So the ultimate goal of this work is essentially to provide a unified framework to calibrate the overall CCYB through the cycle, including when cyclical risks are not elevated. So a preview of the results, in case you will get too bored during the presentation and will not follow until the end, is essentially we provide a range for Euro area calibration of the positive neutral CCYB, which goes from 1% to 1.8%, depending on policymaker preferences. And on this I will be clearer in a second. Okay, so let's jump into the model. So our variable of interest is banks' return on assets, because we're interested in essentially looking mainly at banks' losses and profits. And if we look at this, the distribution of this variable across countries, banks, and time, on the left-hand side chart, what we see is that essentially the distribution has a clear strong left tail. If we look at this variable jointly with the DSRI, which is our composite indicator that we use throughout the paper in order to measure cyclical systemic risk, what we observe is that an increase in the DSRI typically is not followed by any movement in the median of the distribution of banks' ROA, but it does follow an increase in the left tail of the distribution. So essentially the lower percentiles go down. Given this observation, what we thought is that using a model which focused on the median or the mean of the distribution was not informative enough, so we decided to use a quantile model. In particular, we use a quantile location scale model, and we combine it with local projection in order to have a view on the impact of the variable of interest at various horizons. So we model the conditional quantile of ROA as a function of the DSRI, as a measure of cyclical systemic risk, an interaction with the T1 ratio, with the idea in mind that essentially an increase in cyclical systemic risk hits the conditional distribution of the ROA differently depending on the capitalization of the banking system. We control for a number of bank level and country level factors, and we saturate the model with bank specific and time specific fixed effects. So the benefits of our frameworks, in our view, are just, first of all, that we can capture nonlinear responses of losses across percentiles. The local projection frameworks, as I said, allow us to study the impact of the variables of interest over different time horizons, including those that are more relevant for macroprudential policy making. It's a framework that is flexible to reflect different policymaker preferences, meaning that we can look at different severity of losses and decide which level of severity of losses we want to cover, and we just can do that by looking at different percentile of the distribution. So the more we go on the left, basically, the more conservative we are. And then, from a technical point of view, the quantile location scale model avoids incidental parameter problems and quantile crossing, which means that essentially we can include in the model bank fixed effects, which is not a trivial task in a quantile model. And we consider bank-specific fixed effect being an important element when studying banks' ROA. So I will be very quick on the data. So we use both country level and bank level data. We source them from SNL Financial. We have data from 2005 to 2019 at annual frequency. We include more or less 300 euro area banks at the highest level of consolidation, and which cover around 80% of total assets. So we consider this a representative sample. Just a quick note on the estimation procedure. Since our sample structure is such that we have a small t and a large n, the estimator that we use display a bias which is essentially increasing in the n to t ratio, and so we need to perform a split sample jackknife procedure in order to essentially correct the bias of the estimates. And what we do is that we take the bias corrected estimates and recenter the confidence interval around those estimates. So this is a procedure that is suggested in the paper which proposed the estimator that we use. It's actually a bit tricky, this this mouse. Okay. So the result. So the figures here represent the marginal effect of a 1 unit increase in the DSRI on various percentile of the conditional distribution of ROA. So we can essentially see three main insights from these slides, from these results. So first of all is that an increase in cyclical systemic risk leads to a decrease in banks' ROA, which is so a negative and statistically significant impact on all the percentiles of the distribution that we are looking at, with a peak effect around the 4th years after the change in the SRI happened. This regardless of the percentile we look at. Moreover, we show a slightly stronger impact on the lower percentile of the distribution, but this is quite low, the difference. This is different compared to other studies which perform similar analysis, and with the main difference with these other papers that they do not include in the model bank-specific fixed effect, which we consider to be quite important, and we argue that this can be one of the reasons why differences across percentile are let's say, less strong and less prominent. One thing that is different across percentiles is the shape of the response. If we look at more extreme tails in the distribution, so if we look at the 5th and the 9th percentile of the distribution, what we see is that after the peak of the effects occurs, the 4th year, essentially there is a much stronger rebound at the top of the distribution, while in the bottom of the distribution the recovery is much slower. Like taken together, these results essentially suggest that the cumulated effect, first the impact is negative across the distribution, and the cumulated effect of an increase in the SRI thus seems to be stronger in the lower part of the distribution. So now we use these results, this estimated impact, in order to calibrate the cyclical systemic risk, let's call it this way, so the CCYB to address cyclical systemic risk through a linear rule, which is displayed in equation 1. So essentially, we take the overall effect of the DSRI, which is given by the terms theta and nu, which is the impact, the marginal effect of DSRI and its interaction term. And what we do is to essentially normalize this for the average risk-weighted assets in each time and country, with obviously the idea to convert essentially these coefficients in terms of unit of CCYB as per required by the regulation, and we multiply this by the level of the SRI. So with this calibration rule, we obtain time-varying and country-varying coefficients that can vary depending also on the obviously percentile that we fit our model on. So here are just 4 examples of a country that we have in the sample. So we see in all the countries that we have seen, that we have here in the slides, obviously the suggested level of CCYB by the calibration rule is fairly high in the years previous to the financial crisis, consistent with the fact that there was a high level of systemic risk in the system, while in the second part of the sample, in countries like in Austria and France, where in the post-sovereign debt crisis there was some more cyclical risk dynamics building up, we have a calibration rule which suggests an increase in cyclical in CCYB, while in other countries like Italy and Spain, where in the post-sovereign debt crisis cyclical dynamics remain mostly muted, the calibration rule does not suggest any activation of the CCYB. Okay, so now we integrate the calibration for the positive neutral rate. So we have two main elements for the positive neutral rate that we want to achieve. So first is the target rate, which is the rate at which the positive neutral CCYB is set when in times where risks are not elevated. The goal of this target rate is essentially should be high enough in order to ensure enough loss absorption capacity. We aim to target to calibrate at a rate which is unique across euro area countries, so we do not go into country-specific calibrations. And also, as I said, we want to allow some flexibility to incorporate policymaker preferences, so we provide a range of buffers rather than one single rate. And then we have the calibration, the build-up rule, which is govern the speed at which the CCYB is built up and the target rate is reached, and also when it's released. So the build-up rule is just an illustrative example. It's not really the focus of the paper, but we do provide some illustrative example to reflect our thinking on how this should look like. So how do we do that? So the calibration rule is fairly in line with the one that we have proposed for the CCYB to address cyclical systemic risk. In particular, we take the coefficients associated to the time fixed effects, those that are negative and statistically significant, and we normalize then again by average risk-weighted assets in order to have the units expressed in units of CCYB, and we take the average across the years included in the model, in the sample, sorry. Here there are two discretionary choices to be made. So first, we have to decide, obviously, which percentile we have to focus on. So as I said, we can choose any percentile of the conditional distribution. So here we focus on the 25th and the 10th percentile, with the main idea to essentially put our focus on the left side of the distribution. So we want to be below the median, but we want to avoid the really extreme tails for two reasons. First, because again, in the effort to minimize overlap with other instruments. So in particular, we want to minimize the overlap with P2G, which tend to cover losses that comes from very extreme scenarios, and also more from a technical point of view. In the very extreme tails, we tend to have a high data sparsity, and so this obviously decreases massively the precision of the estimates. So we want to avoid to have less precise estimates. So in terms of horizon selection, because we have a local projection framework, so the estimates comes at different horizons, we focus on 1 year ahead. This is just to account for the implementation lag of the CCYB. Okay, so why does this approach make sense to us? So the main desirable feature of the time fixed effect coefficient is that it's invariant across banks as opposed to be bank specific. And this aligns with the goal of capturing essentially an observed factor that simultaneously affect all the banks in each period and that are not otherwise accounted for in the regression. So this, we think that is consistent with the positive neutral CCYB, which is a macroprudential instrument, so hence is essentially set to address systemic rather than bank-specific risks. And also which aims, as I said, if we recall at the beginning of the presentation, the main goals for the positive neutral CCYB, it essentially aims to cover those losses which are uncovered by other capital buffers, because we want to minimize obviously overlap, and that essentially stem from either risks that are like going beyond those that stem from cyclical systemic risk, because this is already covered by the cyclical CCYB, or because they stem from the essentially uncertainty in measuring cyclical systemic risk. So the results of the calibration. So here, for completeness, I also show the results with the 50th percentile. But as I said, we focus on the 25th and the 10th. So essentially, if we take a more conservative approach and we cover losses stemming from the 10th percentile, then the model delivers a calibration of 1.8%, while with the 25th percentile focus, the model covers essentially, the model delivers a calibration of 1%. So this is the example of the stylized build-up rule. So what we have in mind here is that the build-up should also, I mean, as has been discussed in the previous presentation, we want to minimize the overall cost of the increase in capital requirements. And in order to do that, we set a build-up rule which says that essentially we increase the CCYB in times where banking conditions are favorable, meaning that we have a high profitability with a low dispersion in this profitability and a low financial distress, while the release happens on the other way around when we have negative profitability and high financial distress. If we implement this calibration rule and this build-up rule, we can obtain then essentially a joint calibration for the CCYB through the cycle. And in order to do this joint calibration, what we do is essentially after calibrating the positive neutral CCYB, we re-estimate the model in order to deliver new levels of cyclical CCYB, because we want to take into account the fact that in the banking system, now we have also a higher level of capitalization. And as I said at the beginning, we consider that when cyclical systemic risk hits, having a higher level of capitalization essentially can provide some, can mitigate those effects. And so we want to essentially include this and take this into account when we calibrate the CCYB to address cyclical systemic risk. So we perform this joint calibration by re-estimating the model, including the PNR in the system. So what we obtain with this joint calibration. So here again, there are just 4 examples of the countries that we have in the sample. So first of all, the main insights from this joint calibration, thank you. So is that first of all, we have a more, especially in the post-sovereign debt crisis, we have a more gradual increase in the CCYB compared to if we had only thanks to the PNR, if we had only the CCYB to address cyclical systemic risk. Moreover, and most importantly, if in the years essentially before the pandemic, in most of the countries in the sample, we would have had positive levels of CCYB overall. So we perform a number of robustness checks, with alternative specifications of the model. We tried also including or not including the significant or not significant coefficients for the calibration. We also tried different interaction terms or other macro variables, and the results seems to be robust to all those checks. Let me conclude. So this paper proposed a novel framework for the calibration of the overall CCYB through the cycle. And our approach allows to disentangle losses associated with financial cycle from those not related necessarily to the financial cycle. And this framework proposes an harmonized calibration of the positive neutral rate while also accounting for country-specific conditions. And finally, it delivers a calibration of the overall rate while also accommodating for policymaker preferences. And with this, I'll stop here. Thank you very much.
Thank you very much, Georgia. Again, remarkable management of time, which makes my job very, very, very easy. So let me see. Now for the comments, the floor is yours, Javier.
Thank you very much, Jesus, and also thank you very much from my side to Galo and Rafa for inviting me to discuss this paper, which is very interesting, very timely, and also deals with a topic that is very relevant for my own work at the bank. Let me see if this works. Oh, takes time, yes. Oh, not too much.
Yes.
Okay. I would like to start by putting the paper first in a historical context, what the original design of the CCYB was, and then in the context of the positive neutral CCYB, which many countries, including Spain, have already adopted. So in order to understand the contribution of the paper, I think this would be useful. The original design of the CCYB was as a reaction of the global financial crisis, and especially the boom that occurred in the years prior to the global financial crisis. It was thought that it would be useful to have a buffer that could grow in times of excessive credit growth. And this was, the credit to GDP gap was chosen as the indicator that would guide this activation. However, after the global financial crisis, some countries, in particular the Bank of England was a pioneer, started to realize that activation of the CCYB would take a lot of time. And in the meantime, some systemic shocks might occur. One of them was the COVID pandemic. So this was the origin of the movement towards the positive neutral framework. Many of the countries that have already adopted this framework now typically try to characterize cyclical systemic risk in different phases. For instance, in our case, it would be 3 phases. Low risk would be basically materialization. High risk would be the kind of events that would have triggered the activation of the CCYB in the original risk design, while the intermediate risk level would be basically the normal times. Normal times means that cyclical risk is not so high, but it's worth activating the buffer. How is the buffer calibrated? Well, most countries currently use a stress testing methodology. However, it is true that this methodology typically doesn't use the same models nor the same scenarios, so it's quite heterogeneous across countries. So this is where the contribution of this paper comes. And I think it's a very interesting contribution because it tries to bring some consistency across these decisions, across countries, which is clearly the way forward where we need to go. How do the authors operationalize this proposal? Well, as Georgia has very well explained, they consider a panel of euro area banks, 318 banks. I think that the effective sample starts in 2008 and ends in 2019. And they consider quantile regressions. On the left-hand side, they have return on assets. On the right-hand side, they have different, well, three main blocks of variables. Bank variables, that I believe that they are just controls. Cyclical variables. Here, the most important variable is the systemic risk indicator, or the DSRI, because this is the indicator that they use to calibrate what they call CCYB for cyclical systemic risk. And it's, the formula is on the right. I have put in red the variables that are country specific. So that formula, the coefficient of the quantile regression is not country specific, but then some of the variables are country specific. And finally, there are fixed effects, bank and time fixed effects. Sorry, I forgot to mention that in terms of cyclical variables, there are all other cyclical variables. Coming to the fixed effects, the time fixed effects are the most important ones because those are the effects that the authors use to calibrate the positive neutral CCYB. In this case, they take 2018 as the more normal year in their sample, and the calibration is basically the maximum time fixed effect compared to this year. Okay. In addition to this framework to calibrate the buffer, as Georgia has explained, there is also a proposal, at least an illustrative proposal, for the build-up, the maintenance, and also the release of the buffer, which depends on, for instance, the build-up depends on the return on assets being in the country above the historical median. The standard deviation of this variable has to be sufficiently low, and then the level of systemic stress in the financial market should also be low. The rate at which the buffer is accumulated cannot surpass 25% of bank profits. Okay. I will give here my overall assessment, and then I would like to talk about some specific details. First, as I have mentioned, it's clearly a consistent tool, which is very important. I will talk very briefly about the econometric approach, but it's also a robust econometric approach, very interesting. The fact that there is an automatic rule is also interesting. I mean, national authorities, when they activate the CCYB, typically can deviate from rules, but rules are important because they impose some consistency in our decisions. At least we have to explain when we deviate, why we deviate. So this is very useful. On the more or less positive side, I have some comments in order to increase some the capacity of the model to adapt to national specificities. I mean, for instance, when you consider a positive neutral CCYB, it is true that many countries are now clustering around 1%, but at least the model could have more flexibility. And then, well, as I don't have much time, I will move here to my main comment. Well, my main comment is that I still consider the positive neutral CCYB as a cyclical buffer. So you calibrate what you call CCYB for cyclical systemic risk based on the systemic risk indicator. However, there are other cyclical variables that are very important, and they may capture part of the systemic cyclical systemic risk. In contrast, the positive neutral is based on time fixed effects, which are residual, so they could be sensitive to adding more or less cyclical variables. This may be a crazy proposal, but at least I would suggest to explore these other cyclical variables in order to explore a potential alternative calibration of the CCYB. For instance, intuitively, normal times can be thought as a period in which the DSRI is not very high, but GDP is growing, sovereign spreads are not so high. This could be operationalized in a calibrating formula. However, this would require probably reestimating the model with different variables, but it might be worth trying. In my last minute, let me see if, okay. Also, regarding the econometric approach, which I find very, very interesting, there is a literature already. I am an outsider here, but I believe that you introduce a kind of linear structure in the coefficients across quantiles, which is avoid some problems that you have mentioned. Why linear? Perhaps quadratic effect might be interesting. And also regarding the return on assets, I am not sure if you are using total consolidated profits in order to compute this. For large international banks, it may matter to consider consolidated ROE or only business in the country. However, as the CCYB is a buffer for national exposure, for domestic exposures, I think it would matter. Perhaps in Spain you wouldn't activate so early in 2015 if you consider only business in Spain. I don't know, something to consider. And well, I think I will stop here because we are running out of time. Thank you very much.
Thank you very much. We are sorry for pressing you so much. So maybe a couple of questions from the audience, please. Rafa, please. Mike is coming. Thank you. In these exercises, the endogenous response of banks to the regulation is ignored, essentially. And I think that, so basically, the idea is let's look at the buffer effects of the regulation for a given probability distribution of losses or whatever the indicator you're having, as opposed to thinking about what kind of incentive effects this regulation may actually have. And these effects may be on the size of voluntary buffers, like you were mentioning before, on the incentives for risk-taking. I understand that this is a horribly difficult problem, but I think that, I mean, having in mind that the other side is not going to stay quiet and it will do something, and anticipating what may happen on the side of the regulators may be important. Now, the second thing is that the paper, or the papers really follow the silo approach of the Basel Committee. So you have the different types of regulations, capital, liquidity, for credit, market, operational, etc. But I think that, I mean, it would be, again, the ideal thing would be to think about the different ingredients of the regulation, not sort of looking at the interaction between the different elements of the regulation. So in the paper by Javier, you have the 5, right? And then you were playing around with these two things. I think that having a sort of a less partial silo perspective, a more holistic approach to the entire regulation would be desirable. Now, what I'm sort of proposing is sort of a horribly difficult problem. And basically, the point that I would like to make is not a question. It's essentially that we need a lot more research on these topics, and we are far from sort of having to call off these type of conferences going forward, because there is a lot of stuff to be done on these and other related matters. Thank you.
Thank you very much. Another question, please. No more questions? Okay, please. Short and sharp.
Okay, I will bring something that I think is typically absent from these discussions. When we propose regulations to banks, some of these regulations are costly to banks. So a natural complement would be to reward banks for the cost we are creating with those regulations. For example, if we ask them to be particularly tight with, or not tight, loose with their capital, or should have more capital in their balance sheets, we know that capital for tax reasons is an inefficient form of finance for banks. So a natural thing would be to give a tax incentives while we are imposing those regulations, and then thinking the general equilibrium effect of those a bit more seriously. I mean, again, this is completely external to the discussion in banking typically, but in corporate finance, the natural lever of intervention would be the tax rate. So I'm not sure that the central banks can do much about the fiscal policy, but it's something to think about.
Thank you very much. If I may add a question, it's a corollary of your paper that ECB is ready to apply Article 5 of SSM regulation. Thank you. The floor is yours.
Okay, so thank you very much, Javier, for the very constructive and useful discussion. Really super appreciated. A lot of food for thoughts. Yeah, definitely the point on country specificities to be taken more into account is something we would like to definitely work on, and also, I mean, it's very important to make it more operational, obviously, because it's given the national nature of the tool. I mean, there are a lot of things that I think we want to discuss, so we will do it bilaterally, and but in general, really, thanks a lot. It really provides a lot of also like really material for improving the paper, so thank you very much. So regarding the so yeah, taking into account the endogenous response of banks to regulation. So yeah, this is a very important point. The paper is I mean, the model is a reduced form model, so it's yeah, this is what, I mean, I show what the model can do, and this is something the model cannot do. So, but yeah, I mean, definitely, I mean, it would be very interesting to work on some extensions or or some type of modeling that take this into account using a similar framework. But yeah, this is, I mean, this I guess would be completely, different work. Also, very interesting the point on the interactions across different regulations and being more holistic. We try to, I mean, we try to do that in order to, I mean, we try to kind of have an holistic view in the sense that we argue that we include in the model a number of, of bank variables and then country level variables. Probably on the country level side, some structural characteristics are missing. But then okay, then there will be a problem with the time fixed effects, that some information will be absorbed there. But essentially, we strive to have an holistic approach by including as much as possible in the model, because we said, okay, I mean, we want to have this residual component that we take for the positive neutral, and we try not to overlap this with any other instrument in the regulation, and we try to kind of put there all the like bank-specific characteristics or other cyclical characteristics that are used to calibrate or should influence other buffers. But this is definitely something we try to do. Finally, in terms of rewarding. Like actually, one thing that that made me think your comment is that one aspect that it's important is also to take into account the cost of implementing those requirements, and also there, like it's something that we have thought a lot about to include in the model, to include in the paper. Sorry, but so far, also there we think that it's probably going to be completely different work because it's like really not in the focus on the paper, but it's definitely something that it's worth. It's an aspect that is worth exploring and worth studying. In the paper, we just essentially try to see how much the buffer should be to cover certain amount of losses, because then this would translate in capital depletion. But actually, we neglect the cost of increasing. The only part of the paper where we take into account the cost of increasing requirements is essentially when we have this stylized build-up rule, and we try to see, like, to make it dependent on bank profitability in order to minimize the cost, because this has been shown largely in the literature that like costs of increasing capital requirements are largely nonlinear in the bank profitability in bank conditions, banking sector conditions. But it's something that we do not dig too much deeper into it. And then, the paper, I don't know whether that would be a corollary, because it has obviously some limitation in what it's really focused on. The amount of losses that should cover certain specific, the amount of buffers that should cover like certain specific losses, and I think that would be a bit maybe ambitious for the paper to say that would be a corollary. So maybe I will stop there. Thank you.
Thank you very much. I think that thank you very much, discussions and the audience and the authors. We move immediately to the next section. Thank you very much.
So thank you very much. This is the last session of today, and I wouldn't say it's the best, but I think that it's on the top of the conference. I am pleased to introduce our keynote speaker, Thomas Philippon. Tomas is currently the Max Elheim Professor of Finance at the Stern School of Business of New York University. It is not an exaggeration to say that he is one of the brightest and the most talented economists of his generation, as his impressive academic and research curriculum attests. After having earned an MA in physics from École Polytechnique, any of you who is a French national or fellow traveler know what that means, a master in economics from the Paris School of Economics and a PhD in economics from MIT. He joined the faculty of NYU in 2003. And over the last 2 decades, Professor Philippon has held various visiting professors at some of the finest universities in the United States. He has advised the Financial Stability Board, the Federal Reserve Bank of New York, as well as the French Minister of Finance and the ACPR, which is the French Prudential and Resolution Authority, among many other important responsibilities. Not least remarkably, our keynote speaker this afternoon has been the recipient of several prestigious prizes and distinctions awarded to young economists, including the Hermann Bernather Prize, which, as many of you may know, is an award that here at the Bank of Spain we award annually to European young economists who have made outstanding contributions in the fields of macro and finance. Tomas' research interests are wide-ranging, spanning topics in the field of macroeconomics, corporate finance, business cycle, earnings, unemployment. So summing up, it is not by accident that Professor Philippon has crossed the Atlantic this week to deliver not one, but 2 keynote speeches in less than 48 hours, yesterday in Frankfurt at the ECB and today here in Madrid. So he's very hot on the market of keynote speakers. Today, Professor Philippon will address the design and implementation of a stress test for the banking sector. That, for those of you who pay attention to the initial discussion this morning by Governor Knot and Governor Escrivá, is a topic of increasing importance for central banks and supervisory authorities worldwide. We are eagerly waiting to hear your presentations over the next half an hour. And then we will open the floor for questions from you. So thank you very much.
All right, good afternoon. So first of all, you are way too kind. I'm not that hot on the market. What happened is I agreed to go to the ECB, and then somebody leaked that information, and then Rafa asked me to come, and I couldn't say no. So that's, and B, I think the last time I had the pleasure to be in Madrid was indeed for the Bernather Prize, and I still have absolutely fantastic memories of that. So I already loved Madrid before, but ever more since then. And last point, oh, can I have a clicker or something? And last point, some people had the unfortunate honor, José Luis, for instance, to be at the ECB yesterday. So I was worried they would hear twice the same speech. But in part to avoid boring them to death, and in part because this conference has a stronger focus on stress testing, I decided to give you a bit of the overview that some people told me were useful yesterday. But then dive a little bit more into the details of stress testing. So it's going to be half of what I said yesterday and half new stuff. Okay, so the goal is to give you a framework for crisis resolution and stress testing. And I'm just going to emphasize the result that I found surprising when I did the research or when I read other people's research. And I'm going to try to emphasize that there are very strong links between micro and macro prudential. I would even go as far as to say that, you know, we all remember in 2008 when we said, oh, we were too focused on individual bank stability and not the system as a whole. And then I think that was an unfortunate consequence of thinking that there is such a thing as macro versus micro prudential. I plead 100% guilty. I was just like everybody. I was repeating the same mantra without thinking about it. I think it's deeply wrong, and I'll show you why. There's no difference. Okay, so I'm going to try to explain all of that and then talk about challenges, because it's kind of fun to talk about the past crisis, but it's more fun to think about the next ones, and so that's what we're going to do at the end. Okay, so let's start with what I think is like the baseline framework to think about these issues. So we want to think about ex ante, ex post, right? Ex ante is when we design stuff and when banks misbehave. And then ex post is when either they make money and nobody thinks about us, or the shit hits the fan and then the banks are desperate and everybody's blaming us for not seeing the crisis coming. All right, so I think that's a framework we're all familiar with. Okay, so in the crisis box there, I put market failures and interventions. So that's the first thing we need to discuss, which you can't discuss stress testing, in fact, or any type of regulation without specifying what is it that you're worried about and what is it you're going to do if something bad happens. So we're going to first, as usual in economics, we do backward induction, so we start by the end and we move back in time. So we're going to first do the square box, thinking about what's the mapping between market failures and interventions, and then think back about what we do at time zero, and then the linkages between the two. Now the first linkage, the one that we've thought about in the past and tried to implement regulation, is based on moral hazard, and that's the idea that whatever you end up doing in the square box at the bottom right, involving transfers from taxpayer to various institutions, so bailouts in general, is going to feed back into the time zero decision of banks or NBFI in terms of their risk taking, both micro level, so individual banks taking risk, or macro in the sense that you tighten the screw somewhere and then the risk goes somewhere else. Okay, so we're first going to analyze the black box, and that's where I'm going to be fast, because I spent a bit of time yesterday explaining the details, so there I'm just really going to give you the headlines. Okay, so I'll take a very neoclassical approach here, and I want to make essentially 1.5 points. The first half point is that I think we're all convinced now, so just bear repeating only once, which is the right framework to think about that is no commitment. That is, there's no point thinking about regulations that you will not implement ex post. So the way you think about it is, if the crisis comes, you're going to do whatever it takes to solve it. Okay? You might have said the day before you would tie your hand and not do, and that doesn't work. Okay? It's not like Ulysses, we don't have a mast where we can just tie ourselves to. So I think that's obvious. Now the important point, I think, is to understand that there is a mapping between the thing you're trying to solve and the instrument you should be using. And if you think about it, I hope it's going to become less surprising afterward, but that mapping appears to be quite tight. So I'm going to think about 3 types of crisis: runs, debt overhang, lack of equity, whatever you want to call it, insolvency. And the third is some kind of market freeze because of adverse selection. Runs, I think it's pretty clear. We have one tool, which is some form of deposit insurance / liquidity support. So there's no point discussing that much further. I will go back to that when I talk about challenges going forward, because the thing that's kind of interesting is, I would argue we've had, we've been thinking about runs and we've been writing model about runs for a century and a half or something, but we never really had runs, to be honest. In the past, they were all freaking slow. So we call them runs because conceptually it's useful, but we never had runs. Like if it takes 20 days to move 20 billion, I don't call that a run. Okay, I think now we do have runs. Okay, post SVB. So I think that's something to talk about. But otherwise, I think that one is explored. So no point spending too much time on that. So debt overhang and adverse selection. Okay, so debt overhang, it turns out that, and again, hopefully that's going to be intuitive. So fundamentally, debt overhang is when a large class of credit assets become risky, which is the flip side of saying there is not enough equity supporting them. And so when you intervene in that market, it's not going to take the form of lending because there's already too much debt. Okay, so ex post efficient intervention against debt overhang always take the form of capital injection. So that's point number 1. Point number 2, you don't want to inject equity against nothing. So the question is against what? And it turns out that in a wide class of model we analyzed with Philip Schnabel, the optimal solution is to inject equity against a mix of preferred stocks and warrants. Interestingly, successful interventions typically have used that. Why preferred stocks? Well, because you want to punish the shareholders, but you don't want to add debt overhang, so you don't want to, worsen the debt issue. So you want to be in between, right? Junior to the debt, but senior to the shareholders. And then why the warrants? Well, because you want to give money to the taxpayer. And so if you're successful, and in fact, in a benchmark debt overhang model, the government can make money. Because if you unclog the system, solve the debt overhang, asset prices are going to go back up, and if you position yourself correctly, you can net out a profit. And to get that profit, though, you need to have a claim on the upside, and that's why you want warrants. So you can formalize all of that, but that's the cost minimizing. That's what gets you to the Pareto frontier. Okay, what about adverse selection? So adverse selection, it's a bit different. Okay, so it's a market that's freezing because people don't trust each other, and then the cost of fund is so high that good types decide that they'd rather wait. Okay, and in the market you only have the bad type. So that's a classic lemon market. Now there it's a little bit more subtle, but thankfully the big principle still works. So the reason it's more subtle is if you're in a world of asymmetric information, then every action has a signaling component, okay? And that means when the government designs a program, who self-selects into the program becomes a very important, in fact, we just mentioned that earlier about the CCYB. Anything you do becomes a signal, okay? And so in fact, in this case, if you design any government program, you're gonna have banks deciding whether to use the government money or not. And you have outside investors watching what's going on. If a bank decides to join the government program or not, it's going to be interpreted by the market as a signal of whether the bank is strong or weak. Okay. Now you could imagine two cases. One is when the bad apples go to the government, the good apples stay in the market. And then, so then in a sense that's good because then the market becomes more efficient. Right? In fact, you're going to get rid of the adverse selection in the market. So the private market is going to go back to functioning, but then the government is going to end up with all the bad apples, so maybe super costly for the government. Or you can flip it, saying, oh, suppose it's the other way. Suppose the good guys go to see the government, and then the bad guys stay in the market. Well, it's not clear it's going to be great either, because unless you really have a very strong participation, you're still going to have adverse selection in the private market, so you're not solving the market freeze. You do end up with the good apples. So for the government, that may be less costly. It turns out that none of that matters very much once you design the program optimally. So what's the conclusion there? First, the optimal instrument is debt guarantee or direct lending. So why is that? Well, I can show you the math, but I think the deeper intuition is, it's a bit like in if you write like a second best program, you try to make sure that you give the government the exact same constraint as the private sector. Right? You're not assuming the government can do better or worse. That's the same thing here. So fundamentally, the government is trying to solve the same problem as the private sector, which is one of asymmetric information. And we know what the private sector solution is. That's why they create debt contracts. Okay? So because the privately optimal solution is to use debt contract, the socially optimal intervention tool is also going to be a debt contract. Okay? That's kind of the very high-level intuition. The math is not easy, but I think that's the high-level intuition. So you're going to use debt contract, and typically either debt guarantees or direct lending by the authorities. Usually these two are equivalent. And then what's interesting? Well, first thing that's interesting is the efficiency of the intervention and the cost of the intervention has literally nothing to do with the size of the program. I mean, literally. So how much you actually end up lending is completely irrelevant for how much it's going to cost and for its efficiency. All that matters is that's conditional on using the right instrument. If you don't use the right instrument, you get screwed all over, of course. But conditional on using the right instrument, then the sufficient statistics with the success of the operation is what you do to private prices. So are you lowering the private cost of fund? That's what's going to determine both the cost and the efficiency of the intervention. And the final surprising thing is you don't need to shut down the markets. So Because in this world, you see, you could imagine, well, it's such a pain in the neck that these guys are watching. And so if I could just shut down the private market for a little bit, then I wouldn't have to worry about banks signaling to their investors, and that's why they don't want to join. So if I just suspend temporarily the private market, so I don't have the signaling issue, it's a legitimate question. It turns out, and that's where it's kind of very subtle, that it actually doesn't help. You don't get better. You don't need to shut down the private market. Okay. So, big lesson number one, appropriate tools. Optimal instruments align with the market failure. So against runs, you do deposit insurance. Against debt overhang, you do equity injections. Against warrants, against credit freeze, you do debt guarantees or direct lending. Okay? Notice something that's peculiar here, which is asset purchases are very rarely a good idea. Now, of course, you'd say, well, that's probably because the bankers always ask for asset purchases. Well, that's the reason, because it's not optimal. So if you do an asset purchase, you're going to end up transferring more money to the banks for the same welfare benefits. So it is in their private interest to ask for asset purchase, but in this wide class of model, it is not optimal for the government to do that. I can talk later about counterexamples where actually you could use some asset purchase, but not in this class. Okay, so that's big lesson number one. Big lesson number two is going to be about the fact that these are still like, you have one nail, one hammer. But the real world is more interesting than that. And in particular, there is no room in any of these for either asset quality reviews ex post or stress test ex ante, because we haven't specified like information set. And so the thing that's interesting is to think about, okay, suppose the government can do all of that is can use its balance sheet, but also provide information. Then what changes? And it turns out a lot of things change. Okay, so let's do the first one. This one actually, interestingly, was motivated by what happened in Spain. Because I remember talking to American regulators and complaining about the fact that the first batch of EU stress tests were weak. And I was like, yeah, okay, you're right, but think about it. Like, why is it that you ran a very relatively aggressive stress test in the spring of 2009? Do you think it has something to do with the fact that the Treasury prepositioned the money and told you that, be honest, and if it turns out the result is bad, we will back you out. We have the money set aside. Now, suppose you didn't have that luxury. Would you have run a tough stress test? No, but that's what the Spaniards are doing. They are not crazy, And so I think that's what got me thinking about that. And that actually simple extension has very interesting, surprising consequences. So all we do is we do run versus adverse selection. So it's like literally Diamond Dybvig meets Akerlof, exactly. And then we have two tools for the government, which is the usual bailouts. And you've seen before the kind of optimal instrument. So that's going to apply here. So the optimal tax or balance sheet instrument for the government is going to be a mixture of DI and debt guarantees. Okay, but then he has this extra tool, which is to disclose information. Okay, now I don't call that a stress test because this is ex post. You're already in the crisis. You're trying to calm the market down. So I would call that an asset quality review. Okay, and I think it's misleading to call that a stress test because you're not designing scenarios. You're already in the deep doo-doo and you're like, okay, I'm trying to figure out how bad it is. So what happens then? Well, the trade-off now, especially in this country, should be obvious, which is if you disclose information, you might be able to unfreeze the credit market because essentially you told the private sector, these are the good guys, you can lend to them at a reasonable spread. So then these guys are going to go borrow, lend, and invest. Okay? The problem is all the bad guys you singled out are all going to be run on. Okay? So then what happens? Well, the trade-off is the more information you disclose, at least over some range, the better it's going to be for the private credit market, but the higher is the risk of a run. So what happens then? Well, what happens is exactly the intuition we had from earlier, which is having access to a deep balance sheet on the government is like an insurance policy. So if you don't know in advance what the stress test or the AQR is going to deliver, but if you know that if the results are bad, you have the balance sheet to stabilize the system, you're de facto, it's almost equivalent to having a lower risk aversion as a regulator. So you're more willing to take the risk. Say, okay, I'm going to take the risk. I'm going to run a very tough stress test, and I'm going to publicly disclose the results. And if it turns out the results are bad, I will use my balance sheet to stabilize the system. Sounds intuitive, okay? But the first thing it does is rich governments do better, in the sense that they spend less taxpayer money in equilibrium. Okay? And to me, that was always the thing that I thought made no sense in the, or made little sense in the first generation models of moral hazard. They always had this very, very strong prediction that if you could just tell the government not to spend anything, or if the government is so constrained it can't spend anything, then in equilibrium it's going to do better. And I just think it's not true. And so that's one reason, which is in this world, a rich government, and remember, this is no commitment. So it's not that they can commit, they have the money, they could spend it. But there is a better tool. It's just that this tool is risky and therefore you only use it if you have a big balance sheet. But I think that's a good prediction, actually. So in that world, it becomes inefficient to restrict government bailout options exposed. You can still restrict the tools they could use, all kinds of stuff. But the idea that you put an upper bound on how much money they can spend actually is inefficient. It's inefficient in the sense that not only you're going to have worse crisis, but you're going to end up spending more money, not less. Okay, so related to that is another thing where I changed my mind a little bit. I always thought that the too big to fail was hopeless, precisely because I think the only reasonable framework is no commitment. Okay, so how can you believe that banks are big and the system cannot be led to fail, no matter what you say ex ante? How can you believe that and at the same time believe that we can do something about too big to fail? And I think I've changed my mind in part on that because it's all about how do you go from losses and bailouts back to moral hazard? Okay, and essentially the feature of all the first generation models is they have one bank or one representative bank. So in that world, how much money you spend exposed is a sufficient statistic for how much money you create, how much more hazard you create ex ante. It's like almost one-to-one, right? You're going to give them money in the bad state of the world, they're going to take more risk. And by how much? Well, proportional, or at least the increasing function of how much you give them exposed. So you only need to worry about the total amount of money you're going to spend, or total taxpayer loss. I also think that's completely wrong. Because the way to think about it is you have many banks, or at least several. And private incentives are not a function of the aggregate size of the pot, but how much they get individually. So imagine a world where you have 5 banks. So A, B, C, D, E, these are the names of the banks. So literally they identified the banks. And then 1, 2, 3, 4, 5, that's the ranking of the banks in the crisis. Okay. And of course, they don't know where they're going to end up. So bank C, for instance, might end up being the top dog. And then bank D might end up being the worst performing bank. Okay. Now suppose you have a policy that says, I'm going to shoot the red one. And that's it. That's your policy. That's all there is to it. Then we can talk about credibility after. Well, that policy would actually have a big impact on private incentives because nobody would want to be number 5. So in fact, you would engineer a race to the top in that case. Now, if you formalize, what matters really is green minus red, which is how much do you reward bank 1 versus how much you punish bank 5. Okay. Now that's a cross-sectional object. It is not the same as the average amount of money you're spending. It's the distribution that matters. And this allows you to make big progress on too big to fail. Okay? So, I guess let me just one question. Why? Because, so take the simple case where you have this bank 1, 2, 3, 4, 5 are perfect substitute with one another, and you don't have limited liability. Then almost literally, you can commit to shooting down the worst performing banks. This is not shutting down the system because the other 4 are still there. They're going to take over the business. So you are actually not shutting down the system. And that's going to create great incentives. Now, if you have limited liability, you will have to reward green and punish red at the same time. Okay. But you will still get rid of moral hazard, even though you are bailing out the system exposed. So again, there will be no connection, or there will be little connection between how much you are spending exposed and the amount of moral hazard you're creating ex ante. But distribution matters. And this works only to the extent that you can actually shut down the worst performing. And that only works if you have good macroprudential tools. Okay? So that's a big thing, I'm going to come back to that. But that doesn't work if you don't have a way of merging banks, if that's efficient. Okay? So that's a case where having good micro tools, literally being able to change the pieces at the micro level, is the way of solving the macro moral hazard. So that's what I mean when I say I think the prudential macro and micro are kind of two sides of the same coin. They are not that different. Okay, so let's speed up a bit. So let's talk about stress test. So when you think about stress testing, now you're thinking about this bottom left part that feeds into various places. If you have a good stress test, you're going to be ready for the intervention. That's the first thing. The second thing is you're going to try to measure what these guys are doing and limit their risk taking. And then doing so, you're also going to change the probability of a crisis. Okay. So now let's dive a little bit into what that means and how you do it. So I think as of now, we're doing stress testing for two separate reasons. One is to set capital requirement. The other one is to learn and do risk management. So we're going to focus on the learning and risk management part and then go back to asking whether there's a tension with the second one. Okay, so what's stress testing in my view? Well, it's three parts. You have the scenario design, then you have to project the numbers, and then you disclose the results. Okay, so disclosure, stuff like that we've discussed before, that's part of the run versus lemon. So I'm going to focus on the first box, which is scenario design. So in the paper with Cecilia, we solved that problem, essentially. We tell you how you design the scenario. So a little bit of notation just so you know how it maps. So that's the only slide with stuff on it. So I'm thinking of a world where you have a bunch of macro risk factors, J, and so the factors are S. They are like states of the world. Okay. So in the simplest case, you think of S1 is GDP, S2 is the VIX, S3 is the exchange rate, and stuff like that. Equivalently, if you run a macro model of like the type of macro model we saw in the previous session, then the S's would be structural shocks, and then you would back out the other guys from it. Okay. And then the key thing is these are the things that determine, to some extent, the losses by the banks. Let's Y be the loss by bank I instead S. It's going to be S times X plus eta. Eta is just noise, because we have always noise, so I put it there. But the thing that's important is X. So X is the vector of exposures that the banks have. And the key is that you don't know what X is. Okay? You know it exists, you know they have exposure to different types of risk, but you don't know. So the name of the game is to guess what X is. Okay? And stress testing then becomes a tool to ask questions about the bank. The questions are the counterfactual P&L they would have in different scenarios. And using these questions, you learn about X. Okay? And then you specify some welfare function for what it is you care about. So typically something like you don't want your system to be undercapitalized, so you have some target capital ratio, and then you subtract the losses. Okay? So this, as it turns out, you can write it as a Kalman filter, but on its head, in a sense. Okay? Which is you're designing the input so you maximize your learning. Okay? So it's a little bit like, it's almost the opposite of what you would do if you thought about like the real world. Okay? Because in the real world, you just have stuff happening and you're trying to update. Here is you creating the stuff, you're creating the scenario to maximize. Okay? So you input, so when there's a hat on something, it means it's not a real world. It's not GDP falling 10%. It's your scenario saying GDP falls 10%. Yeah, I'm going to go a bit over time, I can tell you already. So, so you input scenarios, and then you ask the banks to report losses. Okay, that's the baseline. That's the baseline bottom-up. I'll talk about top-down afterwards. And then you learn. So what is learning here? Well, conditional, remember, what you want to learn about is X, the exposure. So now you have a distribution of X conditional on what you've learned. What you've learned is the result the banks give you, which is their P&L or estimated P&L Y hat. But you also know what you ask them. So condition on Y hat and S hat, you have learning about X. And you learn about the mean and the distribution of X. Okay? And then you take actions based on that. the actions, so to be simple here, we go two broad classes of action. One is essentially a capital requirement, or like a broad-based LTV, which it hits everybody. And another one is a targeted action, like a prompt corrective action. Okay, so just to think of it as tier 1 versus PCA. Okay. So you learn and then you take appropriate action. Okay, so what we do is we solve that thing here. We solve the pink stuff in the middle, which is what are the questions you should be asking? What are the optimal scenarios to learn about the underlying exposures? Okay, and then this is one of the punchlines. So bear with me once. So there is a bit of information on that slide. It's not as horrible as you think. So on the vertical axis, I have the welfare gain from being able to run stress tests. Okay, and it's measured in units of tier 1 capital, in the sense that if the stuff on the left is 100% or 1, it means it's equivalent. Running a stress test gives you the same boost in welfare as having 1 unit of tier 1 for free. Okay, so that's why we scale the utility gain. So you can relate to stress testing versus capital requirement. And on the horizontal axis is the amount of uncertainty in your economy. So first thing that's obvious is these curves are very convex. Okay, so stress test, that would be obvious, but like it's quantitatively is going to be very true. More uncertainty increases the value of stress testing a lot. Okay, if there's little uncertainty, you just gain nothing. The second thing is if you compare the left and the right panels, the scales are very different. On the left, it goes from 1 to 7%. On the right, it goes up to 40%. Okay, so what's the difference? Well, the difference is on the left, all you can do in response to a stress test result is adjust the capital requirement. And that's just not that useful. There's just not that much information you can gain that's going to make you change your mind about this very broad level stuff. Okay. So if all you're going to do after a stress test is to change capital requirement, then a stress test is not that useful. And why? Because intuitively, you're never going to go to the extreme. You're always going to stand, depending on how you define it, but like 15% or something like that. Okay. So there's no point learning something that the answer is going to be 15% no matter what. On the right, the curve that shoots up is the curve where you have plus intervention. So that's the case where you have something like a PCA. The key difference there is if you learn something from the stress test, in your toolkit to respond, you also have the option of doing a targeted intervention, either on a specific bank or on a specific market or a specific class of borrowers. So that's the key. Learning from stress tests is useful only to the extent that you can have a targeted intervention. Otherwise, you're mostly wasting your time, as far as learning is concerned. Okay? The other thing you can see is the other curves are quite close to each other, and the other curve, what they have is they speak to the tension between using stress tests for setting tier 1 ratios. So when you have 2 free, that means you're free to choose 2 scenarios, and the curve right below with the little circle is 1 fixed, 1 free. That means you're already using up 1 scenario as your baseline for your normal adverse for setting the tier 1. So you don't, and that's one is not very free. You only have 1 scenario where you can explore more like crazy stuff. It turns out that 1 is almost good enough. Okay? All right. So lesson from stress testing. Again, the micro-macro is key. Like stress testing, there's big stuff with this big macro exercise we do. The information content of it is useful only if you have good micro tools. Okay? So I think that's a big theme, this micro-macro stuff. And then you need to ask the right question. Okay, so since I'm running low on time, I'm going to quickly talk about the new stuff, or the more speculative stuff. I'm not repeating what's at the top. I said it already. Now, what are the challenges? I think that going forward, we're going to have 3 types of challenges, or maybe 2.5. So one has to do with speed and segmentation, one with market power, and the third with conflict with other objectives, either monetary or fiscal. So the time stuff, the speed stuff, I think is pretty obvious. Like everything we've talked about so far assumes that you can get to the weekend. Okay? Assume that if the crisis hits on Wednesday, you can actually implement all of this stuff over the weekend. And it was very true until SVB. Problem is, it's not true anymore. Combination of markets, apps, online, social media, whatever you want. But the fact is, now the runs are actually runs. They go very fast. Another one which is similar to that is the LDI crisis in the UK, where there what happened is private capital was just so freaking slow to move. That crisis on paper should have been absolutely privately resolved. Yeah, all you had to do was move money from one pocket to the other. If you could think about the LDI guys and the insurers and the pension on the one together. And it took them, they said, oh, it's going to take us 3 weeks to move the money around. So there is like the slowness of the private capital that actually forced the central bank to do something. But in both cases, that means the speed becomes an issue. Market power and concentrated market, they actually makes things worse. Because most of the time, so market power concentration means that these private agents are going to behave strategically. And most of the time, what that's going to mean is going to play against you. Because strategic players are going to slow down the help. So that's the Rajan Diamond huge paper, but that we saw also in the case of the LDI in the UK. The hedge funds are like, oh, we're going to wait until that hit rock bottom, and then we're going to come in. We're not going to, why come in earlier? You know. So if they were not strategic, that would not happen, because they were trying to front run each other. But if they are strategic, they know there are few of them, and maybe they collude in the background, I don't know. But then you can just say, we're going to wait for the crisis to be really bad, the price is very low, and then we're going to come in and earn a few billion pounds, which they did. And they speed up the risk on the other hand. Okay, so concentrated market is like you lose on both sides. The help is going to come more slowly, and then the risk is going to speed up because of predatory trading. Okay, so that implication is it makes the stress test more important, right? In that world, you need to run the right stress test because speed and segmentation are kind of almost the same if you think about it. Speed means when you send the money matters, and fragmentation means where you send the money matter. But in fact, sometimes this segregation is also along the dimension of trading speed. So you need to use the stress test more efficiently in this world because you need to be ready. And I think it also has a third role, which is usually we think of stress testing as, well, we have one baseline scenario or one adverse or whatever you want to call it where we use it. It has to be realistic, so it's not exploratory, and you use it to set the tier 1 ratios. Then you have another one, hopefully, where you can ask more like crazy questions so you can learn something new. Okay. And these are the two uses of stress testing that we discussed so far. I think in this world there is a third one, which is like credible prepositioning. If you have run the right stress test, you've already thought about the tools you would be able to implement. Okay? Now, in the world where you could get to the weekend, it makes no difference because between Wednesday and Friday evening, you have enough time to think about the tools. But in the new world where speed actually matters, it's better if you think about the tools in advance. And the only way you can think about the right tools is by running the right stress tests. Okay? And it's true on the financial side. I think it's even more true on the political side, which is if you're going to have to lend a lot of money very quickly, it's going to help a lot if you run the stress test that correspond to that scenario, because there you could argue, look, we thought it could happen. We crunched the number. These guys are solvent in that scenario. They're just illiquid. So it's okay for me to run and lend them very quickly a lot of money. Okay? But if you haven't done the homework before, you're going to have a massive political backlash if you try to do it quickly. Because they're going to ask you, oh, no, don't do it quickly. First, make sure that they are actually solvent but illiquid. So I think that this pre-positioning, both financially and politically, is a third rule for stress testing in this new world. And the last thing I want to talk about is top-down versus bottom-up. So there is clearly a case for, Klaas said that this morning, the governor of the Dutch Central Bank, that he wants having this top-down stuff because it's more nimble. I think it's absolutely correct. You can have more scenarios and you can include more players. So I think there is no question that this is something that should be developed. And hopefully the framework I showed you earlier is almost like plug and play. So, you specify what you care about, what you're worried about, and then it's going to create the scenarios for you that correspond to this. But I think the bottom-up part, we should not discard it completely. Because at the end of the day, one of the key things with the bottom-up is it is one of the very few exercises, and maybe that's why the banks don't like it, by the way. It's one of the very few exercises where it balances a little bit the information advantage, or rather the information disadvantage of the government. Because for the first time, you're going to get in answers from the different banks, and you can compare across banks what they say. And it's harder to find a better way to find who's cheating, Because if they give you two different answers to the same question, even though you think a priori their business models are similar, you might be suspicious. And it is very hard to learn that in any other way. So I think the great virtue of the bottom-up is precisely to test something like either somebody is lying or even without being too negative about it, just like they have different models and it's about model robustness. Okay? But that's not something you would get from the top down. So in that sense, I think it's very important to keep running the... last thing, and then, yeah, so my last slide. So now the question is, are these things going to conflict with other stuff you want to do? So monetary policy or fiscal policy? With monetary policy, I think the issue is we've seen is central banks no central bank runs scenarios with high inflation. That's obviously crazy, you know, if you think from a Bayesian perspective, but we also know why. Okay, you know, suppose you come up with a scenario with very high uncontrolled inflation, then you're the central bankers. People are going to interpret that as you're admitting you don't know what you're doing. So that there is a tension, clearly. The second one with fiscal policy, I think is going to become more important, which is, I think, the main source of financial risk over the next 5 years, by a wide margin. I mean, after Putin, it's fiscal policy. So, you know, so many countries, the US first, are running completely unsustainable fiscal policies. So many candidates in many countries, including mine, have totally crazy ideas about what they would do if they were elected. That's the major source of financial risk. But it's clear that it's going to be very hard for a central bank to run a public scenario. Maybe privately, top-down, yes, if you do it quietly. But bottom-up, there's no way you're going to publish a scenario where things go haywire because your government is running an irresponsible fiscal policy. And yet, that is a question you would like to ask. But you can't, because it's too dangerous for a central bank. So one suggestion is, I think there's be a stronger role for having kind of delegate that thing a little bit. So you're not bearing the responsibility for creating the scenario. And having some kind of independent advisor for the scenarios would be useful in that world. All right, thank you.
Thank you very much for it was quite clear and inspiring. So if you want, we can open the floor to collect some questions. So the first question there. Oops.
Thank you, Thomas. That was, frankly, a great presentation. I learned a ton. Let me just put forward a couple of things that are unclear to me. They sound intuitive, but I'm not sure I understand them properly. The first one was when you proposed tournaments as a way of reducing moral hazard among banks. And we know that tournaments are never optimal as an incentive scheme unless we have a very, very weird situations. For example, if you are the last bank in the tournament, but just by a penny, obviously that is not the same that you are last in the tournament by a lot. That's an example of why tournaments don't reflect all the information. So I'm a bit surprised that you find that as an optimal suggestion. Maybe there is other assumptions I didn't see. The second observation, again, is a little bit of how general is your statement about market power is bad for market discipline. I can also think in situations in which you can use the fact that people have market power to make them internalize things that they don't internalize otherwise, and that could be useful. And finally, and perhaps because we have a president now that is completely unpredictable in the United States, or maybe in Spain, there is also some comment about how private uncertainty about public policy can be costly. But again, it can be useful as well. I mean, I can imagine public policy that is subject to mixed strategies under certain circumstances that could be helpful. Again, it's a little bit of, are you sure that those things are general or they are intuitive and specific to your particular environments?
Should we collect a second question here, and then so no here. Okay, we will collect all, and then
yes. So on the point on that the stress test to be super fast, you recommend that you have to give the money super fast, like in the case of United States in 2009, different from Europe. It seems extremely similar to the deposit insurance. Let's forget about Silicon Valley Bank. In the past, FDIC was unique in the world that they promised to give you the money on the following day. Once they promise you that, people don't run, and that's why we didn't see runs in the United States. So is it very similar to that? Because it looks like identical. And then when you said that, say, QE or asset purchases are not, are inefficient, maybe in systems like the euro area, in which you don't issue euros, so you don't have that credibility, then maybe promises like the Draghi in July 2012, or the TPI, this was the ONT, or the TPI in the COVID, might be optimal. It's a way of becoming, of promising that money immediately.
Thank you. There was a question there. Thank you for this interesting keynote. I felt that in a way there was a contradiction between the premise that you laid out at the beginning of you can't commit as an authority not to intervene in a crisis, and then later when you have this tournament with the banks where you say you let the worst bank fail. So perhaps you can elaborate on that tension. Also in that context, you stress the importance of what you call macroprudential tools to deal with that bad bank. But in a way, if you mean that you want to improve resolvability of a failed bank, to me, in a way, that's macro-pru, right? And you want to be able to deal with the interconnectedness of that bank and all the efforts that have been undertaken in this regard to deal with SIFIs since the GFC. To me, they have a macroprudential connotation or dimension that's very important. Thank you.
There were Federico there and Carlos here. Yeah, because maybe
thanks for the keynote. A couple of questions. So the first one is about the signaling information effect when you implement a new macroprudential measure. You talked about 3 of them, and so I was simply wondering, is this something we should be worried about whenever you implement a new stress test, and this might be a coordinating device for markets to panic about a certain aspect. The second point is instead about stress tests themselves. I feel like you only talked about whether to run them or and disclose all the results or not run them at all. I was wondering whether there is cases in which only disclosing partially the results is actually optimal or can help. Thank you.
I'm gonna forget the question if I. Let's do a second round after. Okay, so great questions, all of them. Okay, so let's start with the tournament question. There were 2 separate questions on the tournament part. So why is it optimal and why is it time consistent? Okay, in fact, the 2 are connected. So I said tournament because it's the intuitive way to do it, but you design the payoff structure. So you don't have to, if the last one fails by epsilon, the punishment can also be continuous in that. But the key thing is that it depends on the cross-section. And typically the way you would do it is depend in a continuous way, so it's not like you don't punish for epsilon. But the key is you play one against the other, and that's the critical part. And that to me is the key nature of the tournament. It's a relative performance evaluation. Okay, so maybe the technical way to do it is you do a relative performance evaluation, but it's going to look like a tournament. And then there's going to be a winner and a loser. And so in the case where the green and the red are separate, like the prime example of something that works well is the bad bank is performing very poorly, and you want the more healthy bank to just take it over. Okay. So then the question becomes, one, do you have the tools to do that? So that to me is the connection with the micro, which is you need good tools to do that. You need to be able to wipe down the shareholders of the red bank to 0. And that's not so easy to do, as we saw in practice. So that's a good tool. And then you have the tool for merging them, okay? With all the technical part in the background, from the IT to the counterparties in various derivatives. So to me, these are all micro-prudential in the sense that they are like, can you do it in practice, like technically? If the answer is yes, then that becomes credible. See, this is the key. Then it becomes credible, because that's actually, you are happy to do that. It is ex post efficient to do that, so you're going to do it. But it's also good for incentives. And in fact, it goes further. It is okay to give money to green. It is okay to give green a first loss protection against the assets of red. If green is saying, oh my God, okay, fine, I could buy red, but there is this balance is complicated, there might be hidden losses in there, I'm worried. If the government says, okay, I'm going to give you protection, so the first losses are on us, is that moral hazard? Well, no, it's not. It is not moral hazard, because it's something you get only if you're green. So that works, actually. And that's exposed Pareto optimal, and therefore it is time consistent. Okay, so that's kind of the big answer on the tournament part. On the market power, yes, I agree. That one is, I went fast. There are cases where, essentially all the cases where market power could be good is like what is the story we tell about Canada. You have a few big banks, they have big margins, they have a reason to stay alive, and therefore they don't take, so it's like the franchise value. So anything, but then it's broader than that. You say, like, if you have good franchise value for reasons X, Y, Z, then it's good for stability. If one of these reasons happen to be market power, it's going to have a good effect via the franchise value. But I would put that in the broad category of franchise value, and I think honestly that there are ways to improve franchise value that are not necessarily linked to market power. So, but I agree with that, so absolutely. If market power improves franchise value, that channel is good. The other channels are going to be strategic, and they're always going to play against the government. The hedge funds have a strong incentive to wait. You know, like what did they do in the UK? They started trading at 7:30 in the morning, when the day the Treasury was going to start their program at 8:30 in the morning, and they make 4 billion out of it. They could have moved in Monday. They didn't. And if they were competitive, they would have. So that's when, like, and then the predatory trading, which is the thing you're worried about when that would speed up the risk. Same thing, predatory trading is one-to-one with concentration market power, their incentives. So in that sense, I think that it's more likely to be bad than good. And your last question was, what was it about public policy? So that's what I meant is in this world where, you know, the source of the risk is the government itself, at least in some countries, then this policy becomes tricky to think about. And to me, it's a bit like the conflict with fiscal policy more broadly. I mean, are you going to run a scenario where you say my government become crazy and start doing stuff that's going to move the market 20% up and down for no reason? I mean, that's a stress test which would be actually useful to run, but you know, you can't, because you can't ask that question if you're the part of the government. So, and that's what I meant. Okay, and then José Luis. So the FDIC, yes. So speed. So the FDIC had two great things actually. One is they were very fast, and so they would show up on Friday, shut the bank down, and on Monday you had your money back. So they would shut down the run. The other thing they did, which I learned writing the papers, is they actually implemented the green-red scheme. FDIC closure of banks is not based on the absolute performance of the bank. It's based on relative performance. If all the banks do poorly, they're going to shut down the worst performing, relatively speaking, and they're going to merge with the best performing. But that best performing might be worse performing than the worst performing was in the boom. That doesn't matter. That's very good for incentives. So I think that's the two things they had going for them. The only trouble they have now is they can't get to the weekend. So that's kind of I think that's the key issue. And then the asset purchase, so that's very important. So the asset purchase part, my claim was if you're trying to solve like a financial crisis, like a issue of equity in the private sector, in the private bank, undercapitalization, or a market freeze because of adverse selection like we had after 2009, then buying the asset is a bad idea. Buying a broad class of assets on which there is no asymmetric information, that is a different game, and that actually can be optimal. Okay. So buying a lot of gilt, like the fact that the Bank of England bought a lot of gilt, I think makes sense. The fact they did it in a way which was so predictable that they allowed the sharks to profit from it is less optimal in my view. Same thing with the Eurozone. The good thing with Draghi is that was actually a perfect one, because that was not predictable. See, he didn't say, oh, on Wednesday, I'm going to tell you something great that's going to solve the market. Because then, of course, all the hedge funds would have pre-positioned to benefit from, but he didn't do that. He announced, boom, whatever it takes. So I think that's kind of the key, and that is totally fine. It does bring at some point back the moral hazard question about, if the issue that is that the crisis is triggered by irresponsible fiscal policy, what is it you're going to do about it? Are you going to bail out the government or not? That question is still going to be there. Okay, I don't think, oh no, and the signaling part, yeah. So for the signaling part of QE, I think that thankfully we have this great research agenda paper by Haddad, Morera, it's on this, actually, it's still there, and Muir, where I think it's that they are just plain and simple. They have the right framework, that's it, just use it. Everything is a plan. There is no such thing as a temporary intervention. There is no such thing as a temporary QE. Everything is a plan. If you announce something, people are going to think of it as how it plays out over the years. They're going to think about states of the world in the future where you're going to redo that policy. Everything is a plan. There is no such thing. So that's it. And so therefore, if you announce something, it is always going to have this big signaling effect. And it could be good or bad. Often, if it's well done, it's good. In fact, the whatever it takes was a prime example of that. But you have to think about the trade-off, because there is no free announcement of, I'm going to do it for a week and then I'm going to stop. No, that doesn't exist. Okay, I think that's it, no? So maybe second round of.
Okay, so there was still one question.
Thanks for the speech. One more question. I agree that publishing a harsh results together with a message of no policy action is not going to be optimal. Generally, it's kind of the supervisory equivalent of shouting the end is nigh. And actually, it might be difficult to commit to take no policy action if you publish a harsh result. But assuming that's not possible, could it be still optimal to? Could it still be optimal to perform the stress test even if no policy action is taken? Because otherwise, you can get into bad dynamics. So what's the point of not performing the stress test in that situation? Kind of hoping that the bad banks kind of get subsidized by the good banks in the sense that the market perceives the average, but if this average is very low, maybe it's still the best option to execute the test to show the market that there are some good institutions. So I don't know, I guess what are your final thoughts on when you have not many policy options, what is the best time to do or not to do the test? Thanks.
Yeah, no, but I think maybe I need to clarify that. A stress test, there's stress test in peacetime and stress test in wartime. A stress test in wartime, I call that an asset quality review. Because you are in a bad scenario and you just want to figure out how bad it is, okay? You're not trying to be very forward-looking or very creative. So that one is always going to be a tool in the toolbox, no question. So if you end up in a situation where the things are bad and you need to reassure the market, doing an asset quality review, which is like a mini stress test, or like, I think that's totally, of course, that's going to be part of it. I'm more thinking of stress tests in peacetime. Because what happened over the history of since 2010 is initially, so first of all, the first, wartime stress test was successful in the US, which is why it became popular and stuff like that, okay? And eventually we did the same in Europe. But now when you move to stress testing in peacetime, initially there was an information content in the thing that you could see the stock prices moving in response to the publication of the result. But that died out very quickly. Today it's fully predictable. So the baseline scenario today is just another way of setting the capital requirement. And by the way, I'm not against it. I think it's a pretty good way to do it. But there is no information in there. The day you release the result, there is zero information content. Nobody cares. The market don't move. Nobody is learning anything. Okay. So, but it's still a good way to set the capital requirement. Okay. But it is not an information acquisition exercise. To acquire information, you need to have another scenario or two where you can ask questions that are not realistic, in the sense that they are not part of the plausible set of stuff that's going to happen over the next year. So you would never use this scenario to set capital requirements. But you can still learn from them. And so what I'm advocating is that these scenarios are the ones where we need to be a bit more creative. And I think it's going to be hard to be creative if the scenarios are fully designed in-house because then they become like a signaling device and they become a political nightmare. So outsourcing some of it could be useful.
Okay, so Denise?
She's going to bring the mic.
I was just wondering, in all this, how do you see the bail-in options? Bail-in instruments, and whether governments can commit to, if they raise enough bail-in instruments, if they can enforce that, can they commit to no bailout? You know, it all comes down to taxpayer money or the industry money at the end of the day, but how does it fit with your thinking?
They are very useful that I don't have time to cover. Bail-in and clawbacks. And they are very tightly connected, obviously. You can think of a bail-in instrument as a way of clawing back returns to the investors. So these are always going to be useful. They are great for incentives, they are great for taxpayer. So in terms of my, all the things I described, they would, to me, they would be part of the good, like they would be like good micro tools. If you can claw back money earned by traders, by CEOs, by everybody, if you can bail in some investors, that's going to be good for incentive, good for taxpayer. But it will never add up to the full macro insurance. And I would go even further. I think it shouldn't, in the sense that it's still the case that the government, it's cheaper for the government to provide catastrophe insurance. It's going to be true no matter what. So, in other words, if you were to force the size of all the bail-inable stuff to be big enough that it would cover your creative, not the adverse scenario, the creative severely adverse. I mean, for instance, take COVID. That's another, COVID also, obviously. Great example where in COVID, absolutely, you can buy asset as much as you want. There is no problem, no more hazard, and it's a great thing to do. But like say COVID, for instance, you know, in a shock like that, you need the government. There is nowhere, if you were to make sure that the private sector has enough fund to cover like something like COVID power 2 with some even worse virus, I mean, that won't happen. So I think that the clawbacks and bail-ins and all these tools that you have, they are great, but I think they don't negate the fact that we're still going to need the balance sheet of the government as a backstop at some point. So I just want to be able to use that efficiently. That's what I'm trying to do.
Okay. So I think we call it a day. Thank you very much. Thanks to all of you. It has been a very long day. Thanks to the keynote. It has been a very nice talk. We see each other tomorrow at 9. And,
now we're going to drink.
Now, yeah. Thank you.